Welcome to this course where I will show you exactly how you can make money at day trading, the real way. I will show you a simple, structured, easy to follow way and how you can build the skill of trading. This is the exact approach I'm using today and I've been using for so many years that gave me the opportunity to quit my 9 to 5 to be able to support for myself and my family and most importantly have the ability to be able to get into the market and make money. My name is Mustafa. I run this school community, and in this course, I will break down exactly, step by step, completely for free, how you can do it yourself. All right? So let's jump right into it. I'm going to have a short presentation with you just explaining some facets of my mission through this. Why am I doing this? And also my story. So you should know who you're talking to, right? So my mission is very simple. My mission is to make trading simple. It rhymes, right? My mission is simple to make trading simple. Why am I doing this? Because I'm teaching what I needed when I was on my trading journey. And I'm not focused on the money amount because you will at the end of this video and understand that the money is not that important. So I want to focus on giving people the skill for free. I'm not asking for any money. Giving people the skill so they can learn it and you can set your own paycheck. Because if you have the skill, you can make $1,000 a month just to pay off your car bills and your payments on the house and your apartment just to make a living. And you can decide you can make $10,000 or $100,000. It doesn't matter. It's up to you. So I don't want to set that goal for you. You should decide what's suitable for you. And the problem with the trading industry is that these things that I'm going to share with you in this course is that the information is all hidden behind expensive walls, right? You have to pay this amount to be able to get access to this, to be able to do this. My approach right here, I'm just going to give all of it for free. Why? Because I'm standing on the shoulders of giants. I'm here where I'm here today because of the teachers and my mentors that I've learned throughout the years. I paid for mentorship and I paid for classes to learn and pay for books and courses for all of these things to to get where I am today. So I'm grateful for my mentors and my teachers that they put out this information now for some money amount, but I'm gonna do it entirely for free. And the information that's out there is that they're complicated because I remember when I started day trading, things were complicated in the trading industry. We don't know which symbol to trade. We don't know how much to trade. Should we enter with all our money? How should we do all these things? It seems like there's news right now. What should we do during the news? It seems like such an enormous thing to tackle, so we don't take the first step. So that's why I want to make it simple. I want to make it easy. And to be transparent and easy, this is labeled a scam industry. We are inside a scammy labeled industry. The things that got to do with money and people's livelihood and all of these things, they all convey scarcity mindset. If somebody takes my money, I don't feel safe anymore. And this is why trading is such a scammy industry because they trick people in to either gain money quickly or don't lose your money, so put this right here, and then they take your money. So I just want to keep it out on the table. And this could not be scammy. I don't want to talk about it way too much, but this cannot possibly be scammy because it's all for free, right? I have nothing to sell you. I'm giving it all for free. And if it's free and still scammy, I don't know how to talk about that. So why am I doing this? I want to help you get results first. I want to gain your trust. And if that makes sense, I want to help you scale even further. And if it makes sense, if we can work together, I want to help you scale even further and maybe start a business together, start a venture together, do something together. Because when you reach, from my perspective, when you reach that level of trading, it gets boring. And how do we connect with people today? We connect with people through social media. So I don't want to I want my hopes are to connect with people that you do trading, you make it work, and then you make some money, and then you will want to scale to the next level, and that is when connect with me, write to me, maybe we can do something. Uh, I love to do that. So if you win, I win. That's how it works. If I can help you win, then I win. But it's a long-term um, vision of mine. So I just want you to start and start for free. You don't need to pay anything. All right. So my story, I'm going to share a little bit about myself. Who is this guy, right? Why, why am I listening to you? Why should you even complete this course, right? Why am I worth listening to? That's a great question because you might saw a short or a reel or on Instagram, Facebook, on YouTube, on all these social media platforms, and I told you to join the community, and then when you join the community, you pressed on this course, and now you are here. Welcome. Love to have you here. And now I'm going to share a little bit about myself and who I am and what made me come to this position right here. So my story is very um, different, I would say, because I'm a I have a degree in computer science and engineering. I'm an IT guy. So my last position I worked as an IT project manager inside the dental industry. I created the dental medical record system for dentists around Europe and around Scandinavia, right? So I was an IT project manager for that position, and I was in that position for a couple of years, and I my main goal for my career was to become a project manager. I really wanted to be a project manager, lead a team, build a system, and create something. But I found out very quickly that it feels like I've been tricked my entire life. It's like somebody have told me you need to get a degree and then get a job and then you work your ladder up in the career ladder and then you get a high paying job and you just do those things and when you get that job you just live in apathy, not be happy, make some money, live that simple life and just continue like that for the rest of your life. And I saw how my colleagues, like they hated their lives. My colleagues is not just those two the people at the exhibition, but my colleagues they walked around sad, and even one of my colleagues cried next to me next to the computer. It was a bad environment, and I didn't like that, and I saw my trajectory going that way. So I was stuck. I was stuck in that position, and I wanted to get out. So I wanted to get out, but how should I get out? And we had a baby on the way, and I had parents, and I need to feed the family, I need to support the family, and my parents were getting older. I needed to to help them financially. So just give me a second. So I wanted to help them out financially also. So I was a bit stuck. So that's why I wanted to have something to leave my 9 to 5. I wanted to have a skill that I can rely on myself and feed my family and my my parents and the people I care about forever. And I wanted to be put anywhere in the world just to have a computer and internet connection and be able to make money from that. Um, I'm focused more on the skill. So the goal was to have a skill, like a tool, to be able to work that tool anywhere I went. So I started reading day trading things. I started learning day trading, and I started, you know, trying it out, trying demo account, doing challenges back and forth, failing them back and forth. Fun the challenge was not that big at the time, but I did those things. I tried everything out just to have some, just to build on my skill. I even napped at the at the office. This was a real picture. That's the crazy. That's at the office. I napped at the office because I couldn't the time I quit my job and then I went home, it took me such a long time to go home. So told myself, I nap at the office and I do some trading, back testing exercises, read some trading um, to learn the skill and not go home and waste time. So I've been trading before, but not really trading because before it was like somebody said, "Oh, gold is going up." I took some money and then I put it in gold, right? Crypto is the new thing. I took some money and I invested in crypto, and I didn't know what I didn't know what the stop loss was. I didn't know how to take profits. I didn't know the taxes of them. How does the taxes work with all of these things? And I get it. We are all inadequate in the beginning. That's what I said to myself. We are all inadequate in the beginning because it's a new thing, right? So then COVID happened. And what happened during COVID? The timing of this was so perfect. When COVID happened, we had our first child, and I started trading. You can see here on the computer, I traded and I worked my 9 to 5, and it was perfect. You know, I could work and I could trade at the same time, and I didn't have anybody disturbing me and and stopping me from trading basically. So it was a great we went to Spain, I traded, I worked, I had the family with me, and I lived the life, you know, because I love trading. I love working. That's my main thing. So I did continue trade and I continued to do all those things, but I have one fear because I entered the vicious cycle of gaining some profits and then losing them, and then gaining some profits and then losing them, and going back and forth and having that circle over and over and over again until it feels like is this even happening? And that's why my mind goes directly to this is a scammy industry because how can they make it happen, right? And the one thing I didn't mention is that I have a huge fear of losing money. Money for me has always been a insecurity in my life. I didn't have enough money. I was focused on money. I saved money. I was stingy with money and all these things because I was so afraid of losing them. When I got some money, it was like I put up walls not to lose that the money. So when COVID ended and we had to go back to to the office, I couldn't take the environment of sitting next in the office, working a 9 to 5 back again. And they weren't even flexible with working from home. So I decided, I have some money saved up. We don't need to upgrade the house and upgrade the cars and upgrade all these things and get more stuck in debt. So what did I do? I resigned. I resigned my position at work and I said, you know what? I have money put aside for a couple of years for me to just focus on trade. I had some success with trading, but it wasn't that good enough to be honest with you. So I resigned and uh, I wanted to focus all my attention on trading. So what happened a week after that? I got a text message a week after that somebody says that your bank account is about to be breached or somebody's getting into the bank account. So I opened the app and I opened the text message. I called the people sending me the text message, and before I knew it, like this, all my savings disappeared. And my biggest fear happened in front of me. I lost all my savings like in an instant. And this is the first time my wife walks into the room and she sees me like on my knees crying, like I just felt like the biggest failure in my life because I'm here, you know, I quit my job and I wanted to focus on trading and I want to do all this thing and I have some safety with the money, and like I mentioned before, my biggest fear just came to life because I lost everything. I lost every bit of saving I had during that time and I felt like a wreck. And then I stopped trading. I stopped trading. I was sitting there. Hello, I'm a victim. It's the guy's fault who called me. It's the bank's fault who don't have security. It's this guy's fault, and I stopped trading and I started blaming everybody for everything except myself. So I became a victim. But then I looked at my son. When he looks at me, what is the story I'm telling my son about myself? I'm the mirror to my kid. I'm the mirror to my children. What are they seeing? What's going to be my story to my son? That somebody scammed me of all my money? Is that going to be my story? So I told my wife, I need to figure this out. So I booked a cabin and I went there for myself and I went and just reflected. I sat there for a couple of hours, 3 days, and just sat there and reflected about what do I want to do? What is my story? What do you want your story to be about? And I'm so much into storytelling and movies and I love these kind of things with stories. And I told myself, what is your story going to be? That you did trading, you find some success in it, and then you lost everything, and that is it? That's your best shot? You gave power to somebody else over your outcome. And like my mindset going into this is I rather starve to death than be a victim. I rather starve to death than be a victim. So what did I do? I buckled up and I worked like hell on trading. And the thing that happened to me elevated my trading to a whole another level. Why? Because every time I put on a risk on a trade, I thought to myself, I've lost 100x this amount. What this amount is nothing. And even but the wins became like I've lost 100x this amount. So the losses is nothing. All the discipline and the issues and the overtrading and all these things just went away by losing everything. And I never knew. I never knew that that was the worst feeling in my life. That the thing that happened, that I lost everything because that was the biggest like I was facing my monster, my demon. And because I faced my demon and then I went back into the game, there is no demon anymore. There is no devil. There is no something scaring me. And I never could have guessed that the biggest fall down, the biggest mistake, the biggest hurdle in my life gave me the skill that I can feed my family for generations. So the money, that's what I said in the beginning, the money is not important. The skill is important. Because if you have the skill, it doesn't money can disappear like that. If you have the skill, you can you can you can make as much money as you want because trading is high leveraged. Trading is high leveraged. You can make small amount, you can make a large amount. It all depends on what you want and the goals that you have. So I got into trading and now I've been doing it for a couple of years and it's been working for me. And I want to share all the things that I've learned, all the steps that I learned, all the system all the spreadsheet, everything, and I just want to give it to you. So hopefully in the future we can work together. So this is my story. This is who I am. This is the first video. And I really hope that if you like this video, follow me on Facebook, follow me on Instagram, follow me on the school community if you're not there already. See you in the next video. Have a good day. Hello and welcome to Trading Made Simple, where you will learn how to read the market, manage risk, and build a structured approach into trading. In this video, I'm going to break down everything that you can expect from this course and what you will learn and the 4-stage roadmap to where you are, to where you will be at the end of this entire course. So I'm going to talk about 3 things. I'm going to talk about the 4-stage roadmap, what you will learn in this course, and what you should expect, basically. So my name is Mustafa, and let's jump right into it. So the trading roadmap that I'm going to talk about in this course is number 1, foundation. So we are right now here in the foundation part, getting set up. And number 2 is reading the market. After you have everything set up, we want to know what we're watching in the market, the charts, how they move, how they react. And number 3, after we know what we're watching, after we know how to read the market, we need to find something specific to look for on a consistent basis so we can apply or take a trade or sell a trade from that strategy that we're using. And at the end, risk, psychology, and consistency, right? If we don't have risk properly, if we don't have the right mindset and the right psychology, and if we don't apply that with consistency, we will never be able to build a house. So I put a house right here as a metaphor. The metaphor is that if you master all these things, at the end, you will have the skill or the ability to create a generational structure. Because you've seen houses. When a house Some houses can stand for 200 years and 100 years. That's what I want to give you. I'm going to give you a skill that could stand in the test of time, that you can be using that skill as much as you want, and you can teach other people that skill further. So, what will you learn in this course? I'm going to talk about how trading actually works. You will understand what a trade is, you will understand how price moves and how the market functions, because the market is so big and there are so many symbols that you can trade. And to be able to understand these things, I'm simplifying it for you in a simple manner so you can you can understand what I'm talking about. And I'm using simple language, simple English for you to actually understand what trading is and how it works. I'm going to also talk about how to think as a trader, the mindset and the discipline and the habits you need, even the food and when to eat and how to eat and the coffee consumption, all these things. I'm going to talk to you about how to become a better trader and how day traders or traders think when they trade. And also how to build the route foundation. And this is what we're going to focus on the first step. The tools you need, the charts you need. I don't want to show you something in number 3 where you need it in number 1. I want to go through every step with you in the beginning so you can have the right tools and the right structure in the beginning, because I know how confusing it is. You had to install some things and enter them and the templates and all these things. I'm going to share it all with you. And number 3 is what you should expect from trading. You know, many people, right? Let's keep it honest. We enter trading. Why? Because we want money. We see somebody on social media making 8K in 8 minutes, right? It's luring. It's luring us in. That's why most people want to get into trading, because they associate also money with freedom. If I have the money, I am free. So just to keep it honest, trading is a skill and it takes time. Like if somebody makes $8,000 in 8 minutes, maybe it works. Maybe it works for them, but maybe it took them 15 years to master that skill. It's just like a profession. It becomes like you have to learn and practice and make mistakes and grow. It's not something you can just copy from somebody that's doing it correctly. You can copy their mindset, but you have to eventually go and do it by yourself. And also, to keep it real, losses are part of the process. Losses are part of the success. You know, when I see somebody successful can be subjective to any other person. Success is different for you when it's different for me, right? When I see somebody successful, my mind directly goes to, man, he must had so many losses, because that's how you win. You, if you just sit and don't do nothing, you, you you're out of the game. But if you act and take a loss, and you act again and take a loss, and you learn during these stages, you're so much far ahead than the person that didn't do anything. So the more losses, which is a part of trading, you have to lose. It's a guarantee. But then you have to apply correct risk management, as we talked about in the roadmap. You have to apply the principles of correct risk management to be able to lose small and then win big. So the focus is not on the money. The focus is on the process, on the systems, on the cheat sheets that you using, on the habits, on personal development. Because if you're strong outside of the market, you will be strong inside the market. So let's recap a bit. In this lesson, we covered 3 important ideas. The 4-stage roadmap. We are in the stage foundation right now. What you will learn in this course, these steps that I talked about what you will learn in this course, how to read market, how to read analysis, how to adjust your risk correctly, how to stay ahead with the habits, and how to check the news, how to act when there are news in the market, and what you should realistically expect from trading. You know, the realistic expectations from trading. I get so many messages sent to me, like people are ruining their lives by setting so high expectations on themselves. You don't need to just make you don't need to focus on how to make 10K a month. Focus on making $50 this week, you know, and take that $50 and pay your electric bill. Just start out there, make it feel real to you. So in this course, it's built and designed to give you the right foundation in the beginning, because I know how confusing and complicated it might seem. All right. So just a short lesson check-in. You now started trading made simple course. Just take a moment to think about, why am I learning trading? Why did I enter this? What's my goal with this? One sentence is enough. Just share it below in the comment section below. And I'm here to tell you, because you're here, hats off to you. Really, because you've taken this seriously and you've taken the first step to perfecting the skill of trading. Like always, if you like this video, feel free to follow me on YouTube, on Instagram, and if you're not following me on my school community, feel free to join. On our YouTube, I share videos and content that's not a part of the course and not a part of the community, just me talking and giving my perspective. So talk to you more there, and have a great day. See you on the next video. Hello and welcome to this lesson where I'm going to talk about how trading actually works. I'm going to break down 3 main points in this lesson, and I'm going to talk about what a trade actually is. Buy versus sell. What does that mean? I'm also going to talk about why price moves in the market. You look at the chart, you're seeing those candles moving up and down. Why does the candles move up and down? And number 3, I'm going to talk about the role of the brokers and the role of the liquidity inside the market. So if you've ever been to Turkey or Egypt or any of these, Morocco, any of these places, they have bazaars. So what's happening in the bazaar? There are people who are selling, there are sellers, and there are buyers. If I want to go into the bazaar buying a purse for my wife, or you know, a lighter for myself or something like that, I want to have the lowest price possible from the seller. So that is the transaction that is recorded inside the market. I want to buy something, somebody's selling something, the transaction that is happening, that is what's recorded in the charts. So when you see the charts moving, you're seeing transaction between people. Somebody's buying and somebody's selling. What is a trade actually? It, what a trade actually is: buy versus sell. So every trade had 2 sides. There are simple sides. You have buyers who want to buy, and you have sellers who want to sell. So when people say I'm buying, they're expecting for the prices to go up. So when people say I want to buy, they want to go long. The word long is associated with buying. I'm buying for it to go long. And selling is associated with the word short. I want to go short. So buying, I'm going long. Buyers are expecting price to go higher, and sellers are expecting price to go lower. That's how it works. So why does price move in the market? Price moves because of supply and demand. If you want people to buy, let me give you a short example. So there is this monkey right now, right? People have emotional attachment to the monkey. The monkey was playing in the zoo with other monkey, and it's a doll. They sell it on IKEA. So this monkey costs like $3, right? And now you can see on social media and on marketplaces that this doll cost $100 because it's so much demand in that monkey. People want it so much. There are a huge amount of people wanting these things, and there's the demand of it makes the price go up. So so when people don't want it, the price goes down. And this is how the large participants manipulate the market. There's institutions, there are hedge funds, there are banks. When me and you take a trade, we risk maybe 500, $1,000, I don't know. When large hedge fund, those small amounts don't move the market. But institutions and hedge funds and banks, they enter large orders, and those large orders shifts the market, makes the people go, makes us as retail traders. I don't know, but we're trading retail. Follow the market, follow where the banks and institutions and the hedge funds want to take other people out. To my next point with liquidity. With liquidity attracts price. I want to draw this a bit. I don't want to talk too much. This is where liquidity lies. And this is what the banks and institutions want to do. They want to go up, take those people out, because there is nobody in the world that has a long position right here, because the market shifted to the other side. They are all sellers going to the other side. So I don't want to get too much into detail about this, but this is where the orders exist. And this is where the banks and institution wants to go to take out those orders. All right? So what is the role of brokers and liquidity? Brokers connect you to the market. So when you see the chart on TradingView, you're not connected. You need to have somebody somewhere to put your money in as a broker to connect yourself to the market, to have a broker connected to the market, because you just watching the chart and you're taking buys and sells. It's not going into the market. But when you have a broker that is connected to the market, you simply put money inside of the broker and simply take trades through that platform. And this is the platform that allows you to take longs and sell shorts. And this is explaining how liquidity works. When you enter with money inside the broker and you take a trade from a symbol with your choice, that's what moves the market. That's how the big banks and institutions move the market, because they enter through a broker, and that changes the direction of the market. And that creates liquidity also, because liquidity, the market would not function. And you see it during the holidays and during the times where people have red days in their calendar. There is nobody buying or selling, so there's not that much volatility or volume in the market, which makes the market have a steady curve and not be optimal for traders. So the market would not function without people entering buys and selling shorts. Right? So let's recap a bit. What a trade actually is. What is a trade? Buy and sell. We talked about that today in this lesson. Why price moves in the market and how this is affected through liquidity. And also how the role of brokers and liquidity is happening inside the market. So if I need to buy something, there has to be somebody on the other side selling something. So just a lesson check-in. What's your biggest takeaway from this lesson here? Just one sentence, it's enough, and please feel free to share it below. And as always, if you like this video, follow me on YouTube and Instagram. And if you haven't joined already, join the school community to learn more. So on YouTube, I put out videos that I just talk and share my perspective, and hopefully in the future, I don't know, do some vlogs. We'll see. All right. Thank you for watching this video, and see you on the next one. Hello and welcome to this lesson where I'll be talking about understanding risk before profit, why that is important. So I'm going to share 3 things with you today. I'm going to talk about why survival is more important than profits, why risk per trade, how it can be explained, and the danger of over-leveraging. So we've heard people over-risking, over-leveraging, and you can see people's losses, but they're still surviving in the market. How does that work? That's what I'm going to talk to you about today. So the metaphor I like to use is a professional poker player. You can see that if a professional has a good hand in his poker. He don't go directly all in with all his money. He has a pot with his chips, and he there's a balance between how much he's risking and what the cards he has is and what other players might do, right? There is always a possibility that somebody has a better hand than them. They can absolutely bluff it back and forth, but this is how a poker player plays. It's like playing a game. You don't want to be leveling up to level 50 and in one trade you blow all the progress you've made to level 2, right? You need to adjust your size. Like if you're at level 2, you risk 2%, then 1%, and then you gain 8 to 10%, and then you keep moving it up. Also, why survival is more important than profit. Trading is a long-term game. Successful traders really focus on consistency over time, not quick profits. Because when you see successful traders, they count their trades in a monthly basis, in a quarterly basis, in a yearly basis, because they can be unprofitable or break even 1 year, and the next year they can have double the amount of the profits that they should have made in year number 1. So when you count your trades, we count them in a series of trades because we know at the end of the month we are profitable. Because also in a yearly um, perspective, you can have 3 losing months, and the rest of the year you can have winning months. But some of them are scattered; they are not one after the other. They might be. So losses is part of trading. That's just something you should swallow. But you should know you should know that because you have a system, you have a strategy, at the end of the year you will be profitable. So survival allows you to improve. It really does. Because knowing that you might or there is a possibility at the end of the year you are still profitable, you stop doing the over leveraging and over risking and needing to gain that money directly. This is how you protect your account. You give yourself the opportunity to take the next trade. Risk per trade explained. So even every time you enter a trade, you should know, or you should write it on a piece of paper. I'm gonna risk $100 today. I'm willing to lose $100 today. I'm willing to lose $500 today. You should define your risk before you enter the trade on a piece of paper, on your risk calculator, on your position size calculator, or on TradingView. And when you do that, you're aware and you're mentally alert that you know that you will get into the market today when you see your setup and you accepted the risk from the very beginning, so you let the trade play out. And when you risk small, you will see. You will see when you risk small, you will follow your plan. You will stay disciplined. Your emotions are not that volatile, right? You don't have spikes up and down of your emotions, and like I wrote here, your that muscle grows. That it really does, because in the beginning, when you risk $100, you have so much emotions. You're stressing out. You have you're breathing heavily and all these things, and then when you start making 200 every time you trade, right? The new uh, the new barrier becomes 200 and then 500 and then 800. So when you're at 800 and you go back to trade $100, that $100 you don't even feel that emotion. That's a good mindset to have because that's true. Your body is affected by it. You're physically you're physically breathing differently after a while because we are always inadequate in the beginning. In the beginning, we don't know what's right, what's wrong, we're stressing out, and then when we level up, the thing in the beginning becomes so simple to us, becomes so silly, right? So risk reward. I'm going to explain risk reward here on TradingView. Let me just show you what risk reward is and how it works. So let me show you. This is the trade I'm currently in, and it took my took profit right here. This is a trade I took. So when I took this trade, you know what? I don't want to break down the trade. There are tools right here on TradingView called long and short positions, right? If you press on this, you can see that there's a risk-reward ratio saying number one. This means that I'm willing to risk one right here. I'm willing to risk one right here to gain how much? To gain one. The risk-reward ratio is one. So I'm risking one to gain one. You can do that, but you can also, to have it to gain the most amount of profit, you're risking one, but you're gaining three. You can see that? So when you see people putting these symbols or these um, colors on TradingView, this is what it means. I'm risking $1 to gain $3, 3.0.4. But let's make the math simple. Gaining $3. So if I'm risking $100, okay, I will gain 300 on this trade. This is how also risk management and thinking long term will help you, because you know when you lose three of these, you lost $300, right? But when you win one, you get back all the three losses that you had, not get. This is how risk reward is explained. So the danger of over leveraging. Leverage magnifies gains and losses. So we want our equity curve to be like this. Let me just explain it to you. We want our equity curve to be ideally like this, right? We have an equity curve. It goes like this. We make some profits, and then we have a bit of drawdown, and then we make some profits, and then we had a bit of drawdown, and then we make some profits, and we had little bit, and we make some profit. This is how we want it to work. But this is what happens usually. We make some profits, and then we lose, and then we can't control our emotions, and we lose everything, and we blow that account to zero. That's why I'm telling people, go over, prove it to yourself that you can make money and you can work the system good, so you don't end up losing money in this way. So the more you lose, like you risk $100, right? And you lost that $100, you say, oh no, you know what? I want to get back into the market. Let me risk $200 to gain back my first $100 and then to gain more. This is usually what happens when people over leverage. And then you go and lose that $200. What do you do next? You double that. Let me risk $400 so I can get back my 200 and then my 100 and then I can gain more. And this is just eating through your account. It destroys account. That's what over leveraging is. All right, that's my quick introduction to risking, over leveraging, and why losses is important in the market and why survival is more important than profits. This is the video explaining these things. Just do a short recap of what we talked about, why survival is more important than profits, risk per trade explained, and the danger of over leveraging. These are the things you should be cautious about, because when people enter trading directly with live funds, this is usually what happens because they can't stand the fact that they're losing, because you don't have an idea of it and how it works. So that's why we should use demo account to get started. That's why I recommend. So lesson check-in, take a moment to think about your biggest takeaway from this lesson. What was your biggest takeaway from this lesson? Just write it short in a sentence below. And I hope that you can follow me on social media, on YouTube, Instagram, and if you haven't done it already, join the school community. On YouTube, I share my perspective and videos a little bit outside of trading, but it's still trading related. Feel free to follow me on YouTube, Trading with Mustafa, and don't forget the H. See you on the next lesson. Have a good day. Welcome to this video where I'm going to share with you why most traders lose money in the market. I'm going to talk about three things today: overtrading and impatience. What does it mean? What is it? Trading without a trading plan. As a trader, you need a plan to follow on a consistent basis, and you need a plan to follow correctly. And last but not least, letting emotions control our decisions in the market, letting fear, FOMO, greed control our emotions. Those are the things I'm going to discuss in this video today. So I want you to think about it as A gambler. When a gambler, you hear the metaphor that is trading gambling. Does it really work? A gambler goes into the market without a plan, without something to follow. He just enters the market and he loses, and he don't want to lose again, so he enters again, and he gains some profit, and he feels the fear. I've lost this much, and I've gained this much. Let me take my profits, and he doesn't have a structure or a plan to what he's doing. This is what a gambler is. They and they want to take out as much profit as possible, and they have $1 or $2 until they take profit, and they say no, I want to take the maximum amount of profit, and it goes up, it goes down, and takes them out, and that makes them go into the market even more and even harder, and it's just chaos. That's chaos when when I see a gambler. That's how they do. Trading is not that. If you're trading that way, then you're a gambler. You're hoping for something. And the thing with gambling in trading, it's right next to it. Here is the plan where you follow to be a professional and a professional day trader. Let's keep it at that. And here's the way to gamble. It's right next to it. It's so easy to flip into the gambler mode. And we don't want to do that, right? So overtrading and impatience. Overtrading and impatience are two very important things in trading. You're taking too many trades. So many beginners trade constantly instead of waiting for a high quality setup. There's something we usually say, this is an A plus setup, this is a super setup, this is a diamond setup. We use these terms to define when the trade is perfectly aligned with all our confluences to be able to enter the trade. So many beginner traders, they trade 10 times, 20 times a day maybe, or a week. Professional day traders, they take like 10 trades a month. Do you think about that? You have London session and New York session, and like in a week, there are five, Monday to Friday, there are five trading days in the London session and five trading days in the New York session. So in a week, right? There are 10 trading moments that you can trade. And in a month, if a professional day trader takes 10 trades a month, like what is the beginner day trader doing? He's taking 50 trades a month. Like he enters without a plan. He is over trading. He's trading too much. And that impatience in the market leads to poor decision making because you don't know what you're waiting for. You need a setup, you need a strategy, you need something to follow. When that happens, before when I used to be very impatient, I screenshotted my strategy and I told myself when this appears, enter. When this doesn't appear, don't enter. And then I use that as a reference to be more patient. So this is what good traders do. They wait for a clean setup, and when they see a clean setup, they apply good risk to it and they execute in the market. This is what professional day traders understand, and this is it's like when talking to somebody who is not in like who's not waiting for the setup. It's almost so clear that it goes over people's heads. So why did you trade this way? It wasn't a part of your setup. I was impatient. I couldn't hold on to the trade. That's what we usually hear. A plan in trading is so important because if you don't have a plan, you're just entering the market in a random fashion. You don't know what you're waiting for. You don't know how much you can trade. You don't know how much you can risk. You don't know when to enter, when to exit, and how much profit you need to take. So let me just give you an example. Let me just draw like this. This is a market, right? If I have a trading plan, this is what my trading plan says. I'm here to take this trade right here, this trade right here to get 10 points, let's say 10 points, right? So many beginner traders say, but you missed the entire move right here. This move could have gotten you, I don't know, 1,000 points or 100 points, right? Compared to this one. I say yes, but this is not a part of my plan. This is not a part of my plan, so I'm not focused on that. It doesn't matter if it goes to 1 million. It doesn't matter because my plan is to take these trades over and over and over again because they are a part of my plan. Because whatever happens right here, it doesn't matter. It can might as well go down and take me out and take my risk. And this keeps us consistent because we have a plan that we follow on a daily basis, on a weekly basis, on a yearly basis. That is the main focus. That is the whole thing focused into one thing. You have to have a plan to execute. And this plan, I'm going to share with you my plan. I'm going to show you how you can create your plan to satisfy your needs and your goals so you can enter and exit and take profit in a correct manner and not go into the market just guessing. I want, uh, that's the thing, guessing. You see, let me just, where is it? Guessing, guessing what the market is going to do. Because if you enter the market this way, if you enter the market this way, the market goes like this, and you enter the market not knowing where to take profit. I'm going to enter right here and not knowing where to take profit. The emotions you get on this level is so huge, it's so volatile that it's not worth it. Just take your trade, take your profit right here in this area, and then leave the market. Go enjoy your life. That's basically it. And what do most traders do? They let their emotions control their decisions. Fear and greed and FOMO, those are all real emotions that affect us. Fear comes from the sense of security. The fear part of our brain, the amygdala, is the one that is there to protect us. When there's a lion coming to attack us, something threatening our lives, the fear and the amygdala gets activated, and it brings the emotion of fear forward. This is what causes many traders to they take the trade and they exit too early because they are fearing the loss, or they enter the trade and they have some profit and they exit the profit. They take $10 when they could have made $30. Because they say, oh, $10. Oh, I need to take those $10 and they exit the trade. I don't want to lose those $10. I can't stand the fact that I was in profit and then I lost. That's the fear creating that. And greed is the same thing. Not really the same thing, but greed can make you risk too much. That you see a perfect setup and you have this amount of money that you said in the beginning that I'm willing to lose 50 bucks, 100 bucks today. I'm willing to lose 100 bucks today. But when you see the setup, what do? You know what? This might give me 500 bucks, so let me risk more. Or let me risk my entire account. Or let me full port. Let me go all in on that amount. We can't do that. We have to stay disciplined, and that separates us for being a professional than being a gambler. And this is what gambling is. They wish for something greater to happen because they're not following the plan. We can't follow a random approach into trading. This is the nutshell of it all in trading. Trading is having a plan, having proper risk, and just following it over and over and over again. And when you've made it when it feels boring for you. When it feels boring, when trading feels boring and you're not reacting to the emotions that's happening, it feels so boring for you, that is when you've made it. Because trading shouldn't be exciting. That's fear and greed and excitement, the dopamine, all of these things happening inside of you when you trade. Those things should be at the minimal. Why? Because you are following your plan that you've been doing over and over and over again. This is how you can succeed in trading. So let's recap a bit. We talked about overtrading and impatience, why overtrading is dangerous and being impatient in the market is something that we all have different levels. My impatience is different than your impatience. Like I might be impatient with my kids, right? You might have a lot of patience with kids because you've been around kids your entire life. We also talked about the importance of having a trading plan. When you enter the market, you should have a plan. It's like a meal prep. Having a plan is like a meal prep. You meal prep your meals So when the time comes that you're feeling the emotions of I'm hungry, I want something to eat, I want sugar, you don't focus on that. You have a meal prep, you have meal preps. You just take out the box of food and then you eat it because that's what your plan said. And then letting emotions control decisions like fear and greed. Greed is misspelled right here, but that's fine. You know what I mean. All right, that's the recap of this video. I will it's better for you to do a lesson check-in. Why? Because it makes you learn these things not sitting passively. So take a moment to think about what's my what did I learn from this lesson today, and just write one sentence down in the comments section below. It doesn't need to be correct grammar. It just needs you to get activated into learning, because this is the way you learn. Oh, what did he say about this? Let me learn about these things. You don't need to write five, six other things. Just write, I learned that impatience is important in the market, and share that lesson below. All right, as always, follow me on YouTube, follow me on Instagram, and if you're not inside the school community, feel free to join. Follow me on YouTube. I make videos there on YouTube also where I talk about everything trading related, but not specifically inside the course. So join, follow, and see you on the next lesson. Have a good day. Welcome to this video, and in this video I'm going to share with you the trader's mindset from day one. So you should know what you're getting into, what mindset to have as a day trader. I'm going to share with you 3 things, but trading is a skill. It's not gambling. As people say, trading is a skill that can be learned. If you see somebody trading and making it work, then they have the skill of trading, right? So if they can do it, you can do it. I hear so many people having limiting beliefs around trading and gambling and gambling. Isn't trading, when people hear me say, oh, okay, when I tell people, what do you do for a living? I tell them, I trade. Okay, isn't trading gambling? That's the first thing that pops into their head. I'm like, I see where they're coming from, but trading is a skill that can be learned because if you can do it, somebody else can do it. Everybody can learn that skill of trading. Consistency beat big wins. I'm going to talk about consistency and how that's the key in trading. You don't need to have these large profits. You need to have these small, consistent wins over time. And last but not least, discipline is your real edge. Discipline is your real edge. And discipline is so important, and I'm going to share with you what it is. So, a professional athlete. We all have professional athletes maybe that we follow and that we enjoy watching, and some of us like basketball, football, or tennis, or golf. I don't know. But what does a professional athlete do? They read, they watch game tapes, they journal, they see their progress, they develop, they grow, they focus on what they eat, they focus on how they sleep, they focus on how they breathe, they focus on uh, their group of people. They focus on creating and building optimism inside their mind because they're handling losses over and over and over again. They're treating this profession as they do, soccer, tennis, golf, as a professional would. And when I hear people texting me and writing to me on social media, you can be profitable tomorrow by just changing your mindset, by just changing the way you see trading. Always ask yourself, what would a professional blank your name in trading do? What would Mustafa, a professional day trader, do in this scenario? When you enter a trade, when you see the charts and you're thinking, "Oh, I feel the FOMO, I feel the fear, I feel impatient in the market," just ask yourself, what would a professional day trader do in this scenario? What would put in the amount, what would a 25K a month day trader do in this scenario? Meaning your goal, and then act accordingly. Because that will change. This takes time, but that will change your habits and your behaviors over time. Trading is a skill. Like I said before, many compare trading to gambling. because you can't really take you can't really grab it, right? Everything is risky in life. If you buy a condo or an apartment building and you invest your money there, and maybe, that's a risk. You buy it, you fix it up, and there's nobody coming to rent the place because it's far away from the city, and yeah, I don't know. It's it's a week after that it gets flooded with water. That's a risk also. We don't know. Trading is the same way, but it requires learning and practice. It's a profession. You can't just enter trading and just hoping to gain uh, to gain the skill overnight, because we all have different levels of fear and greed and emotions that we need to work through to be a master at trading, master at the craft. And this is what trading successful traders do. They follow a structured approach. We use rules, we use strategies, we use risk management instead of guessing. We can't guess inside the market because you see me when I trade because I've been doing this for so long. Sometimes I enter trades without even like I just know because I've seen the pattern so many times. And sometimes even me, I need to stop myself. You know what? You're not following this. You're almost guessing right now. So step back, take a break. What are we doing? Do the checklist. Check it. So when you gamble requires luck, and trading relies on discipline. Luck is gambling, trading equals discipline. So professional day traders, they understand that over a long period of time, they will be probable, and they see it in a long time horizon. Because if you have trades like that, let me show you an example. You take a trade right here, you win this trade. You take a trade right here, you win this trade. And then what happens? You lose one and you lose two. And you're thinking, oh man, do I have the skill of trading? And then you lose a third one. And this is where most people get out of rails. Instead, they beat themselves up. But what happens? They win another time, and the last one they lose. Now you're probably thinking like this guy can't trade, right? Why? Because we have three uh, risk reward right here. So we risked one and we gained three. So three and three, that's six, and three, that's nine in total. That's 9% that you gain. And what did you risk here? You risk one, 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 and one. So 9 minus 4, what does it give you? It gives you a 5% gain. That is what you count at the end of the month. Even if there are losses, as long as we are following our system, we don't get to these emotions right here, and we focus on the wins at the end because we're thinking about it in a long-term horizon. We're not focused on just because I lost this trade, that is it, right? And the negative patterns in our mind start activating. I'm not good, I'm not. Stop it. Just take a break, watch on the long-term horizon. There's still 20 days, 20 trading days that you need to get through, right? That's the long-term horizon perspective, how you think. And it gets even clearer if you see it on a 1 year horizon or every 3 months, 3 months. You get a clear picture of your profit and loss in all these periods. Consistency beats big wins. I just explained to you the consistency that beats big wins, and I'm gonna do it again. You know, let me just if you have the market right here, market is going this direction right here. What do most people want to do? They want to enter right here, right? And they want to take the entire run right here to get the 1,000 or the 100. This is not what we want to do. We want to have one big trade does not create long-term success. These trades doesn't happen very often. What happens very often is taking one single winning trade over and over and over again. We want to focus on taking these trades over and over and over again. We gain small wins, 10, 10, 10, 10, which which builds up. It becomes a lot at the end. So those small consistent wins that I just showed you, those are the things that builds your confidence in your skill and the skill. It builds the skill and the confidence in your skill that you can go to the market and take out some wins. And over time, you will see that executions leads to steady improvement, like I wrote here. You improve yourself over and over and over again because those one to ones, those one to twos, you're risking one to gain one and then risking one to gain three. You will find a balance through that. You can't have it statically. Like I just when I enter the market, I just want a one to three. I'm going to risk one to gain three. It doesn't work. You have to have a plan and you have to see what the market is doing. So that's what professional day traders do. They focus not on the big win, because this is what I hear people say. Oh, it's news now. How can I capitalize on that? It's war and news. How can I capitalize on that? You don't capitalize. Does your plan fit the news and the wars? If it does, take the trade. If it doesn't, stay away from the market because it's too many emotions and too many new people entering the market, and it changes the market. So this is what I do. I judge my success based on following my plan, not my profit, because I know that the end of the month, I don't even look at my profit, to be honest with you. I close down the window. I don't want to see the profits. I don't care. I want to see that I'm following the plan. Discipline is your real edge. You hear people talking about what's your edge? What's your edge in the market? A discipline is what you should have as an edge. There is an edge, in your strategy, there's an edge in your psychology, and there's an edge in your discipline. Some people are more disciplined than other people, but discipline keeps you consistent because not every day we feel that strong and disciplined and we have that amazing willpower that we need in the market. It's not every day we have that, but we have the discipline to stick to the rules that we've set for ourselves. And if we follow the rules, it protects us from emotional decisions. Because the decisions, we can't rely on them, and we can't rely on motivation. Motivation is like taking a shower. Sometimes you feel good, sometimes you feel bad. You just listen to a song, or you drank your second cup of coffee, and your motivation is high. And this also made me think about the um, overconfidence. When we win a trade, we feel good, we have that dopamine, and then we enter the market and we risk more, and we think we're on top of the world, and this is where we gets broken down because we didn't follow the discipline needed to follow the plan that we needed. So this is what separates amateurs from professionals. Discipline is what separates between these two. Successful traders execute their strategy the same way every time. That is so spot on. Successful traders execute their strategy the same way every time. It's just like a professional. It's just like a professional. It's just like you have to treat this like a professional athlete is doing it. They are respecting the risk. They are respecting the plan. They are avoiding unnecessary decision making in the market, and they're executing their plan over and over and over again, and they show up for themselves. Because if you're not going to show up for yourself in this trading endeavor, who's going to do it for you? So this is what discipline is about in trading. Discipline is very important. So let's recap. In this lesson, I talked about three important ideas: that trading is a skill, it's not gambling. Consistency matters more than one big win. Consistency, small consistent win over time is more important than the big win that we want. And discipline is your real edge as a trader. This is what separates you from separates the beginners from professional day traders. And if you learn something from this lesson, please feel free to take a couple of seconds just to think about what did I learn in this lesson today that's going to stick with me. And if you write it down, it sticks with you even more. So just take one sentence and share it below in the comment section below. As always, follow me on YouTube, follow me on Instagram, and If you haven't done it already, join the school community. On YouTube, I share perspectives and ideas all regarding trading, and there are videos there that are not equipped or fit to just be inside a course. So feel free to follow me on YouTube and on Instagram, and I talk to you inside the community. See you on the next video. Have a good day. Hello and welcome to this video where I'm going to share with you the tools you need to trade. This is a technical step-by-step lesson. The goal is here to make it so you trade effortlessly. There are tools we need when we trade because we need to have a place to read the charts, which is TradingView. There are other charts platforms, but TradingView is the one I've been using for so long, so that's one I recommend to you. So you need to have a place where you can read the chart. You will also have a place where you can execute from the broker. So you read what you see in the chart and the symbol. What is gold doing right now? And if I want to enter the trade, I need to enter it through the broker, which is connected to the market. All right. So we need a place to read the chart, and we need a broker that's connected to the market where we enter and exit trades. And lastly is your trade workplace setup. Your trading workplace setup is just like your table or your computer desks and your keyboards and stuff like that in trading. So it shouldn't become something that you're getting stuck somewhere or you're thinking about the risk. I'm gonna give you all the things and all the templates and everything you need to have it as effortless as possible. So let's just focus on step number one right here. Why do we need these things? Think about it like a mechanic. A mechanic, to be able to know how to fix the car and to be able to fix the car, period, the mechanic need to have his tools to be able to fix the car. He needs to have a wrench, a hammer, the oil, I don't know, to be able to fix the car. And this is what we need as traders. We need a place to read the chart, and we need a broker to place our trades. And we need also some templates and settings that I will show you and share with you, so you don't need to have to think about it. And this took me a while to figure out, by the way, but I'm going to share it with you so you can start trading as quickly as possible without thinking about it. So the first trading platform that I want to show you is TradingView. So TradingView, they have different subscription levels. So the one I'm using is called Essential, right? So setting and billing, I don't know, where do we go? The products, pricing. Let's go to pricing. You need the essential to be able to read the market. You don't need all the other things. And I'm gonna show you why. So 12, let's say 13 pounds or 13 euros, what is it, a month? It's not much. I'm all about investing money into your education. That's important, and that's important that you do it as well. Why? Because the other day I went for dinner, or I went shopping. I went to buy some groceries, and my son the other day said, but Daddy, I want this car." Right? He wanted the car next to the candy, and they put the cars down next to the candy, and he said, "I want the car." There's a car with the candy inside of it. That car and candy costs 15 bucks. One toy, and he has a million of them. Do you see what I mean? So invest in and doing and paying this sorry, paying this amount every single month to get you to the like a dreamy level in trading. Invest money into this. Like I get so annoyed. I had one friend he's, yeah, I want to learn trading. I want to learn this thing. I said to him, okay, you know what? Do this, and do this. I showed him all the steps, and I follow up after a while, and I checked. How's it going with you? He didn't even sign up. He said 13 bucks. 13 bucks is a lot. I said okay. Then okay, it's a lot. If 13 bucks is a lot, how would you expect to make more money? You have to be able to invest in your ability. I put a link down below. And this is, let me be transparent with you. This is an affiliate link. I get a small commission from that affiliate link but it doesn't affect you at all. It just supports the community, it supports the channel, it supports what I'm doing. So the money I'm getting from the affiliate, I'm reinvesting it into prizes to the community, into building the community, into hiring developers and hiring people so we can grow even more. That's why I put the affiliate link. All right. So when you get TradingView, it will look like this. Let me just open up a chart. It will look like this. So when you have the free version of TradingView, you have maybe 1 hour and 1 day only. We need to have 1 minute, 5 minutes, 15, and 1 hour. We need to have these because these are essential for our trading. Because this is how we trade. And here in TradingView, this is what it looks like. You can change the color of it, you can change the settings of it, you can put drawings on it, and this is where we do our technical analysis. All right. So after you've downloaded the TradingView and you logged in, feel free to play around with it. Feel free to play around with it, get familiar with the platform, and draw, watch the chart, see what it does. And if you want to search for something, just search. Let's say gold. I want to search for gold. What is gold doing right now in wartime? So you're searching for gold, you're seeing what the gold is doing. And you're seeing what the gold is doing on a 1 minute, 5 minutes, 15. You can just choose a time frame of your choice. All right, so just play around with it and give it a try, and I hope to see you in another video. And before you leave, don't forget to follow me on YouTube or follow me on Instagram, and if you haven't done it already, join the school community. See you on the next video. In this video, I'm going to show you how to get the broker downloaded. Broker is the one connected to the market. So you have a chart where you see charts on TradingView, and then when you see a setup, you have to take the trade through the broker. You can also connect the broker to your TradingView so you don't have two different platforms. So today I'm going to show you how to download the broker and how to set up a demo account so you can just try out buying and selling with demo money, with paper money. All right. So the broker I'm using right here is VT Markets. This is an affiliate link. I'm going to be honest and transparent with you. The profit we get from this affiliate link doesn't cost you anything, and it just helps the community grow even more. So the profits I'm getting from the affiliate link, I'm going to reinvest it inside the community to win prizes, to help you out, to buy funded challenges for you, so we can all grow together. All right, now I got that out of the way. If you press the link I put in the description, you will jump to this site right here. You just create a login, you log in, and we need to do two things basically. We need to open up a demo account. If you go to demo accounts right here on the right side and you press on MT5 and you press on open demo account. So you want to open up a demo account on MT5 because it's more modern and it's easier to read what's happening in the market over there. You want to press on standard STP account. You can have what currency you want. I usually go with USD, and you can have a 1 to 100 leverage. It doesn't matter. You can just pick which one you want. And then let's say we want a 100K demo account to trade with, to try out with, right? You submit it, demo account configured. They're sent you an email for the logins. So you don't need to check the email right now. The thing you want to do is be on the website, keep it right here, and then we press on downloads because we need the broker downloaded to our computer. We press on MT5, this is the one we need. We download MT5 and we get it for our Windows. So I'm going to download it and show you the exact step step by step. Do you want to download MT5? I press yes. You probably didn't see it, but here it is. I'm going to download MT5. Take some time, but it's fine. Just follow along, follow these steps, so you don't need to think about how to set up and how to do these things. All right, we just close this down, and we see that we have MT5 downloaded right now, or it just pops up. It just pops up. This is the first window that we are getting. We press next because this is VT market, and we open up an existing. We have an existing demo account. So we press we insert the login and the password that we got in our email. So what do? We jump to our email that is connected to the VT market, and this is what it gives me. Let me just screenshot this so I can show you what it's. This is the login that you need to copy and paste, and this is the password that you need to copy and paste, and you set the server to VT Market Demo. I just want you to notice this is a demo account. This is not real money. All right? So you take this information. So I take the MT5 login. I insert it right here. I need to press this. I insert it right here, and then I open up the email again, and I copy the password, and I insert the password right here, and I'll be sure if I'm using the same server, VT Markets Demo. I'm using the correct server. You can see there's a lot of service right here. I press OK.
Incoming mail.
And this is what happens. You can hear the sound maybe. And this is how it looks like. This is how the broker looks like. And this is how you can take the trade. And if you press on trade right here, this is the amount. So you have 100K USD inside of your trading amount. So this is the markets GBP USD. You have USD JPY. And this is how you can do it. All right, this is what it looks like, and this is now you can take a trade using this. So if you just open these up, you can press on these buttons right here. See, this is so confusing. I'll go trade. You can see the trades volume right here. You can see, you know what, that's it. On the next video, I'm going to share with you how to set up the position size calculator, and here you can just play around with it. Zoom in, zoom out, see, get to know it, get to know the software. I'm going to show you how to download a position size calculator connected to VT Market so you can take trades easier. You will see lines where you enter and exit trades that looks almost identical to this. All right. So when you see this in the chart as trading view, you jump over to the broker and you take the trade from there. All right. So get familiar with the platform, take a trade, buy and sell if you can manage it. And you can see the amount right here going up and down. You can see how much you're making, how much you're losing. That is fine. Nothing's gonna happen. It's just a way for you to what is this? Depth of market. Let me just figure this out for you here. It doesn't matter. We're not gonna use it. So play around with it, watch the chart, get familiar with the platform, and play around with the symbol. So as always, if you like this video, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. And in my YouTube channel, I share perspectives and insights about different things, but related to trading. So follow me there. Everything I shared to you today, the link is in bio. The link is in the description. Sorry about that. See you on the next video. All right, so in this video, I'm going to explain to you your trading workspace setup. I'm going to help you set everything up because to make it easy for you to take a trade. So we need these three things. We need a template, we need a position size calculator, we need to download a position size calculator, and we need the risk reward settings for our broker. All right, so we're inside the broker right now. Before we do all of that, we need to download the template on MT5. So the template we need on MT5 is called default. Let me just, this is going to be a technically, I'm going to insert it here so I don't forget to upload it to you. So this is the default that we're going to use. I have my son out there crying, but it's fine. So this is what we're gonna do. You know, I'm gonna change this to English so we can see the same settings. Just give me one moment. So yeah, this takes time, but you need to just do it once, and you don't need to do it again. All right, here we go. So file. First of all, take the template, press right click on the chart, press on the template right here, and load the template. And when you load the template, you should find the template that I just uploaded to you right here. And the name of the template needs to be default. Why? Because every time you open up a new chart, it will show the same settings. So when you open it, it changes to this right here because it looks cleaner, right? It looks so much cleaner right here. And you need to press these buttons right here so you don't need to have it all dragged all the way right to this area right here. So you have to drag it to this area right here. So you can choose the 1 minute, you can choose the 5 minute, 15 minute, it doesn't matter. You can also draw, you can scroll in and out. You can also draw with the tools you have right here. Now, that was the first thing. The second thing is the position size calculator. We need to be able to count the risk properly. So what do? We download the position size calculator. I need to download it. Now, when I have it downloaded, what do? I open it up on downloads in this area. I double click. I'm sharing with you everything right here. I double click. I found the position size calculator. I copied. I copy to clipboard. I copy it and I go to VT Markets. I go to File. I go to Open Data folder, and this folder opens up, and I go to MQL5, and I go to Experts. Then I go to Examples. No, I go to Experts, and this is what I paste in what I copied from the position size calculator. I copied this inside this folder inside the MQL5. All right, minimize this. So I jump back to VT Market. I press on Tools. I tend to press on MetaQuotes Language Editor, and this is what opens up. And I go to Experts, where I inserted the folder. I go to Position Sizer, and I go to the one called MQ5. This is the only one I want to run. So I double click on that, and what do? I press on Compile. And you can see the generating the code that we need for it to create the position size calculator. It takes some time a bit. No warnings, no errors. Great, we can just close this down. And here you can just see the accounts. This changed right now. I didn't know why it changed. You can see the accounts, and in the accounts you see the indicator. You want to open up the indicator right here, and you want to open up the no, sorry, the expert advisor, not indicator, expert advisor, and you want to press on position size calculator, and this is where you double click it. When you double click it, you should just write OK, and you see it under your account, and this is when you load the other file, the PSC risk reward pre preset, so you can have it on inside your position size calculator. And this is all getting so technical, but just follow along these steps and you will get it. So in downloads, I have a preset that I set for my trades right here, but it doesn't open. I don't know why it doesn't open. I'm going to close it down, open it again. There we go. See, I closed it down and open it again, and this is what we wanted. This is what we wanted, a position size calculator. A position size calculator is how you can set up your risk properly. So it moves based on what you set as risk. So you don't need to think about where to set up as risk. So after you've done that, after you let me double check position size calculator, the default. After you've done that, this is how you can trade the market. Now we have the symbols not opening up. Let me just see. The symbols is over here. What symbol do you want to trade? So the one you should use, or you can use, DAX or DE40 or 30, or the Germany. This is it. The Germany 40 is the one. The window, let's see here. Okay. Anyway, this is the one I wanted to focus on. When you open up a chart, you have one, you have two, right here. I want to know how this is so confusing. I can have them preset. Okay, got it. There you go. The Germany 40. Okay, the Germany 40 is the one that we're using, and we're double tapping on the indicator for us to use the position size calculator in Germany 40. So I need to close this down, unfortunately, and then open it up again. There we go. Germany 40, and this is what we trade on a daily basis. So I don't want it to be the entirely all the way right here. So I press on this button right here. The brokers that we are using are not very user friendly, but you get used to it very quickly. So this is what you do. So, okay, so let's say you want to take a trade, you press Control Shift. I want to take a short. I press Control Shift, you hear the tsh sound. And now it just risked, you can see risk 1%, it risked $1,000. This is demo money just to try this out. All right, so feel free to take the trade, take the risk, see what happens, buy, sell. You buy and sell with Control Shift. All right, you might not see it, but you see it right here in this area right here. And if you want to close the trade, so see, I closed the trade right here just to show you. Let me do this instead. See, I want to close the trade. Oh, and I closed the trade, and what happened? I just made 50 bucks, 57 bucks. And this is how you can try it out. You can see where I entered the short and when I exited the short. You can see that it's a sell position. So just play around with it, have it work for you. A lesson check-in. Now you've downloaded TradingView, you've downloaded the broker, you have everything set up. Lesson check-in. Did you get everything set up for trading? Just write one sentence and comment in the comment section below what you had struggled with so I know when I get feedback for the next video. As always, if you like this video, follow me on YouTube where I make different kind of content regarding to trading, but it doesn't fit inside the course. Also on Instagram, follow me there, and if you haven't done it already, follow the school community, or join the school community rather. Talk to you in the next video. Have a great day. Welcome to this video, and in this video I'm going to show you how to set up your chart. We use the chart software TradingView to basically do the technical analysis we need to do inside the market. So in this video I'm going to share with you what choosing the right symbols and timeframes on TradingView, how you choose them, how you set the correct time frames to know the direction of the symbols that you're using. Symbols meaning pairs. Pairs meaning the names of the stock or the index or the indices or the crypto that you're using. I'm going to show you all of this now. I'm also going to show you how to keep your charts clean and simple. You've seen all these people, they have so many instruments, so many indicators that are showing them where the market is going up or down or bearish or bullish. And I'm going to also show you to mark out important price levels, which you need in a daily basis. We're just going to keep it clean and simple as I do. This is exactly how I do on a daily basis. So I'm using the metaphor as a pilot cockpit. So have you seen the pilot cockpit before? It looks like there are so many instruments, but for the pilot running or flying the airplane, it's clear and precise and structured to him. Why? Because he set everything into simplicity so he can just focus on the main goal, which is flying the plane. And this is what I want to do with you regarding TradingView. So if I jump directly to TradingView, I'm going to just show you how it looks like. So this is how I do. I trade the DAX Germany 40. It's called Germany 40. It's called the DAX. And I trade the US Tech. US Tech is the NASDAQ. You see here? The US Tech is the NASDAQ. US Tech. The NASDAQ have the 100 biggest technology companies in the US inside of it. So that's the NASDAQ, the US Tech 100. And the Germany has the 40 largest companies in it, the Germany 40. So these are the ones I trade, and these are the ones I trade on a daily basis, London session and New York session. Right? So when I come to the chart, when I come to TradingView, I want my chart to be clean and simple. I don't want it to have, I don't want to be confused when I enter the market, right? I want to be able to see the chart clean like this is now. The only indicator I use is this indicator right here. If I it the only thing it does, you can just mark it out yourself. The only thing it does is it marks out the Asia session. So when I draw, I usually start drawing from the Asia session to market pre-market open or sometime before that. So I can draw the overnight range, right? So this is the indicator I use. If I double tap on it, this is the name of the indicator is ICT everything. You can find it by pressing on indicators and write ICT everything and you press on it. And then when you press on it, you get so much settings and this is what I want you, if you want, to use. Just copy all of this, screenshot it, so you can have the same settings that I have. I'm just taking it slow so you can have time to pause the video. Style, this is what I have in style. And visibility, this is what I have in visibility. All right, and this is what shows up. This is the area where market opened on Monday morning. So I don't want to get into too much detail. The thing I want to mark out when I come to the market is the pre-session open, London session at 8 o'clock and pre-session open at 9 o'clock. London session in my time frame, UTC plus 1, my time zone, opens up at 9 o'clock. So where I live, London session opens up at 9 o'clock. Maybe it's different to where you live. So you need to check, you Google it. Google it. What time does London session open in my UTC plus 4? And then you mark that out as a London session open. And you can see the same thing I'm doing with um, with New York session open. New York session open now. So I mark out the New York session open. It's different now because this is it's 2:30 right now. Summer it's usually 15:30, 3:30. Why? Because it's summertime soon. It's going to be summertime soon. So the usual ones I need you to focus on is to have mark out the pre-session open 8 o'clock and then 9 o'clock and then 4:30 and then 3:30. This is what you're going to be working on a daily basis. And you can just see how many of these I've marked out. right? And right here, you see that I have drawings right here. These are the main tools that I use on a daily basis. So how do I put them and have them sticking up there? You just go to these areas right here. You press this arrow, and you basically just mark it out as a add favorite, and use the one that you're using. And then you can just adjust them and shift where you want them. Also, regarding time frames, so the time frames we're using, it's usually on a 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, and monthly. So on a daily basis, this is the only thing I'm looking at. I'm looking at these 4, 1, 15, 5, and 1 minute. Higher time frames hold higher power. We check the higher time frames because we need to know where the direction of the market is going, right? And then we take the trade on the lower time frames. You can check on the higher time frames, weekly and monthly, and take trades on the 4 hour and a daily. So we check the direction of the market by checking the 1 hour and the 4 hour, mostly the 1 hour. And then we take a trade out of the 1 minute or the 5 minute. I usually take a trade on the 15 minute and on the 1 minute. These are my top two. 1 and 5. And this is how I set them up. I press on this arrow right here, and I press on the star on the 1 minute, star on the 5 minute, 15, because I don't need all of these 2, 3, 4, 5 minutes, 45 minutes. I don't need all of these. All right. Um, let's see, did I miss something right here? All right. How do you find the symbol? So you see that I have these two symbols right here. I just write, like I just press my mouse on the chart right here, and I just write. I want to know what gold is doing, right? So I write gold, or gold is also called XAU. But let's like write gold to make it simple. So gold is also called XAU USD. Gold. That's the symbol, ticket symbol, the pair. That's what they call the pair, the ticket, um, the ticker, not the ticket, the ticker, the symbol, the pair. These all are definitions of this, the name of the symbol. So I press gold. I'm seeing what gold is doing, right? So if I wanted to trade gold, I just press Alt. If I'm on Windows, I press Alt and then W. What happens? It saves it right here. Now I don't want to save it because I don't want to keep my chart clean. All right. That's how you save the chart. So now here in TradingView, you can also do replay. You can do replay if you have the essential version of TradingView. If you press on the replay, you can go back in time. You can go back in time and test your strategy. This is how this is what we use to backtest the strategy. And you can also like test it out like this. Oh wow, I think this is going bearish. This is going down. The market is going down. So what do? We take a trade. We try it out. We take a stop loss right here. We take a trade. Let's see what happens because I believe it's going down. So we fast forward. Oh, it didn't work. And this is how we can backtest our strategy so we can see if it fits our model, fits our time, fits how the way we want to trade. So this is how TradingView can be used. I don't want to miss something in this video. I just want to, let me just double check. Different time series or different perspective, user high time frames to understand higher direction. I marked that, I marked that. All right, keeping chart clean. London session. Yes, that's basically it. That's basically it with TradingView. Play around with it. And this is how you can backtest your strategy with the replay. This is how you can also set alerts because some people, when you have, you know, this is a key level. I just add alert to it. I press Alt and Command. Oh, right. It's in replay mode, so it doesn't allow you to put an alert. So I press Alt and Command. I press an alert, I download the TradingView application to my phone, and I also have it set to my email to give me signals to my email. So usually when people work a 9 to 5, they don't have a time to stare at the chart as we do right here. So what do? We mark out this area right here. So when price action hits this area, what does this area do? It gives us an alarm, and this is when we can sit next to the chart and take the trade. So that's a good thing to know. You can see that this is an alarm created right here. All right, let's recap a bit. So now you should be understanding or have knowledge about how to set up your chart. You should choose the symbols and time frames you know works for you, or that you should try out and test out, because the strategy I'm using, the strategy I'm going to teach you, works best on DAX and NASDAQ, London session, New York session. I'm going to share it with you, in a document, hopefully, so you can try it out yourself and see what works and what doesn't work. You can also try different symbols, because maybe you like some uh, uh, slower symbols or faster symbols. It's up to you. You can take the strategy and test it out on different symbols to see what works for you. So this is how I keep my charts clean. And the most important sessions levels to mark out is the London session and New York session, because these are the times where we want to trade. We want to trade when London session opens, and we want to trade like max 2 hours. This is where we want to trade. Max 2 hours after London session opens. That is about it. All right. Lesson check-in. What's your biggest takeaway from this lesson? Just one sentence. What did you set up your chart? Did you set up your trading view? Was this understandable? If it was, feel free to just write one sentence. One sentence is enough in the comment section below, because you will learn, not learning passively. You will learn actively, because we're activating our brains to do something, to dig something out that we learned in this lesson right here. As always, follow me on YouTube, follow me on Instagram, and join the school community if you haven't done it before. All right? See you on the next video, and have a good one. Welcome to this introduction video of module number 2. So you finished module number 1, where we talk about the foundation of the tools we need and have everything set up and understand the basics of trading. In this second module, we will understand how to read the market. That's what you should expect after finishing this module. You will be able to read the market confidently. So in this module, I will explain to you three things. The roadmap, where we are in the roadmap right now, where you are in the roadmap right now, what this module will help you understand, and what this means for you, why you should finish this module, and what you will get at the end of it. So the four-stage roadmap in trading. We set up everything in the foundation part. This is step number 1. Step number 2 is where we are right now. We have to create the tools that we need to read the market. Using the metaphor of a house, and in this first foundations, we set everything up. We counted all the bricks and all the screws and all the saws we need to get everything set up so we can start reading the market. So in reading the market, this is where, if you imagine yourself sitting in a house, this is where the electricity is put in. This is where the walls is put in. This is where the windows of the house is put in to be able to see the structure of the house. Not yet live in it, just to see the structure and see and read the house from outside in, basically. Have you not seen a building of like a house? They are setting up the walls of the house, and you can see that this is going to become a house. So we are on the second stage right now, and this stage is called reading the market. What this module will help you understand. This module will give you confidence in how to read the market, how to read the charts, how to read the candles, how to understand market structure, and you will understand how price moves. You will understand at the end of this video where Bitcoin is going in about 2 weeks, 3 weeks, because you will understand market structure, breakout structure, fair value gaps. You will have an understanding of where the market is moving. So my expectations for you is to give you the ability the ability to read the market through your own technical analysis. I'm giving you the tools so you can read and understand the market from your perspective. What does this mean for you? The market at the end of this module, where you go through all the lessons, you will start to make trading will start to make sense to you. Reading the charts will start to make sense to you, and you will stop guessing and you will start understanding. This will give you enormous confidence in your ability to trade, to take a trade. I'm just giving you a heads up. You will sometimes guess where the market is going because of the technical analysis you will learn in this module, but I'm here to tell you, don't go over to live, don't put any money in, just do all of this on a demo account still that you created on the foundation part, in the foundation part of this four-stage trading roadmap. So, so take it easy, relax. Don't don't you lose your money yet, right? You can lose your money through proper risk management later on, but not yet. You're still new to the game. So let's recap a bit. I've talked about a little bit about the fourth stage, the second stage in the roadmap, and where we are in the four stages of the roadmap, what this module will help you understand, and a little bit of what you can expect when finishing the entire lessons of this module. So as always, do a lesson check-in. Just check in, where are you right now in your trading journey? Have you finished the foundation part where you have everything set up so you can start reading the market and the charts easily? If you haven't done it already, finish that step because this step will make it just more harder for you. As always, follow me on YouTube, follow me on Instagram, and if you have not signed up to my school community yet, this is all for free. Feel free to join. I give you spreadsheets, Excel sheets, journal software that you can use in for free so you can improve your trading. All right, that's it for this introduction video, and see you on the next lesson. Have a good day. Hello and welcome to this video. In this video, I'm going to talk to you about how to read a chart. This is where we take it more seriously, how to read a chart. And in this video, I'm going to talk about three things. What candles represent. You've seen the green and you've seen the red candles. I'm going to talk about what they represent. I'm going to talk about what the green and red candles mean. What do they mean? When the candle is green, when the candle is red, what do they mean, and what do they represent? Buyers or sellers? What does those things mean? Excuse me. And also observing instead of predicting. Because when we predict the market, this is when we make mistakes. All right. So I'm just using a metaphor as a heartbeat monitor. When you've been to the hospital and you see someone connected a heartbeat monitor to the patient, you've seen the spikes up and down as what's happening right now with their heartbeat right now, live. We're not predicting it. We're seeing a chart of what is happening right now. The same thing goes with the market. We're just seeing what we're basically seeing people, behavior, psychology when we see the market, when we see the candles. We're seeing people buying, we're seeing people selling, and we are seeing it in the live market just like our heartbeat when we go to the hospital. All right. So I'm basically I can discuss all of these things, but I'm gonna jump into trading view and explain to you what those mean. So the first step is, what does the candles represent? So each candle represents price movement. So you have these different candles. You have the red candles, right? And you have the blue candles right here, right? This is a visualization of what's happening in the market. The red candles meaning that there are sellers going hard. There are sellers selling their positions. When the sellers are selling their positions, it creates this candle. It creates a bearish candle. There is bearish and there is bullish. Bearish going down, bullish going up. I'm just gonna explain bearish and bullish because we hear it so much um, when we trade. So I just want you to visualize a bull. The bull attacks. When the bull attacks, it attacks bull up. So when people say the market is bullish, you think about when the bull is attacking. The market is bullish, so the bull attacks up, meaning the market is bullish. The bear attacks with its claws down. So when the people say the market is bearish, they mean that the market is attacking down. The market is bearish. So when I say that this candle is bearish, meaning red candle, it the metaphor is how does the bear attack? They attack down. The same thing with bullish. The the bull attacks up. So this candle meaning that there are buyers. There are people buying a lot, which indicates that the market is going up. And mind you, there is nobody in the entire world that has positions all uh, going long right here. Why? Because there's no candle on this area right here. So every candle you see here conveys information. When the market opens, when the market closes, when did the majority of the buyers or sellers enter? Did they enter here? This is where the buyers entered. There are buyers entered right here, and there are more buyers pushing in right now because it creates these kind of candles, right? And you can see that this candle is smaller, this candle is bigger because there are less buyers right here. But this is what moves the market. Short candle right here, bearish candle, red candle right here. This is where the move where you can see just simple explanation. There are buyers right here buying, and there are more buyers right here buying, which creates this red, blue candle or green candle, and the market trying to take them out right here. So what does the market continue to do? No, we're not taking because there are people selling right here because they thought the market is going down and they put their stops all the way up here. So what does the market do? They continue up to take the money from the people putting their stops right here. And what does the market do? All the people that said that this is going up, they put their stop all the way down here. What did the market do? The market reversed again and took those out again. And this is how the market works. This is how the candles work on a daily basis. They take people out, they take their money, and they take other people out that thought that they were going up. So when we look at this chart, we see green candles, we see red candles, and it can be a bit confusing. But if you zoom into this, every candle has some information. Every candle, as I explained before, has some information. We know the color of the candle is important because this is what we're gonna use later on to dictate where price is moving. So when we come to the market and we see candles looking like this, right? We don't predict anything. It's like the heart monitor. We don't predict where the market is going. We don't predict this is a trade I took today. We don't predict where the market is going. We just observe what is happening. I'm observing my trade I took today based on the candles that I was reading, how the candles reacted to one another, and the structure and the strategy I've been using for so long that tells me where the highest probability of the market going today. And when I know that the highest probability of the market going bearish today, going down today, then I insert some money and I risk properly and I see the market going down. It's not always that that is happening, but the highest probability of it happening happened. So the charts that I'm seeing, the candles that I'm seeing is giving me information. And this is what our job is. We are waiting for the information. And that is one of the hardest parts as being a day trader is to wait for a correct information to happen before we enter and exit the trade. Our job is to understand it, not predict it. We have to understand where the market is going, not predict it. Because if we predict, we speculate and we guess, and this is when it turns into gambling, and this is where people say this is gambling because we basically are gambling because we are predicting something not showing us in the market. We can't find, like, just let me give you an example. This is how we define a breakup structure. This this is how we define a breakup structure. The body of the candle has to be closed underneath the body of the candle right here for it to indicate that we are going down. It didn't happen right here. It didn't happen right here. It didn't happen right here. It happened right here, but it didn't give us a fair value gap. I don't want to get into much detail, but it didn't happen basically. And it didn't look like it was going down based on the candles based on the candles that I'm seeing. This gave me an indication that the candles or the market, the sellers are dominant in this area. So that's why I took this trade and I took some money and I risked properly and I also indicated where the market highest, the highest probability of the market was going to this areas where I take my profits. All right, just let me just recap a bit. I talked about in this lesson what candles represent, what the red candles represent and what the green candles represent, and what we ought to think about when we enter the market and see the candles. We're not predicting the price, we're just observing. And when our strategy, eventually, when we learn our strategy appears, that is when we enter. So what the candles represent, what green and red candles mean, and we are here to just be observers of the market instead of predictors of the market. So a short lesson check-in. What made candles clearer for you in this lesson? Just write one sentence below and share it so you can make it stick with you even more. And as always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, follow me on my school community. Thank you for following through on this lesson and see you on the next one. Have a good day. Hello and welcome to this video where I'm going to talk to you about market structure and explain it to you in a simple manner so you will understand it. In this video, I'm going to talk about three things: higher highs and higher lows, uptrend. What does those mean? Lower highs and lower lows, downtrend. What does those mean? A short explanation and a drawing on TradingView on how you should and you could understand it. And at the end, structure reveals market direction and how you can use it to basically see the structure of the market on where the market is going. So I'm gonna use the metaphor of a staircase. When you go up on a staircase, you see that every stair has its highs and its lows. Highs, or plateau, highs and plateau. The same thing goes with the market. So every high has a low, and every low has a high. You've seen these drawings of people doing the higher highs, higher lows, higher highs. This is basically the zigzag effect of the market. These are highs right here, and these are the lows of the highs right here. This is when the trend is bullish. The trend is going up, the trend is bullish. When the trend is going down, it looks like this, right? And you can see the structure of the market. You can see that these are created right here. They are lower highs because we are on the bearish trend. We are on this way of moving in the market. These are lower highs, and these are lower lows. So higher highs, higher lows, and lower highs and lower lows. And if you look at the market structure of these, this is showing you the market trend of the market. This is what we indicate the trend of the market going. Let me show you an example of how the market reacted today, right? I traded today. So if we go to the higher time frame, and this is what usually what happens. We are in the We are in a bearish trend. How do I know this? Because the market created, I'm going to draw this, there's higher highs right here and higher lows. Higher highs, higher lows. Now, why am I saying higher highs, higher lows? Because sorry, not higher highs, higher lows. Um, Lower highs and lower lows. There are lower highs and lower lows because we are on a bearish trend like this. So what usually happens, think about it as a staircase going down or a staircase going up. In this scenario, there's a staircase going down. So lower lows and lower highs and lower lows and lower highs and lower lows. And before market opens, what can we expect it to happen? The market usually creates a lower high and then continues down lower lows, and this is the area here, exactly right here, where we want to take a trade and we want to make some money. We don't want to take this entire move down, right? We're only focused on taking a small percentage from the market consistently by using the higher highs and higher lows and lower highs and lower lows. So this is a bearish trend. Let me show you a bullish trend where we can say higher highs, higher lows. So in this scenario right here, right? This was a bearish. It created higher lows and lower highs and lower lows and lower highs and lower lows and just continued down. And what happened right here in this area, you can see that it broke structure. It broke structure to the opposite direction. When it breaks structure to the opposite direction, it changes. It creates a new higher high and a higher low and a higher high and then a higher low. And because the market has a bearish, sorry, it's shifted from a bearish trend to a bullish trend. Apologies of the confusion of the bearish and bullish. But you get the point. And this is how you can start seeing the market structure. I'm just going to use another example so you can see it more clearly and you can start drawing it on your charts. Don't, this is what not to do. You know, when people do this, higher high, higher low, higher high, higher low, higher high, higher, it doesn't work that way. Every candle that has a low, every candle that has a low like this, a low like this, there's a high right here because it's two candles. Two candles creates highs, two candles creates lows. So in each candle, there's a low right here and there's a high right here. And this is how you do it. There is a low right here. There is a high right here. And there is a low right here. And there is a high right here. It doesn't need to be exactly like this, but you get the point. It can be in this manner, as long as the direction is bearish or bullish. And this is the low right here, because if you use this right here to this area, you've missed the correct direction of the market, because this is where the market maybe can turn to the upside. So what you want to do is you want to mark out the lows and the highs always, and that's how you define the structure of the market. This, if you do this on a continual basis, you will start to see the pattern of the market. The price and the candles will start to show you where the market is going. But the direction comes first. This is where we use, if you think about it as a triangle, the market structure is the base of the, this is why people say the trend is king, right? Trend is king. Because the trend is the direction of the market. If the trend is bearish, and the higher time frames is showing you bearish, what is the market more likely, where is the market more likely to go? To a bearish direction. That is why they say trend is king. The market structure is a way for us to define the trend. And this is how we do it. We follow what price is doing, basically. All right, I just explain to you some things about market structure, how you can understand it. I explained to you higher highs and higher lows and lower highs and lower lows and how they work in an uptrend and in a downtrend. Also explained to you structure and how it reveals the direction of the market and why trend is king. And if you use market structure, or if you read market structure on a higher time frame, this is where you know the trend of the market. This is where you know where Bitcoin is going in the next 2 weeks, because you're going outside of the higher time frames. Higher time frames hold higher power. All right, just a short lesson check-in. What made market structure clearer for you in this lesson? Did did market structure become clearer for you in this lesson? Just write one sentence, that is enough, so you don't sit passively and learn, because you active learning makes you memorize the things that you've learned even more. So as always, follow me on YouTube, follow me on Instagram, and join my school community, and I hope to talk to you more there. Have a good day. See you on the next lesson. Welcome to this lesson, and in this lesson I'm gonna explain to you liquidity and how it works in the market and what it is. And I'm going to talk about three things: what liquidity is in the market, where liquidity is found, and why price moves towards liquidity. And at the end of this lesson, I promise you, when you start seeing the charts after this, it will make so much more sense to you. So, there's a whale and there is fishes, right? Me and you, when we trade, the amount we are using when we trade, it's so small compared to the whales, right? The whales, that's a metaphor for the banks and institutions and the hedge funds where, that wants to take out our money, the fishes, right? And so where does the whales usually flock to? Where all the people are putting the majority of their orders in. So where the majority of the orders are underneath the liquidity. So the whales and banks and institutions want to chase liquidity, the small fishes, the orders where we put our stop losses, so they can eat, so they can get their money. So in this video, I'm gonna give you some perspective of how to find liquidity, where to find it, what liquidity is in the market, and I'm gonna give you a perspective that will shift the direction of your trading. So every day there's a high and there's a low created in the market, right? So just let me just show you an example of how this works. So in this example, there's a high created, right? There's a low created, and this low is bound to be taken out because that is how the market works. When people when people take a trade right here, they usually put their stop loss underneath this area. If their stop loss is not being taken out, they're still inside of the market. And where are all the orders of people entering a buy position right here? Underneath the liquidity, underneath the stop loss right here. So this is the areas where most people have put their stop loss under. And where does the big whales or the banks and institutions want to go? They want to go and take those people out because that is how they get paid. The banks and institutions want to take us out so they can get paid. That is why the whole thing of trading is that we want to think like the banks and institutions so we can take a small profit of what they are taking. So if you see it in the market like this, there's a low created and there's a high created in every session. So when the high is created, what happens the next day or the day after? It doesn't specifically have to be the next day. What happens? The market opens and it goes up, takes out the previous day's liquidity. It can just to make it clear, it doesn't need to be specifically the day before. Like this is on a Monday and it got taken out on a Thursday, right? You see the example right here? But I just want you to think in these patterns. This is how liquidity works. So the banks and institutions made their more money right here, made their most money right here. And this is why we're always waiting for a liquidity to be swept. Liquidity is so powerful. I'll draw a triangle for you right now to give you the perspective of how this works. So number one is always the trend. Trend is king, as they say. Trend is king, as the kids say nowadays, right? King and queen and this and that. And number two is liquidity. Number two is liquidity. This is what we are looking for. This is what we are building our strategy for. We are defining where the highest probability of the market is going. So first we define the trend. Where is the trend going? And then we define the liquidity. Where is the liquidity about to be swept? Where there's the banks and institutions want to go to sweep up liquidity to go the other direction. So when the market sweeps liquidity, it usually goes on the other direction. So like this area right here, there's a low created, right? What does the market want to do the day after? Market want to sweep liquidity and continue up. Now, you're probably thinking, now this is a short move, right? We want to continue all the way up. It doesn't matter because we are only taking profits on these areas right here because this is on a 1 hour time frame. We are jumping to the 15-minute on a 1 minute time frame and we are taking the trade right there. So we're basically taking this trade right here. We're not taking the entire move up. So the market will take us out. And this is what happens. Market goes up, it creates a high, it gets taken out, and then it creates a low, and then the day after it gets taken out, then it creates a high. Now this high has not been taken out, but it doesn't mean that the high will not be taken out in the future. It will be taken out, but not now. So below the lows is where most of the people are putting their stop loss, and above the highs are where the most people are putting their stop losses. This is where the most traders are positioned. And you can see that the low is created right here. And what does the market do on Thursday, sorry? It goes down, it sweeps this liquidity. It didn't give us a reaction to the upside yet. So it swept the other liquidity for the second day and it continued down. And this probably will continue up, or there's more liquidity right here. It probably will go down, take out this liquidity and continue up. You know what? Let us do a test and see what happens. Let's speed this up. See? There's a Friday right here. So Friday created a new sense of liquidity. And what did the market do on Tuesday, the week after? It waited for it to sweep liquidity right here, and this is where it continued up. And this is what we want to think about all day long. Trend and liquidity. Where is liquidity? This is what we always want to know. This is what defines where the market is basically going, because the market is going to liquidity because it just swept liquidity and going to the other direction where other liquidities are. So because there is a liquidity right here, there's a higher probability for it to continue up to take out the liquidity on the top. Takes it out, and that is it. It takes out the low, and that is it switches direction. See? And when you start getting a sense of this, you will start seeing it over and over and over again. It swept liquidity. It created a new liquidity the day after. You might not see that this is a huge move, but this is the moves where we are taking. We are taking these moves. You can see the red candles. It takes out liquidity. It continues down. And this is the moves we want to take. All right, let's do a short recap and hope this was a good explanation for you about liquidity and how it worked. In this video, I explained to you and I showed you what liquidity is in the market. I also showed you the in a weekly basis where liquidity lies and how it works in the market, basically. Let me just show you a short example. This is a trade I took today. I just got this idea to do this. So I give you a sense of how it works. So today, 9 o'clock, this is a trade I took today. Let me just show you how this works. Select a bar. This is not today. This is today. So if we just do some market replay, this is not a part of the structure of the course, but it's just so you can get a better sense and understanding of how this works because liquidity is so important. So I mark out the market open London session and pre-market open London session, 8 o'clock, 9 o'clock. This is on UTC plus 1, GMT plus 1. All right. Before market opens, I see that the trend, like we talked about before, it created lower lows, uh, sorry, lower highs and lower lows. So it might continue doing lower lows and lower highs. This is what I'm seeing the market doing today. So what did it do? Before I do anything, I want to mark out where liquidity lies. Liquidity lies on these highs. This is liquidity. This is liquidity. This is liquidity right here. I want to see where the market is more likely want to go up to take out liquidity and then reverse down, following the trend because trend is king. So I jump to the 1 hour and then the 15 minute, and I see that there is liquidity always also on the 15 minute. What did I do? I waited for it. I just waited for it to take out liquidity and then reverse to the other side. And this is where I make my money. I wait for it to give you a sense of what it did. I waited for it to sweep liquidity. That's why we call it sweeps liquidity. It goes up, takes out liquidity, and takes out all the orders that are sitting over this area right here. So I didn't take a trade until it swept liquidity, and I usually put an alarm, an alert on this area. I wait for it to trigger the alarm. I wait for it. I wait for it. I wait for it. And so just to make you understand how this works. So I am around the market at 8:45, 8:40, right? So from 8:40 to until it sweeps liquidity, I'm not doing anything. I'm just sitting and watching the chart, right? So I'm waiting for it to sweep liquidity, sweep liquidity. I can't do anything before. Dup! It just swept liquidity right here. And now I'm waiting for the other confluences, which is break of structure and fair value gap reaction. So it did a break of structure right here on this area. Now I'm waiting for it to enter this fair value gap area and react to the downside. That is what I'm taking the trade because it's swift liquidity. I'm waiting for it to do another reaction. And what do you see here? It created a fair value gap reaction. It gave me a bearish candle. I enter right here. I put my stop loss on this area right here underneath the liquidity because this is where people put most their orders, as do we. But we're taking the trades with highest probability. And we take the trade where do we take all our money off during in this liquidity. If we go to the 15 minute, we take a trade where market has the highest probability of it reversing. So we take the profit right here on this liquidity and this liquidity. So we take two positions basically. And what do? We go in with money or doing a test account and we wait for it to continue down, continue down, continue down, because this is the highest probability of what the trend might do. This is it. We made money right here and we made money right here. So that was a short strategy explanation for you guys, but I just wanted to get the point across of how liquidity is so important and how liquidity is really reverses the markets. And this is where the most the orders are set and inside the liquidity. So liquidity is important to understand in this. All right. So do a short checking of explaining a short sentence of what made liquidity clearer for you in this lesson. One sentence is enough. You don't need to share too much. This is just because you don't want to sit passively and learn. And also, as always, follow me on YouTube, on Instagram, and if you haven't done it already, join the school community. All right, take care and see you on the next lesson. Welcome to this lesson of break of structure, where I'm going to explain to you three things about break of structure. What it is, what is break of structure, why it signals a potential shift, and how traders use it and how we use it for confirmation. So if you're familiar with football and football matches and people playing football, you can see that the one team is running one direction, right? And the other team takes the ball and runs the other direction. This is what break of structure is basically. It shifts the structure of the market. And in this video, I'm going to explain to you basically what it is. What is breakup structure? In an uptrend, in a downtrend, and how it works. And I'm just basically just gonna jump into the chart and show you how it works. So how do we define a breakup structure? A breakup structure is defined by candles and wicks. So these are wicks. These are wicks. There's a wick right here. Do you see this? Um, See this line right here? This is a wick, and this is the candle right here, right? There's a body of the candle and there's a wick of the candle. The rule of thumb is that the wick needs to be closed underneath the body of the candle. All right. So let's say this is a candle right here. There's a candle and it creates a wick. This wick needs to be closed underneath the body has to dominate the candle. And this is what indicates a break of structure going to the downside. So there's a low created right here on this wick. You can see the colors of it. This is defined as a break of structure. This is defined as a break of structure because the wick of it, of this candle, of this low of this candle, because we have to think about it as higher highs and higher lows. There's higher highs, right? And higher lows because there's a low created right here. There's a higher high and there's a higher low because there's a low created right here. There's a higher high and there's a what? Lower low because our trend is shifting. And the candle, body of the candle needs to be closed over the wick of the candle. And this is the definition of that the market is shifting. This is the one soccer team or the football team taking the ball, not soccer. I don't know why I said soccer. Football team taking the ball from this other team and shifting the direction of the market. It was up, now it changed direction to down. Bearish and bullish. So let me give you an example of what break of structure is even more, just to give you some perspective. And then I'm going to share with you a perspective of what break of structure is not. So this is a break of structure. Now, did it close over the candle? It's technically it is a break of structure, but it's not a good example. But this is a clear example. This is a clear example of a break of structure going to the downside, right? Because it closed on over the body. And this is another break of structure right here because it closed over the body. Right here, it closed over the body. And this is a break of structure right here because it closed over the body. And this is an indication that the trend is going bearish. There's a break of structure right here also, right? So let's do another example to the upside. So there's a break of structure right here on the upside. See, there's a wick and it closed underneath the body of the candle. So we did the explanation of there is a trend, right? As the kids say nowadays, trend is king. First, we identify where the trend is going, and then we identify liquidity. We identify where liquidity is, and then we identify a break of structure, BOS, break of structure. Trend is king, then comes liquidity, then comes the break of structure. So it goes like this, higher time frames and then lower time frames, right? From higher time frames to lower time frames. So you can choose. You can go from 1 minute to 5 minutes to 1 hour to 15 minutes and so on and so forth. Trend, the higher time frame, hold higher power. So that if a break of structure is happening on the higher time frame, it holds higher power. So what is a break of structure not? What is not a break of structure? This is not a break of structure. Why? Because you can see the wick of the candle is not closed underneath the body of the candle. This is not a definition of a breakout structure. This is not a definition of a breakout structure. There's a high right here, and there's nothing breaking it on this area right here. All right, so is this a breakout structure? Yes, because the body of the candle closed underneath it. Where's another example? This is a high created right here, and this is a wick. Is this a breakup structure? No, it is not a breakup structure. So we don't define it as changing the direction of where we are going. So first of all, it sweeps liquidity, and then it creates a breakup structure. We have now two confluences that's telling us we just swept liquidity and we broke structure to that direction. Because liquidity, when it gets swept, we usually reverse where the market is going. And when we have a break of structure in that reversal, it indicates even more that we are going in that direction. And with the trend also, it reinforces even more where the trend is going. So we don't want to take a trade just by one or two confluences. Confluences meaning a liquidity sweep is a confluence. Have I defined a trend? That is a confluence. A break of structure. Has that happened? That is a confluence. So this is not a break of structure right here. Also, there's a wick right here, and there's a. So when these happens, I don't trust it as being a breakout structure. Why? Because the first candle after the low didn't really close underneath. If you look at it, see, it didn't close underneath over the body. All right, this is what a breakup structure is, and this is what a breakup structure can be explained, and this is where you can define where the trend is going on higher time frame. Let me just show you on Bitcoin or something like that. If you can go to the higher time frame and see where Bitcoin is going, this is where it makes you define where Bitcoin is going on the higher time frame. So you can see what Bitcoin did right here. It created a high, it created a breakout structure, and this is where usually people invest in Bitcoins. They usually invest from a breakout structure, but this doesn't close right here. The candle closes right here, so people enter right here and they put their low right here. And this is what Bitcoin did because of the breakout structure that happened on the weekly time frame. We usually take a breakout structure on the 1 minute, so you can think about how powerful a weekly breakout structure is. So when a weekly breakout structure happens on Bitcoin, this is what usually people do. They start investing and they start putting money inside of crypto. And this is what the market did. See, this is how you can never miss opportunities with Bitcoin because, or with crypto, with any symbol, because you've learned Bitcoin, you've learned breakup structure, and when you start understanding this even more and you start applying it, you start to see it everywhere. And remember, higher time frames hold higher power. So let's just do a short recap. In this video, I explained to you what a breakup structure is, how you can use it, and how you can see a potential shift in the market. A breakup structure alone is not that powerful. It can be even more powerful if you put trend, because trend is king, and you put liquidity. Liquidity is also strong. It comes after trend, and then a breakup structure. Now you have three confluences that can point you to the direction of the market. And this is how we as traders are supposed to use it. So, a short check-in. What made candles clearer for you in this lesson? It should say, what made breakout structure clearer for you in this lesson? All right, just write a short comment or click on the poll so it could get more actively inside your learning process. So as always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. See you on the next lesson. Have a good day. Welcome to this lesson where I'm going to explain fair value gaps, FVG. So I'm going to talk about three things in this lesson. What an imbalance is in price is, because fair value gap, It creates imbalance in the market. And I'm going to explain that and how price returns to rebalance the fair value gap. Why does price return to take out the fair value gap, the 50% mark of the fair value gap, and how traders use it as an entry. They use fair value gap as an entry zone. So I'm going to jump directly to the chart, basically, is what I'm doing. Fair value gap is dedicated on 3 candles. It's a 3 candle process. So you have 3 candles. You have, let me just draw it out. You have 1, you have 2, and you have 3. Now, every candle usually has a wick. There's a wick right here, and there's a wick right here. Some candles don't have that much of a wick. So this is where the imbalance happens. So this is on a bearish trend, downtrend, right? And in this bearish trend, there was not much resistance in this area, and this is where it creates a gap. It creates a fair value gap in this area, and this area is where you usually mark out the fair value gap. And this is what the fair value gap is. There are too many sellers selling at the same time, and there is not a lot of buyers buying in this area because it's on the downtrend, right? So you can see it here in the chart that there are fair value gaps over and over and over again. And when you start seeing it, you start noticing that the market usually wants to continue down, right? But it also don't want to leave any imbalances in the market. So it wants to retest the fair value gap and then continue the bearish trend. I'm going to say it again. So the market wants to continue down, but it doesn't want to leave any imbalances in the market as empty positions, fair value gaps. So the market wants to come up to the fair value gap, take the 50% mark or take some of the fair value gap out, and then continue down. And this is where the ideal entry zones are for us as traders. We enter right here, we put our stop loss right here, and we continue the trend down, right? Let me show you how it looks like in the chart. So this is the perfect entry right here. This is the fair value gap that is being created right here. So if you're wondering what I'm using right here, this is called a GAN box. And the GAN box is created by, I'm just going to show you the settings that I'm using so you can just copy them if you like. So this is created by the 50% mark. So the blue line right here is the 50% mark of the fair value gap. Some people have it strict that the price needs to touch the 50% mark before they enter a trade. Some people has to have it between 25% and 50%, and it's as long as it gets into that area, they will enter. It's all up to you. I usually have it as long as it respects the fair value gap. It doesn't matter if it's 25% or 75%, as long as it respects the fair value gap and gives me a reaction to the direction of the trend, I'm entering the trade. So this is a perfect entry. It swept liquidity as we talked about before. There is a liquidity sweep. Liquidity sweep. It swept liquidity. It created a break of structure. There's a low right here, and there's a candle right here with the body of the candle that's closed underneath the wick. And what did the market do? We don't enter directly on this. The market created a fair value gap right here and the fair value gap right here. What did the market do? It continued up. It respected this fair value gap area and it continued down. And this is where we want to take a trade. And this is where we want to put our stop loss. And this is where we want to mark out the winning positions, right, on the liquidities. So just not to go too quick, there's fair value gap over and over again. And I want you to just notice them, mark them out as gaps wherever you go. So when you see these gaps right here, you see there's a gap right here, right? Market respected it. There's a gap right here, right? Market respected it and it continued to the other side. So you can see that the market respected these fair value gaps. All right, let me show you another example. This is what a fair value gap is not. This is an invalid fair value gap. You see, there's a fair value gap right here, right? But what did the body of the candle closed over the fair value gap, which makes the fair value gap invalid. Only the wick needs to be wicked inside the fair value gap as it's doing right here. You see it? The body of these candles didn't close over them. It's basically the opposite of a breakup structure. When we define a breakup structure, we define a breakup structure that the candle of the body needs to be the candle of this body needs to be closed over the wick. In a fair value gap manner, the wick is okay to spike into the fair value gap like this, spike into the fair value gap like this, and then continue. That is valid. But if the body of the candle is closed underneath the the fair value gap, then the fair value gap is not respected, right? So this is a valid fair value gap right here. Why? Because the entire body and the wick is respecting the area of the fair value gap and didn't close over it. If this body would have closed over it, over the fair value gap, if this body would have closed over the fair value gap, it would have been invalid. But because it didn't, then it's valid. So you can see it all over. There's a fair value gap right here. You can see the market go up, respect the fair value gap, and it continue down. The market goes up in this fair value gap right here. What does it do? It respects it, and this continues down. Okay, there's a fair value gap right here. What does the market do? The market touches the 50% mark and it continues to the other direction. So you can see it over and over and over again. And this is what a fair value gap is. There's a fair value gap right here. Is this fair value gap valid? No. Why? Because the body of this candle closed over the fair value gap. It closed over the fair value gap, which makes it invalid. Now, in these examples, it still respected the area of the fair value gap, and it continued to the other direction. But this is areas where we don't take a trade. Okay, give me another example, just a short example. So this is a small fair value gap right here. This area right here, there's a small fair value gap being created. What did the wick do? Some people put their positions right here as limit orders, right? And they wait for the market to go up, take out the fair value gap, and then continue down. You can do that as well. All right. So in this video, just doing a short recap, I went through how the imbalance of the fair value gap is created, how price usually returns most of the time to test that rebalance of the market and the fair value gap, because the market doesn't like imbalances. So the market usually comes back to the fair value gap and re-specs it and retests it and then continues to the other direction. And I also showed you an entry example of how you can take a trade from the fair value gap using the other confluences. We don't take a trade just because the one confluence happening. We don't take a trade just with a fair value gap. We use the other confluences, liquidity sweep, breakup structure, trend, and then a fair value gap reaction, because we need more confluences for it to indicate where the price or the price action is going. All right. Hope you learned something about fair value gap in this lesson, and just share a short sentence of what made fair value gap clearer to you in this lesson. One sentence is enough so you can learn actively. And as always, follow me on YouTube, sharing my perspective and videos that are not a part of this course, but a part of trading. Also on Instagram. And if you haven't done it already, join the school community. Talk to you in the next lesson. Have a good day. Hello and welcome to this video where I'll be explaining equilibrium in the market. In this video, I'm going to talk about three things: the midpoint of price movement, discount and premium areas, which indicates equilibrium, the balance of the market, and why equilibrium helps you trade locations. So I want you to see equilibrium in the market as a seesaw. We've all been to playgrounds and we sat maybe on a seesaw playing with our kids or playing with our cousins and family members doing the seesaw. And in the seesaw there's a balance. All right, there's a high point and there's a low point, and the low point becomes the high point and the high point becomes the low point. So I'm basically going to explain this to you and how it works by jumping directly into the chart. So the market needs to be balanced out. So I use this indicator called ICT everything. The first thing that the indicator does, so on a Monday, when the week opens, it creates a line right here. Do you see that? It creates a line right here through the Monday opens in Asia session. So this line is the equilibrium of the weekly of the entire week. So basically, there's a high probability that because this is the equilibrium, that the line or the price action will go through the equilibrium. So now, right now, if you see it, we are in a premium. Equilibrium has two sections. There is a premium, right? And there is a discount. Discount. There's a premium and there is a discount. What does the market usually want to do? This is how we should think. The market in a discount goes to premium, and then in a premium goes to discount, and in a discount goes to premium, and it zigzags its way all the way, and sometimes all the way to all the way to until it balances itself out. And sometimes it breaks through the premium and it continues and it makes a new higher high, or it breaks through the discount and it makes a new lower low. So this is what we want to use the premium and the discount for when we take a trade. We don't take a trade only from equilibrium. We use it as a kind of indicator where the market wants to go. So I want you to see this. This is a trade I took yesterday, right? You have to mark out the high and the low to be able to see where the market goes. So there's a high right here, right? There's a high, and where's the low? There's a low right here. There's a low right here. Okay? There's a high right here. There's a low right here. There's a high right here. There's a high right here. There's a low right here. There's a high and there's a low. This is where we mark out the high of the indicator and the low of the indicator. If you're wondering what this is called, this tool, it's called a GAN box. And this GAN box indicates the 50% mark of the middle point. So this is what the market wants to do. If you look at it this way, the market goes from a premium to a discount, right? This is where we mark out the high and the low. And the market wants to usually go from a discount to a premium, and from a premium to a discount. And then, see, it breaks through and creates a new market structure. It breaks through and creates a new market structure and creates a new way of moving inside the market. So in this point, what do? We have a new low and a new, no, this is not a clear high. No, I don't like this. This is not a clear high. There's a low right here and there's a high right here, right? There's a low right here, there's a high right here. I don't use this one. There's a high right here and there's a low right here. Just check it out. Just see what the market is doing. The market goes from discount to premium, and from premium to discount, and it breaks through. It usually continues during the through the equilibrium area. So this is what we want to see. Let me show you some more examples of this. See? And this is where we want to take our trades. So there's a high right here and there's a low right here. What does the market want to do? The market wants to go up, either go to the equilibrium part, touch the equilibrium, the 50% mark, and then continue the other direction. And this happens over and over and over again. Because this is what we want to do ideally. We want to take a trade along, going bullish, to the premium area, and then from premium we want to take a discount. but we want to follow the trend. That's what I'm saying. So there's a low right here and there's a high right here. And what does the market do? The market goes from discount to premium and then goes back to discount and then goes back to premium and then goes back to discount. And this is what we want to use as equilibrium as an indicator. So we have used different areas of the triangle, the strategy triangle. First, we have the trend, right? After we have the trend, we have liquidity, right? After we have liquidity, we have a break of structure, B. This is a B. There is a break of structure. After the break of structure, we have a fair value gap. And the last but not least is the equilibrium. So if we put all of these together, what do we have? We have a strategy because we know what we're looking for in the market. And this gives us a high probability of knowing what the market is going. This is what the market wants to do on a daily basis. It wants to balance itself out. So if you go to the higher time frame, this is what the market is doing right now. See? There's a low right here. Just I know I had it confusing when I started. There are two lows, one here and one here. So which one is the low? Right? It can be a bit confusing. The one that is the lowest is the one that is the low. So which one is the low? This one or this one? Because this one has the lowest part, you count that as a low, right? So you count that as a low and you take this as a high. This one is a high because this area is higher than this area. So this is what the market usually wants to do. This is probably what the market is going to do today. It's going to, because it's in a premium, you want to continue to discount and then continue probably back up because the trend is back up because there's a break of structure right here, close overneath the body. So this is what we're looking at right now. This is probably what the market is going to do right now. And when you start seeing this, you start getting with the structure of the market, you start understanding where the market is moving at all times. At all times. It will become like second nature to you. Oh, the market is moving up. Because people right now, they're seeing, because we're already in a discount. We're already in a discount and we've entered this fair value gap right here. Do you see how I read the market? We entered this fair value gap right here. We didn't touch the 50% mark. So what is the highest probability of the market doing right now? Market's gonna open, and then the highest probability of the market doing right now goes down, take out some liquidity, and then continues up. All right, that is a short explanation of equilibrium. Let's do a short recap. So I explained the midpoint of price movement. There is a premium, all right, there's a premium and there's a discount and there's a line, a 50% mark, the blue line that I marked out, this one, the 50% mark. If you want to know the settings of this GAN box, you can just feel free to screenshot them. You see, there's 0.5. There's a 50% mark of the GAN box. If I just remove it, you can also have it at 0.25% of the GAN box or 0.75% of the GAN box. It's up to you. But I usually work with 0.5%, 50% of the GAN box. This is the midpoint of the equilibrium. I'll also explain to you discount and premium areas. So we want to take in a discount, we want to take longs. In a premium, we want to take shorts. That is an indication of how the balance of the market is working. And this is how you help this helps you have better entries and trade to where the market is going. So if there is a liquidity in the premium area and we're taking a trade from discount, the highest probability of the market going to premium and liquidity is very high. All right, that's about it for this lesson. Feel free to check in and what made equilibrium clearer for you in this lesson. One sentence is enough, and we are doing this, by the way, so we don't sit passively and just listen. We are bringing out the information out in the physical world so it becomes real and it sticks with you even more. As always, follow me on YouTube, follow me on Instagram, And if you haven't done it already, join the school community. See you on the next lesson. Have a great day. Welcome to this video where I'll be explaining the overnight range. The overnight range is the range that's happening between Asia session and London session, and between London session and New York session. And between New York session, I'm not going to count the Sydney session because we don't trade that. So I'm just focusing on Asia, London, and New York session. Basically just London and New York session because those are the overnight ranges that we need to be able to trade on London and New York session. That's our only interest. So I'm going to talk about what the overnight range represents, why institutions watch these levels, and how breakouts create opportunity. And this is why we're using it because it gives us a different opportunity to enter a trade that can give us a better entry, basically. So you've probably heard this, but the overnight range is a metaphor for a rubber band, right? You have a rubber band. Now I don't have one next to my table, but if you have a rubber band, you want the overnight range to you want the price action to exit through the overnight range, right? There's an overnight range happening. We pull the rubber band, like price is just building up. It's building up, building up, building up, and we want it to shoot through the overnight range. And when we see it shooting through the overnight range, this is when we want to take advantage of of the market, of the price movement, move it that way. So you've probably heard AMD. AMD stands for accumulation, manipulation, and distribution. And I'm going to show you an example of this in the market. So during accumulation, this is what usually happens during the overnight range. I'm not going to specify it exactly if it's the Asia session or London session overnight range, but I'm just going to point out that the overnight range accumulates. This is where the rubber band gets loaded and then it breaks through, right? So if there is no accumulation during the Asia session, because let me draw it for you. You have um, you have Asia session, London session, and New York session. Okay, so you have three sessions, and this is where there is accumulation, right? Manipulation, something happens, and then distribution, right? And this is, if we're trading London session, this is where we want to take the trade, right? We want to take a trade short on this area. And this is because there's an overnight range created in this area. This is where we want to take a trade long in the New York session. So every session has its benefits, but the only session we're not trading basically is the Asia session. We're only using it as an indicator of where the market is going. So if there is no uh, if there is no accumulation, you open up the charts. If there is no accumulation in the Asia session, the accumulation basically moves over to the next session. So if this session instead has accumulation, what happens in the next session? The next session goes to manipulation. So it manipulates instead. Instead of what would happen in a London session happens in New York session. So this might happen. And then in the Asia session, we get the distribution. Let me let me show you this inside the chart. Let me just close down. I never have my chat open, excuse me, when I record. So let me show you an example of this. So this is the 9 o'clock New York London session open. The 9 o'clock London session opens at 9 o'clock, and I usually mark out the pre-London session market open. So this is what happens during the London session. Let me just mark it out. There's an overnight. This is the Asia session open. Between the Asia session open, let me just Asia, London, and where is New York? New York is around because this is a different time. Let us just write it at 3:30. And New York, right? Look at what happens. This is so clear. This is a perfect example. So you have the overnight range where you mark out the high and the low of the overnight range. Now, there are a lot of discussions of where is the end of the overnight range happening. It's not a static place. So because I'm seeing this high, I go down to the lower time frames right here. I'm usually marking out this high because I know that the market is not going up. It looks like we are bearish, right? So marking out this high, it doesn't matter if it's this high or this high because it's still gonna break through, or this high because it's still gonna break through on the downside. It doesn't matter. So if it's not at 7 o'clock or at 8 o'clock or at 7:30. It's not that static of a time. I've learned over the years, and this is what works for me, and this is what I've been using. And if it's not clear, don't use it. Don't trade it. It's not this and that. It's not black or white, right? So I'm just gonna use this high right now because it's the pre-market open and it's not specified at any exact time because it's at 8 o'clock and it's created this high. So what am I looking for? I'm looking for this is accumulation. You can see it. This is accumulation happening during the Asia session, right? This is what the market is doing right now during the Asia session. And as soon as London session opens at 9 o'clock, what did the market do? The market manipulated. The market manipulated until, let's say, 3:30, until this area right here. This is what the market did. Market manipulated, and here it distributed. And it's kind of accumulated also. But we don't care about the New York session right now. And this is what we're focusing on, the London session, because this is where we want to take a trade. We want to take a trade outside the overnight range, right? We take a short outside the overnight range and we mark out these lows right here. Maybe this low or this low right here. I remember this trade. I took this trade. This is where we take a trade. This is where we make our money. So this is how it works. There is an overnight range that's happening before every session. The London session has the Asia session, and the New York session has the London session, right? And you start seeing it over and over and over again. There is no specific time for the overnight range as long as it's during that session. Let me show you another example just to get my point across. I'll just close down the replay mode. Market opens at 9 o'clock. There's let me see the midnight right here. I usually have this is where I have an indicator. This is the indicator I'm using, by the way, ICT everything, and these are the settings I'm using. Feel free to copy them. This is on UTC +1. Feel free to screenshot it, pause the video, and screenshot all the settings so you can have the same indicator as me if you like. Right, the style of it, boxes, and the visibility of it. And it gives you what time the Asia session open. You can draw these hours by yourself, but it's kind of easier to see it like that. So the first thing I do, I mark out the London session open, I mark out the high, this is the high, and this is the low of the accumulated overnight range happening. So what does the market do? The market opens up during the accumulation and breaks through. It manipulates to the upside, breaks through the overnight range. Some people just, as soon as it breaks through the overnight range box, what do? They take the trade right here. They put their stop loss in the middle of the overnight range of the box, and they just leave it. They just leave the trade running, and it can run for days or weeks, and they just leave the trade. See? This can work also. They're inside of a winning trade. It can just continue for days. Right now, I have a friend that's doing this, and you can get stopped out as well. All right, that's a bit of an overnight range explanation. Let's do a short recap. What the overnight range represents. I talked about the different um, different areas: accumulation, manipulation, and distribution, and how we want to use them, and how they create breakout opportunities. So in this lesson, just do a short lesson check-in. What made the overnight range clearer for you? Is it specific of where the overnight range is? Just write one sentence and share it below. And if you haven't done it already, follow me on YouTube, follow me on Instagram, follow the school community because I share spreadsheet, Excel files, and everything that you need to be able to master your trading skill. Thank you for this video and see you on the next lesson. Have a good day. Hello and welcome to this video where I'm going to be talking about news and market volatility. I'm going to share with you three things in this lesson: why economics, news moves markets, why volatility increases during news events, and why you must track the economic calendar. So let me just share with you the metaphor. There is a storm in the ocean, right? And we are this boat right here. When there's a storm in the ocean, the storm indicates news and market volatility. This is something we can't control. And there are some people that trade news, and there's other people that don't trade news. How I trade, I stay away from the news as much as possible. There are ways that I'm seeing now on social media where they just gamble away their funded challenges because news are happening and they are hoping for it to go long and go short. So they basically high over leverage or over risk on I don't know, 25K account, and they put all their profits in one, or all their risk in one trade, hoping that the news will go long at their direction or short in their direction. I'm not trading news. I don't trade news. I don't focus on market volatility. The only thing I'm focused on right now and how I do it is having structure, not gambling away because somebody said something. Now, yesterday there was news, and I'm going to show you an example of how it affected the market. First of all, I'm going to show you what you can. I wrote this inside of school community yesterday. Let me just show you how it works. Um, Give me a second right here. Today's event. What's the market doing today? Trade exit news this week. So I shared it inside of the school community, and if you haven't joined already, do that. There are two tools that I usually use investing.com economic calendar. We need to know when the news are happening. So in your trading view, there are also being news indicated right here. You can have news indicated right here, but usually I press on investing.com economic calendar. I press on this week, and this is what I'm seeing happening this week that might affect the market. So on Monday, yesterday, President Trump spoke. He spoke and it affected the market. So during these times, we want to be cautious of our trades. We can have the perfect setup, but as soon as news happens, it can flip to the other side. So we want to be cautious of the news that's happening during the event. And importance of the news. You can also filter out, show filters. You can search or mark out the importance, high or medium. So I just mark out the high because those are the ones for me that over the years affected the market highly. And this is why you can see the time of it. 2:30, 2:45, 2:45, 3:30. This is why the main reason I trade the London session. I trade the London session because they are not that affected by news. There is no news happening during the morning, only happening like once a month, the Germany CPI happening in the morning at 8 o'clock during the London session open. So you can use investing.com, you can use forexfactorycalendar.com, you can see the folders of it, red folders, importance, orange, less important, yellow, less important, right? Let me show you an example of what happened yesterday. This is what happened yesterday. This is a storm metaphor I used in the beginning. So you're trading right here. Yesterday I took a short, right? I took a short right here in this area. I made some money in this area. Okay, I made like around 3% yesterday. So in this area, if I kept holding, put my Take profit right here because the market was bearish. It was so clear that the market was bearish yesterday. That is why I took a short, because I'm following the system, I'm following the strategy, I'm following the trend. And what happened? This is what happened during the news event. I usually mark it out like this. I put a line, I right click, I have a template called news. News. So it indicates red. So I don't take trades before that. Now, why did I take trades right here? Because I usually trade between 9 o'clock and 11:30, because that is when my mind gets tired and I step away from the market. And this is the critical areas where I make most of my mistakes. So it's not worth it for me to be longer inside the market. And this is what the news did. It jumped about around 1,000 points because news was happening. This is what usually people do with their funded accounts. They put a trade right here, right? And they put a trade right here. They put a long right here and they put a short right here. They put they guess that the market is going up and the market is going down. They guess. They don't know because we're not using any strategy right here. This is what the market people are doing. So they put a limit order right here and a limit order right here. So if the market continues up, poof, it just breaks through, and they have 20 funded accounts. Now, I hope I'm not giving you the idea of doing this, but this is what usually the people are doing to pass funded accounts in one trade. They maximize the trade and they take the profits, and this is where they pass 20 funded accounts. Is this on a consistent basis that we can do this? No. So this is why I don't trade news, but this is where you can find out where the news is happening. So when the news is happening, let's say Tuesday, March 24 at 4:30, there is news happening at 2:45, not 4:30. So at 2:45, this is where we go. We go to Tuesday at 2:45. I mark out the news. So this is what I do. So the market opens at 2:30, right? This is when I mark out the yellow one. The market opens up at 2:30. Between 2:30 and 2:45, I'm not doing anything. I'm just watching the market. I'm watching the results of the results of the news happening. And this is where, if you press on it, it says a higher than expected reading should be taken as positive bullish for the USD, while a lower than expecting reading should be taken as a negative bearish for the USD. So they always forecast what the news is going to happen. 51.2. If a higher than expected, if they are expecting 51.2 and the higher than expected actual amount that happens are higher than the forecast, it should be taken as bullish, which directs the market to a bullish trend. And if it's lower than expected, it directs the market to a bearish negative trend for the USD. So this is how we can read the market. All right, this is a short explanation. Let's do a short recap. Why economic news move markets, why volatility and just why economic news moves markets. News indicates uncertainty, fear, insider trading. People do insider trading, greed, FOMO, because when this happened, this is when so many people didn't want to miss the move, so they entered right here. They enter right here. Maybe they don't want to miss the move, and because they want to catch the entire high, right? They think that it's going all the way up, and this is what happens. It goes all the way up here, and it continues down and takes all those people out. News creates fear and uncertainty, and it's unstructured because we don't know how people are going to react and how they are going to do it. And we don't know how it's going to affect the market, because what we are seeing right here is market volatility. What we're seeing right here is human behavior. This is psychology. This is not just candles. We are seeing humans reacting. So there's a massive amount of humans reacting to this. It makes you think, like the Trump gave a speech about this. It makes you think how many people got in got in on longs right here and made some huge profits right here because what because of what Trump said. So, why volatility increase during news and why the economic calendars matter. So, check the economic calendars because we trade with structure, we don't trade the news. All right, as always, lesson check-in. What changed in how you see news and trading? What did change? Write just one sentence, share it below because it will get stuck in your head even more because you've learned something. So as always, follow me on YouTube, follow me on Instagram, and join my school community for more information like this. See you on the next lesson. Have a good day. Hello and welcome to this lesson where I'm going to share with you best times to trade. This is what I've learned during the years because we usually come into the market and we don't know when to trade, when to enter, what time do we fit trading outside of our 9 to 5 so we can trade and be focused. So what time is best to trade? So in this video, I'm going to share with you why certain sessions have more liquidity. Why? Why London and New York session matter the most. These are the sessions that we want to focus on the most. And I'm trading the GMT plus one. Just change that to where you're based. Why timing improves probability. Right. So I want you to think about trading as fishing. If you have done fishing before, usually fishing, hunting, and those things, the fish usually comes out. I don't know about fishing, but the hunting, the deer usually comes out at dawn, right? Right in the morning. Because when I went hunting before, we usually go to the hunting place at 4 in the morning because the sun rises at 5 in the morning, and this is where the deers are alive and you can see them outside. The same thing goes with fishing. We want to be fishing at the right time. Don't want to be fishing when the fishes are asleep, right? We want to be, and then we're just waiting for something to happen, and eventually we just react, and it is not good because we're reacting out of boredom. So I'm going to show you when is the best time to trade and how it can benefit you. Basically, is what I'm saying. So this is what works for me, and this is what's been working for me for the last couple of years. And this is when I trade. I don't trade the Asia session. The Asia session is not ideal for me to trade because there's not a lot of volatility. We want to we want some volatility in the market, not too much. We want some volatility in the market because we want to see our trade executed maybe in a quick manner or in a structured manner. And volatility can create some structure in the market. So this is what I usually do. I mark out the 9 o'clock London session open and the 8 o'clock pre-London session open. I also mark out the 3:30 for 2:30. So this is the New York session, London session, right? And this is the NY New York session. Let me just New York session. And these are the times that we want to trade. I'm just gonna make it so super simple for you. We want to be next to the market at around 8:45. 8:45 to 11:30 is the max. Like I'm even stretching it when I'm saying 11:30. And we want to take a break in the middle of it, right here. We want to take a 5-minute break in the middle of it, and we can put a timer on so we get even keeled, right? We don't stress ourselves out. You can sit next to the chart all day long and not take a trade. So we need to move away from the chart during the half, like put in a half time, put in a timer so you can take a breather, do some exercises, take some coffee, go to the bathroom, stretch a little bit, and then come back to the session. So this is the ideal time where we want to trade. We want to trade the London session 8:45 to 11:45 or 11:30. You know what? I'm stretching this out. We want to trade from 8:45 to 11:30. And during these times, we are probably taking a trade between maybe 10 o'clock, maybe 9:30, maybe 10:30. We don't know. Maybe at 11. We don't know. We are waiting for our strategy to happen. We're observing the market before the strategy happens. So the same thing goes with New York session. New York session opens up at 3:30. This is the ideal time where we want to trade. We want to be sitting next to the market 15 minutes before. That is enough because shouldn't take you a long time to set your bias until max 5:30. This is the ideal times where we want to trade. We want to trade between 15:15 to 30, right? These are the ideal times that we want to trade. Why? Because this is where the deer comes out. This is where we can get most of our fish during these times. And this is where we are most highly alert, and mentally strong, and we're not sitting watching the charts all day. And this is the time where, as I said before, the fish comes out. This is the time where there's a lot of volatility happening inside the market. After that, after 5:30, this is when our strategy is not happening. Look at the market, how it works, and look at how the market works right here. We're not taking any trades in these areas right here, and this is what the times where we're tired. It's the end of the day. We don't want to be sitting next to the market from 9 to the entire London session and the entire New York session. It's not needed. Let me give you a perspective on this. If you sit next to the market from 9 to 11 and you didn't take a trade, right? And I'm sitting next to the market from 9, London session opens, until 5:30 because I want to work hard, I want to hustle, the hustle culture that we're hearing about. And I didn't take a trade. So who did more work, me or you? I'm just sitting next to the chart. You're just sitting next to the chart. We are looking both at the same chart, but during these times, you went shopping, you did some things, you spent time with your family, you touched some grass, you went out playing soccer with your kids, you ate lunch, all those things, and then you're coming back to New York session fresh, even keeled. You've power napped even before. But me sitting next to the chart all day, whose decision making is going to be more fatigued? Probably me. Why? Because I've been sitting and watching the chart all day. This creates boredom even more. And boredom is good in trading because it shouldn't be exciting. So these are my recommendations on when you should trade because these are where you see the patterns of your strategy over and over and over again. And this is the highest probability of you taking that strategy and creating some profits from it. But because these are the times where you want to maybe block out some time in your calendar at work so you can sit next to a chart during these times. And you're not sitting exactly next to the chart the entire day because let me show you how it happens. So there is liquidity right here, right? Let me just show you how this happens. There is liquidity right here. We're following the trend. We're waiting for liquidity to be swept. So when does the liquidity become swept? This is when we mark out the liquidity right here and we put an alert. So we go and we do our thing at work, and when the alert rings, this is when we can act. So we're just waiting for it to hit and sweep the liquidity. Let me just see when it happens so I can stop it. And now, so you were at the market at 8:45, and you marked out the liquidity right here, and you set an alarm. So at 10:20, so between 8:45 and 10:20, you can't do anything basically. This is when you set an alarm. There's a guy in the community, he sets an alarm and he connects it to his Apple Watch. So when the alarm rings, this is how you do an alert, by the way, if I'm speaking out. You just you press on this line, you press on these three buttons right here. Well, this is not how you do it. This is how I do it. You know, I double, I press on Alt and A. Press on this line, I press on Alt and A. This is how you do it. You press on this line, this is the alert. Add alert, right? This is on replay, because this is on replay mode, it doesn't work. You press on this line, you press on this, you add an alert, and when the alert rings, this is when you come to the market. So you're basically just waiting next to the market. This is where you take the trade right here. You put your stop loss right here, and you mark out your take profit one, take profit two, and you just wait for it to do its thing. There's no more than this. And this is a process that can be repeated over and over and over again. All right, so in this video, let's do a short recap. I talked to you about why sessions affect liquidity somewhat. So each sessions want to sweep up liquidity to continue the direction. While London session and New York session is the one we are trading. So we trade when the market is active. We don't trade when the market is dead, basically. We need some volatility to have it react from our strategy so we can observe the market, wait for our strategy to happen, and then we enter the trade. So I just wanted to do a short lesson check-in. What changed in how you see trading time? Because some people used to think about trading as I'm sitting next to the chart all day, or I'm just trading for a minute or two and then I'm leaving. What changed? This is the realistic approach I'm sharing with you. So just share one sentence of what you learned and share it below because it will stick with you even more. So as always, follow me on YouTube. There's a link downstairs in the description. Follow me on Instagram. There's also a link in the description. And follow, if you haven't done it already, join the school community. And I see you on the next lesson. Have a good day. Hello and welcome. In this video, I'm going to share with you how I analyze a chart from scratch. So I'm going to open up TradingView, show you a completely naked chart, and I'm going to show you how I do my technical analysis on a daily basis and how I analyze it. Basically is what I'm doing. So I'm going to share with you three things: how I start with higher time frames, how I identify key levels and liquidity, and how I build a directional bias, how I see my bias and how I create the trend of the day based on what I'm seeing in the market, right? I'm using this metaphor as a map. When you want to drive to some place, not now, but before, when we didn't have phones and stuff like that, we used a map. And this is what I'm going to show you how I do my technical analysis because we have a map, we know where we are going, right? And if the map is not clear, we're not going anywhere. So this is what I usually do. So enter I open up the DAX or the NASDAQ, US Tech or the Germany. I come to the market at 8:45 and this is what I do. I come to the market at 8:45. The first thing I do, I mark out the pre-London session open at 8 o'clock, 8 and 9 o'clock London session open. And I'm on the hourly time frame, right? So I watch the market do like this. I'm watching what is the direction of the market? What am I looking for? What is where is the market going right now? What am I looking for? So what I do, I jump back and see if there is liquidity on this areas that's being swept. Because if it sweeps liquidity on this area, there's a high probability for it to go to the other direction. So, because there is no liquidity in this area, my bias for this is bearish. Why? Because there is a 1 hour break of structure. So I'm looking of the higher time frames break of structure. You can see the time frames that I'm using: 1 minute, 5 minute, 15, 1 hour, 4 daily, and we. So I'm just using the 1 hour, 15, 5, and 1. These are the four basic time frames that I'm using. So how am I identifying the 1 hour break of structure? There's a low right here, and it closed over the body of the candle. There's a low right here, and it closed over the body of the candle. This is a clean direction of where the market is going. There is also a liquidity right here. There's a liquidity right here, and this is where I mark out the 1 hour liquidity, right? So usually what I'm looking at right now, this is before market opens. I don't know what the market is going to do. I'm just observing what the market is going to do and reacting from it. But this is what I'm seeing, or I want to see the market doing before I'm entering. I want to see the market high, low, going up, taking out liquidity, and then continuing down. This is what I'm observing the market to do before I enter. So now I'm on the 1 hour time frame. I want to jump down to the 5 minute, 15-minute time frame. By the way, in the 1 hour time frame, this is what I also want to mark out the equilibrium. You can see that there's an equilibrium right here in the middle. I'll jump down to the 15-minute time frame, and this is where I mark out the, I'm just gonna not do so many lines so it can be clear to you. There's an equilibrium right here. I'm just putting it right here so you can see it more clearly. And I jump down to the 15-minute and I mark out the 15-minute time frames. So higher time frames hold higher power. Higher time frames shows us the direction of where the market is going. Are we bullish or are we bearish? So where are we going? So higher time frames is the stronger time frame. So the liquidity is the same thing. Higher time frame liquidity holds more orders. So the banks and institutions want to take out higher time frame liquidity. Not always. If it gives us a reaction on the 15-minute, I take a trade from that also. So I mark out the 15-minute liquidity right here and the 15-minute liquidity right here. So this is what I'm seeing, what I'm wanting the market to do. I want the market to take out these liquidities, either in this or this, and then continue down. And this is where I want to take my trade on this areas right here. I'm just showing you how I analyze the market. So I'm waiting. I jump to the 5 minute. I usually don't do that much on the 5 minute, and I jump on a 1 minute. So I wait for the market to open, and I'm just waiting for it to take out liquidity. So it just took out this first liquidity right here. So it took out the first liquidity right here, but did it give us a breakup structure? No. So we don't do anything. This is not valid. This indicates that the market wants to take out more liquidity before going to the downside. All right. So I'm waiting for it to take out another high time frame, another 15-minute liquidity. I'm waiting for it. I'm waiting for it. I'm waiting for it. Now, see, I'm removing this because it wasn't valid. Now I'm waiting for the 15-minute liquidity to be swept. Now we have three things. I have the trend, right? I have the trend, which is bearish. I have liquidity being swept on the 15-minute, right? I'm waiting for a 1-minute break of structure. And then I'm waiting for a fair value gap. And I'm checking that the equilibrium is correct, which is correct. See, I'm taking my ideal, I'm taking a short and a premium to go to discount. See, short, premium. So it's already reacted inside the premium area. Let me just check. Did it do a break of structure? Where's the low? There's a low right here happening, and it closed underneath the body. We are still not doing anything. You can still take a trade from this, but we're still not doing anything. And this is how I analyze the market. This is basically how I analyze the market, and this is, I don't want to get too much into this, but this is what I take by trade. Just quickly, you can see that it created a gap. There's one gap right here. Let me just show you. There's a gap happening right here, and there's a gap happening right here. And the gap is being taken from this wick to this wick. So I'm waiting for it to give me a reaction on this gap to continue down. This is where I enter, and this is what happened in the market. I enter right here, put my stop over these highs right here, and I take my profit on these liquidities right here, and this is what the market did. You can basically just, to be honest with you, you can basically just screenshot this. Like screenshot this. If the market does this, take the trade over and over and over and over again. If the market does this, take the trade. There's a break of structure. There is a fair value gap happening right here. The market reacted from the fair value gap because it gave us a bearish candle. There is a liquidity sweep happening right here. We are over the equilibrium area. We are following the main bias of the day, bearish, the trend. And this is what it did. If you keep doing this over and over and over again, I promise you, you will see some results. And this is how I analyze the chart, basically, on a daily basis. Let me show you a different perspective on this. Um, okay, see, there's a Monday, and then I mark out the 9 o'clock and I mark out the 8 o'clock, right? This video might be too long, but it's fine. So, what did the market do right now? The market closed underneath a breakout structure before market open. Now, this is the Asia session overnight range. So I'm waiting for a market to do what? Either break through the overnight range because it already swept liquidity during the Asia session. So I jump to the 15-minute. I'll wait for the first 15-minute candle to close. It closed underneath. What did I do? You take a trade right here, you put your stop loss right here, and you put your profits on these lows right here. And this is what the market is about to do. It goes down, it takes your profit out, and you have some profits because it's accumulated, manipulated, and it's going to do a distribution, AMD. So this is also how I analyze the market because the market on this day didn't want to sweep liquidity after the market open. It's probably going to continue up. Look, continue up and sweep this liquidity, this liquidity, this liquidity, this liquidity. It took out all liquidities right here. So this is how I analyze the market, analyze the chart on a daily basis. All right. So that's about it. Let's do some recap on this video. So in this video, I shared with you how you're starting with a higher time frame always, how we mark out the London session and New York session open, how to identify key levels and liquidity, and how to build a directional bias. The directional bias is built through the higher time frames. If we see a breakup structure happening on the higher time frames before market opens, that's an indication of where the market is going, either bullish or bearish. Lesson check-in, as always, what made chart analysis clearer for you now? Just write one sentence and share it below. And as always, again, share, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. Talk to you inside the community and see you on the next lesson. Have a great day. Welcome to the third stage of the Trading Made Simple course. In this video, I'm going to do a short introduction and show you where we are in the roadmap, where you are in the roadmap. I'm going to explain the roadmap, as I just mentioned, what this module will help you understand, and what this means for you, your expectations for this module. So we are right now, I'm showing the trading roadmap. We are right now in the strategy and how to take trades module. So we did the foundation, we set everything up, we we downloaded the trading view, we downloaded the broker, we set up the demo account, and in the second module, we learned how to read liquidity, how to read the market, how to understand market structure, how to understand the breakup structure and the fair value gap. All this is explained in stage number 2. Now in stage number 3, we will put everything together that we've learned into a strategy, and I will show you here how to take a trade, what strategy you can use, what model you can use, two different models, two different strategies, where to take profit, where to put your stop loss, where to have how to have or create a checklist for you so that you can check things off so you can enter on a strategy. So in this module, you will basically put everything together based on the technical analysis that you've learned. So in this is going to be a propped, like full how to do it strategy. We learned what it is and now how to do it in the third module. All right? So, what does this mean for you? You will stop guessing, basically. You will know when you enter the market, you will know what you're looking for, you will know what you want to see, when you want to see it, and how you behave, not behave, how you put your stop loss, how you put your take profit, and how you take profits, and how you take your losses. There are also good losses to be taken in the market. So I'm just explaining to you a short explanation of the roadmap, how this module worked, and what you should expect from this module. So are you ready to get going? Just write a short sentence about where you are right now in your trading journey. Have you done step one and step two? And now you're ready to take on step number three in the trading roadmap. As always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. All right, see you on the next lesson. Have a great day. Welcome to this lesson where I'll be explaining to you the 1 minute model explained. Excuse me on the phone. So I'm going to explain to you how to take a trade on the 1 minute inside the chart. So I'm jumping directly inside the chart just to show you how this worked, and I'm going to show you some examples of how you can use this. So here's the checklist, and this is the one I recommend that you follow. We need to find out if the trend is set. Did it sweep a liquidity on the 1 hour or on the 50 minute? Do we have a 1 minute breakout structure or a 1 minute fair value gap? And is our risk reward worth it to enter the trade? So the first thing you do is, I'm showing this on the London session. This can work on the New York session also. I'm trading this on the DAX and on the NASDAQ, right? This is the DAX. You can see it right here. This is the Germany 40. So the first thing first, I mark out the 9 o'clock London session open and the pre-London session open at 8 o'clock. So I'm looking for a break of structure on the 1 hour to find my bias of the day. So the bias is bearish. Why? Because there's a break of structure right here. And there's a break of structure right here also. This indicates that we are going bearish. There's also a high, a liquidity resting on these highs right here on the 1 hour. So I mark out the 1 hour, liquidity is right here because higher time frames hold higher power. And I jump down to the 50 minute and I mark out the 50-minute highs or liquidities right here. And this is what I want the market to do. I want the market to continue down, take out some liquidity, maybe this or this, and then continue down because I want to see a reaction happening on the 50-minute or the 1 hour liquidity. So what do? I jump to the 1 minute. I wait for the market to open and sweep this liquidity. If the market didn't sweep the 50-minute or the 1 hour liquidity, I can't do anything because it's not a part of my model. So I'm waiting basically for the market to sweep liquidity. So I'm just sitting and waiting and waiting and waiting. So did it sweep liquidity yet? No, I'm waiting for it. And should it sweep liquidity soon or not? All right, come on. There you go. It just swept liquidity. It swept liquidity right here. It's following the trend. That's number one. Check. Liquidity sweep, 1 hour, 50-minute. It's on the 50-minute. Check. Did it break structure on the 1 minute and did it create a fair value gap on the 1 minute? So it swept liquidity. This is what I usually mark out with the liquidity. It swept liquidity right here. It created a break of structure to the downside right here. There's a low right here. And the body of the 1 minute candle closed underneath the wick of the candle. This indicates that it's a break of structure. Now, there are two fair value gaps right here. There is one right here, and there is one maybe right here. We'll see what the next candle is. There's one right here. So this is what I want the market to do. I want the market to enter this area of the fair value gap, respect it, and continue down. So I'm waiting. I'm still waiting. I'm not entering any trades. It entered the 50% mark of the fair value gap, and this is what I usually take the trade and I put my stop loss over this area right here, and I take my take profits on this area right here, or this area right here, or this low right here, right? And I enter the trade, apply risk, I wait for the market to see what happens, and just it continues to the downside, taking out my take profits. It didn't take out this take profit, by the way. I'm not seeing the candle close to it. And there you go. 1, 2, take profits, get taken out. That's how it works. There's a liquidity right here that got swept, a break of structure created, a fair value gap created, and a reaction off of it. And this is when we enter and we put our stop loss over this area right here. Let me show you another example. So this is today. Let me show you. This is what I did today. Right. So I came to the market. I looked at the market. How is the market looking right now? So if the first few seconds that you look at the market, you should indicate that the market is bullish. Why? Because there is a break of structure happening to the upside, or this here, to the upside. High, low, high, low. So the market indicates that we are bullish, sorry. When we are bullish, we want to mark out the lows, not the highs, the lows of the 50-minute or the 1 hour. There's a low right here, there's a low right here, and there's a low right here, right? I assume that this is the 1 hour liquidity because this is the sell side liquidity. See? 1 hour. So what do we want the market to do? We want the market, because the market is like this. Take out some liquidity and then continue. So we jump down to the 1 minute and we wait for it to sweep liquidity before we do anything. So we wait for the market to sweep liquidity and give us a reaction to the upside. So it swept liquidity. Now, let me show you. This is what happens also. It swept liquidity, right? Swept liquidity. We're waiting for a break of structure to happen. It created a break of structure right here. It created a fair value gap right here. Fair value gap right here. And we're waiting for it to enter the fair value gap and give us a reaction. What happens? It entered the fair value gap. We take the trade. We put our stop loss underneath this low right here. And what happens? Just to be clear and honest, this doesn't happen always. What happens? The market takes us out. Now this is a weird jump, but the market takes us out. So what do? We relax and we mark this out like this, and we wait for another reaction. We remove this, and we don't need to start and think, oh, what if this happened? What I could have gained $1,000 on this trade. No, we wait for the other liquidity to be swept. Because this is what happened today to me. It's today. I took the trade, I lost. Now I waited for another liquidity sweep to be able to enter again. So it created another liquidity sweep right here. Swept liquidity. It follows the trend. It swept liquidity. I'm waiting for a 1 minute break of structure and a 1 minute fair value gap reaction. So what did it do? It created a fair value gap right here, right? It reacted off of it, but I couldn't take the trade. Why? Because there is no break of structure. Do you see it? There's no high. And this is the break of structure that I'm waiting for to happen. So I waited for it to happen. It didn't. So this isn't not a valid trade. What is valid? The liquidity sweep is valid. So I'm waiting for another reaction to happen. There's a high right here. There's a there's a fair value gap right here that's been respected again. This got respected, but it closed underneath, so it's invalid. This fair value gap got respected, but I'm waiting for, I have all the checks checked except the break of structure. So I'm waiting for it to do a break of structure before I enter. There you go. It created a break of structure, And this is where I enter the trade and I put my stop loss underneath this low. So this is what I did. I took this trade, it created another fair value gap. This is maybe too much for you, but I'm just going to explain my mindset going through this. It created another fair value gap, and when this happens, because I'm certain on the direction of where the market is going to go, I'm waiting for another fair value gap, or it just created another fair value gap, and I waited for it to do another reaction. See, it gave me a reaction still. This is where I added to the position. I added even more to the position and I put my stop loss on these area. And where did I take my take profit? On this area right here. And I enter and I let the market do its thing. I wait, I wait, I wait, I wait. Because I know the direction of the market because of the trend, liquidity sweep, break of structure, fair value gap, and I'm waiting for it to sweep. No, not this area. No, no, no. These highs right here. Take profit on these highs right here. All right. This. Let me just show you how this works. Why did it reverse from this area right here? If you jump to the 15-minute, what happens? There is a 15-minute fair value gap. Not this high. This is not. On the 15-minute fair value gap is where the first take profit is, not this high. So I didn't take profit. I took profit right here because it passed 11 o'clock and I didn't want to trade anymore past 11 o'clock. So you take the profit on the 15-minute fair value gap for this trade. And do you see how this works? This happens over and over and over again. This is like the cookie cutter that you need to use. Now, let me show you another example, the last one. We come to the market. We mark out 8 o'clock and 9 o'clock. We wait for a break of structure to happen before market open, and we take the trade after market opens. We mark out the high. This is on the 1 hour, right? Then we jump down to the 15-minute. We mark out the 15-minute highs because we are bearish. We want the market to take out the highs, give us a reaction to continue to the downside. All right? So we mark out the 15-minute highs and liquidities, and we're waiting for the market to basically take out the liquidity. Now, it took out this liquidity right here. What do? It swept liquidity. Does it follow the trend? Yes. What is our trend? Our trend is bearish. We are waiting for a 1 minute now, break of structure, and a fair value gap reaction break of structure to the 1 minute. So if you just see it right here, there is a 1 minute fair value gap right here. See it? There is a 1 minute fair value gap right here, and I'm looking for a break of structure right now. So I'm marking out the lows right here. I'm waiting for it to break structure to give me a green candle and then a red candle. So I'm waiting for it. The new low is right here. I'm waiting for it to do a break of structure. It re-respected this fair value gap, or it just respected one fair value gap. It respected this fair value gap, but it didn't give us a break of structure. So the new low is right here. There you go. It broke structure to the downside, and this is on this candle, where this candle closes is where I would take the trade. Put my stop loss underneath this area, and put my take profit on these lows right here. Probably this low, the first take profit, and the second low. This low right here, and this low right here, right? I enter the trade. One, two, take profits, hit. And this is how it works. Why? Because I'm just following. I'm not doing anything different. This is what I'm using on a daily basis. This is what you can be using on a daily basis to be able to read the market easily and have a checklist that you follow easily and just basically The challenge right here becomes to wait and to have patience and to trust it. So this is an explanation of the 1 minute model. Hope this made sense to you. If you have any questions, feel free to comment them, so I will get back to you with a response as quickly as possible. So, as always, do a check-in. You know what? 1 minute model. Do a check-in of what you've learned through the strategy. I'm not removing these lessons, by the way, so you can screenshot them, download them, keep them at your computer. You can just save the link and just rewatch them over and over again, and just try it out for yourself until you get the habit of entering these ways on the 1 minute model. So write one sentence of what you understood and what you learned from this lesson. And follow me on YouTube if you haven't done it already. Follow me on Instagram. And if you're not inside the community, feel free to join. Talk to you in another lesson. Have a great day. Welcome to this video and this lesson explaining the school run model. This model is used for you during the London session and the New York session. I didn't structure this video because I want this to flow out naturally without me losing any information. So I'm going to jump directly to the chart and show you how it works. So basically, the first thing you want to do is you want to come to the market. I just marked out the London session because it's easier for you to understand this. Basically, what you need to understand is one, use this as a checklist. Mark out overnight range, 50-minute candle, 15, 1, 5, stop loss, fair value gap, high or low. All right, I want you to keep these things in mind. So in the school run strategy is dependent on the accumulation that's happening over the overnight range. So if you're trading the London session, we are putting heavy value on what's happening during the overnight range, the accumulation. So the first thing we do, we mark out the London session open. Now, it says it's on the 10 o'clock, but this is wrong. It should be on the 9 o'clock because it's summertime, winter time, and it's changing. So 9 o'clock is the London session open at UTC +1. All right, just forget about that. The first thing we do is we mark out the overnight range. So we mark out the overnight range, the high and the low of the overnight range. We also mark out in this case, it will be the 9 o'clock. So the overnight range is not here. This is the overnight range. There's a high and there's a low of the overnight range. So that's first thing first. We marked out the overnight range, right? I want you to keep in mind the candles. So a positive candle, let me just write this down. So positive candle inside the range equals bearish. A negative candle inside the range equals bullish. Copy this, screenshot this. There are two candles, right? There's a green candle and there's a red candle. Inside the range, if the candle, let me just show you. If there is a positive, meaning a green candle, meaning a bullish candle, inside the range, you switch directions of them. I don't know how I should make this. Let me just draw it for you here. So this is the overnight range, right? This is the overnight range, right? And this is the market open right here. There's a market open right here. Tick, 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 beside, because I used the green, yellow color. And if there is a negative candle inside the range, you switch direction. It means that it's going bullish because the sellers are coming in and the banks and institutions wants to take them out because the sellers are coming in hoping that the market will go low. This is only inside the overnight range. If there is a positive candle, there are buyers coming in. And what does the banks and institutions want to do? Want to go to the opposite direction. This is a good thing to keep in mind, and because that's how the banks and institutions are thinking. So, but if the negative candle is outside of the overnight range, what does that mean? That the sellers are dominant in the market, and the market is going to continue bearish, right? The same thing goes with the if the candle is closed over the overnight range, this means that the buyers are dominant and the market is continuing bullish. I just want you to think about those things here. So, what's happening right here in the market? The 15-minute candle, we can use the 15-minute, we can use the 5-minute, and we can use the 15-minute. I go with the 15-minute. Why? Because it's the perfect balance between the 1 hour and the 5-minute. The 5 minutes is way too quick. It can reverse the market. And the 15 minutes is the perfect time frame for it to indicate where the market is going. That's why I'm using the 15-minute. And it's been working for me for so long. So what does the 15-minute candle do? Let me just do a bar replay. I'm waiting for the 15-minute candle to close after the market opens. So I'm waiting for 50-minute candle to close after the market opens. And where does it close? It closes underneath the overnight range. And this is basically how I do it. I'm entering directly on the candle close of the 15-minute. I'm waiting for the seconds to tick and I'm taking the trade right here. So where do I put my stop loss? Because there is heavy pressure on the fair value gap right here. There's an imbalance in the market. The market usually wants to come up, take out this imbalance, and continue bearish. So where do I put my stop loss? I put my stop loss usually when I enter right here, usually over the fair value gap or over the liquidity right here. So in this scenario, I will be putting it right here, right? And I take my profit in this area right here, take my profit right here, or maybe right here also, right? Sometimes I just leave it. I just leave it continue downwards or this area right here, right? So we take the trade, I take the trade, I wait for it to happen, and voila, it goes directly down to the market. Now, this is how it works. There's a stop loss, fair value gap, and high or low that needs to be adjusted. So because the candle closed outside the overnight range, it means that it's going to continue bullish, bearish, excuse me. All right. To the next example, let me show you. I've marked out a lot of examples here so you can get a sense of how this works. So the next example right here, start anew. We come to the market, right? We mark out the 9 o'clock and then we mark out the 8 o'clock. Then we mark out number 1, the overnight range. Where is the high and the low of the range? This is the high of the range and this is the low of the range, right? From the Asia session overnight range. And what are we waiting for right now? We're waiting for the 15-minute candle. We're always on the 15-minute. We're waiting for the 15-minute candle to close over the overnight range. And I also forgot to mention, where is the trend taking us? We have to see a break of structure happening in the overnight range, either to the upside or to the downside. So in this scenario, there is a break of structure going to the upside. So our trend is bullish. And we jump back to the 15-minute and we wait for the first 15-minute fair value gap candle to close. Let's wait for it. The first 15-minute candle closed right here, but what are we seeing? We are seeing a 15-minute fair value gap right here. So what do we do? Do we take it directly? We can take it right here, put our stop loss underneath the body of the candle, or to be sure, we can put it underneath the body of the fair value gap candle. All right. And what do? We put our take profits right here on these highs on these highs right here. Okay, and then we take the trade. 1, 2, 3. It retested. It respected the fair value gap right here, and now you can see the reaction happening to the upside. Let me just, and there you go. It takes out our take profits right here, and we're done for the day. Let me show you another example. This is what we do. We enter the market. See, now it's summertime. You mark out the 8 o'clock and the 9 o'clock, and you watch where is the break of structure happening, either to the upside or to the downside. There's a break of structure happening to the upside right here. Break of structure high, close over the body of the candle on the 1 hour. We jump down to the 15-minute and we mark out the overnight range right here. 1, 2, and we see that the overnight range ends at this area. So we wait for it to close on the first 50-minute candle. In this scenario, I will probably take the trade on the 5-minute candle close. See, it closed the candle right here, a bullish candle. It indicates that we're going to the upside. Now, you can see that there's a fair value gap happening right here, and the market is more likely, because the candle is so small, the market's more likely to go down, take out this fair value gap, the 50% mark, and then continue to the upside, right? So if I put the stop loss right here, which I could, it will give me a too tight of a stop loss. So I usually go to this area right here. I don't want to go all the way down here because, and also there's a fair value gap right here. This might take you all the way down here, take out this fair value gap and continue up. So in this scenario, I want to risk less. I want to adjust my risk accordingly. And I put my take profit right here on this high right here, or some profit taken on this high right here. Right? I enter the trade, see what a market does, and there you go. Takes out two of my take profits. And what do we do when you hit our first take profit? I put my stop loss to break even. There's a stop loss I put right here. I put my stop loss to break even and I move it right here. So I'm still in profit. All right, that's one example. That's two examples. Let me show you some more examples so you can get a hang of it. This works also. This works also on the New York session. And this works best on the DAX and the NASDAQ. That's what I've been trading for so long, and it's made me, it's helped me a lot. So now, again, we mark out the 9 o'clock open and we mark out the 8 o'clock open. I'm just doing this repetitively, if you what you say. I'm repeating it over and over and over again because that is how trading is. And I'm showing you the system that works over and over and over again. This is the model. I'm not going to use the word strategy anymore because strategy is the whole thing of trading. Strategy is how you use your model, your risk management, how many trades you've taken a day. That's the whole strategy of the game. There's a model like a cookie cutter that you apply to the market over and over again and you take profits from it. So you see, if you go to the 1 hour, you see that there's a break of structure happening to the downside. So it indicates that the market is going down. Now, then I jump to the 15-minute. I mark out the high and I mark out the low, right? And now this, I'm waiting for the market to open and I'm waiting for the first 15-minute candle to close after the market opens. So the candle closed under the overnight range, not over, under the overnight range. And this indicates to me that the market is going bearish. Now, there's a fair value gap right here. We should think about the fair value gap at all times because this is what the market usually does. It goes up, takes out the fair value gap and continues down. So I'm putting my stop loss over this area right here. You can see that this gives me a 126 point stop loss. Now, in this scenario, I will do something different. Let me show you what I would do. In this scenario, I would take my stop loss to this area right here, right? I will reduce my risk and I will put my stop loss, my take profit on this area right here. And I'll take the trade. Why am I doing this? Because the stop loss is way too high. Or the thing I can do also, I can wait for the market to retrace back up and take it from the fair value gap down. All right, so let's see what happens. I'm gonna jump one step. So in this scenario, this is what this is what I would do. So in this scenario, you see that the wick of this candle would go up, and this is where I would take the trade on the body of the candle right here, on the top of the body of the candle, and put my stop loss underneath the fair value gap. So it gives me a 100 pip stop loss, but it still can give me a 1 to 5 because I'm taking my profits right here. So I'm taking my profits, I'm taking the trade, and it directly goes to my take profit. See, it re-respected. It re-res and not re-respected because it only did it once. It goes down, it takes out the liquidity right here, it continues all the way up, respects the fair value gap again, and continues down. So if you've missed this trade, you can always take the trade from here and put your stop loss underneath this high right here. Right? It works. It really does. And put your take profit on this area right here. All right, I'm not going to show you way too many examples. I'm just going to show you the last example right here and see what happens. All right, let's just speed it up. All right, so in this scenario, you can see that this is on a 1 hour time frame. We marked out the London session open at 9 o'clock and pre-market London session open at 8 o'clock, right? There's a break of structure happening right here, but the last break of structure closest to the market open happened on the downside. So what does this tell me? It tells me that the market is going down. This is, by the way, how you set your bias. This is, by the way, how you set your trend of the day, right? What do? I jump back to the 15 minutes. I mark out the low and the high. I wait for the first 15-minute candle to close. See, it closed exactly underneath. So I'm taking the trade directly from this. And also, there was a fair value gap right here before market open. And what did it do? It respected the fair value gap. It respected the fair value gap and took out the, not the 50% mark, but it took out some part of the fair value gap. So what do? I put my stop loss underneath this area right here, and I put my take profit on this low right here, probably this low right here. This or this low right here. This low right here. I take my trade, I wait for it, and it takes out my take profit. Right? Does it make sense? A checklist needs to be done here. First thing you do is to mark out the London session, market open, and pre-London session market open. You mark out the overnight range. After you mark out the overnight range, you wait for the first 15-minute candle to close. If you work a 9 to 5, this is a perfect system for you because you have to have patience with it. And you don't need to be sitting next to the chart all day. The only thing you need to do is like this is so easy. Really. Then let me just show you. You come to the market, if you're at work at the 9 to 5, you come to the market, all right, you mark at the 9 o'clock. You can't take the trade before 9:15. 9:15, market opens at 9. 9:15 is when the candle, 50-minute candle closes. That's when you have an indication of where the market is going. So before you come to the market, Let's say, you know what, you're at work at 8 o'clock at the office. 8 o'clock at the office, this happens. You drink some coffee, you talk to your colleagues, you do this and that, and then it goes, a half hour goes away, and then it's 8:30. You can see that it's 8:30, 8. You can see, you can come to the market, you can see, you know what, the market is bearish right now. Let me mark out the overnight range. You do this, you mark out the overnight range, and then you set your alarm at 9:10. All right? Then you come to the market at 9:10. So you come to the market at 9, what is it? 9 o'clock, 9:05, 9:10. 9, you're here next to the market at 9:10, right? So you have 5 minutes to decide how much you can risk. How much are you willing to lose on this trade? Not win, lose on this trade. Because we're always thinking in how much can I lose, not how much can I win. So you're waiting for 5 minutes, and when the 50-minute candle closes, you just enter the trade right here, put your stop loss over the high, and you mark out your take profits that is fixed on the liquidity, and then you leave. And then you leave, and this is what happens. You leave, and this is what happens. Right? I'm jumping now to the 5 minute. You wait for it, you wait for it, you wait for you're not checking the market. So you come back at 10:40, an hour and a half, basically. After you've taken the trade, you come, you look, you see that it's taking your profit. And you don't need to do anything because this strategy requires more patience than a 1 minute strategy. All right, that's the explanation of the school run model. If you got some value out of this, feel free, if you learned something out of this, feel free to check in. What made candles? What did you understand about the school run model? All right, lesson check-in. What did you understand about the school run model? Just write one sentence, that is enough because it keeps you actively learning and pulls out the things that you learn from this lesson right here. And as always, follow me on YouTube, Instagram, and if you haven't done it already, join our school community. All right, take care and see you on the next lesson. Bye. Hello and welcome to this lesson where I'm going to talk to you about when to take a trade. Because the market is so big, right? The times, the symbols, what do we trade, when do we not trade. I'm going to share with you when to take a trade, and I'm going to explain two things. Waiting for confirmation, that's the baseline of when to take a trade. Aligning with the market structure, it needs to follow all the stars need to be aligned for you to take the trade, and entering only when the setups is clear. This is, I'm saying this, for me, this is just second nature. But for people starting out, this is not, it goes over people's heads. So we talked about before, when is the ideal time to trade? We trade the ideally between 9 o'clock and 11 o'clock, right? 2 hours, 2.5 hours. So after that and before that, we don't take trades. We don't take trades after and before that. So I want to just show you the strategy on the 1 minute model to use as a perspective on how to take a trade and how to not take a trade, basically. So we have a checklist and we need to follow. This checklist is a confirmation of what we want to use as an indicator. We don't need to use indicators as an indicator for ourselves where the market is going and where to enter and how much risk I need to put in to enter on this trade based on how good it looks, basically. So we can use, you can just screenshot this checklist if you like, and I'm just going to show you. So we come to the market, it's 9 o'clock, we see, oh, so it's done a break of structure to the upside. We are bullish right now. Let's mark out the 1 hour liquidity right here, and let's mark out the liquidity on this side right here. So I'm waiting for the market to sweep this um, ah, to sweep, what did I do now? My apologies. to sweep these liquidities, and continue up, continue bullish, because this is what the market is indicating to me. So I jump to the 15-minute time frame. I'm watching. So I'm watching for the market to happen, to do his thing. I'm seeing that the market created another 15-minute liquidity right here, and this is what I mark out with a yellow because it's after market open. And I'm still waiting. I'm still waiting. I'm still waiting. I'm still waiting for a liquidity sweep to happen. It created another 15-minute liquidity right here. I'm still waiting. I'm still waiting for the market to sweep out liquidity before doing anything. I'm still waiting. I'm still waiting. I'm still waiting. And now the market just swept liquidity right here. It swept liquidity right here. So the trend is correct. Liquidity on the 15-minute is correct. I'm waiting for a break of structure and a fair value gap on the 1-minute. So I jump to the 1-minute, and what do I see the market doing right now? This is such a beautiful trade. You can see that it created a break of structure, right? It created a fair value gap right here in this area right here. Maybe it creates a fair value gap right here. We'll see. It created another fair value gap right here. So we are waiting for, we have all the confluences, all the confirmation that the trend is bullish. Liquidity has been swept on the low, which indicates that it's going to reverse to the other direction, bullish. We're waiting for a 1-minute fair value gap reaction. We have already we have this. It's already created a 1-minute break of structure. What does the market do? It didn't give us a reaction to the downside. There we go. See, there's a fair value gap right here. It's reacted off of it, and this is where we enter. We enter at this low basically right here, and we put our stop loss on this area right here. So this is where we enter on this trade, and we put our take profit on this high right here. So in this scenario, we're waiting for the market to do its thing, and it takes out our take profit. Now, takes out our take profit right here. Now, is there something wrong with this trade right here? There's just one thing I'm thinking about. We ended our trading session, if you look at the time right here, we ended our trading session at, let's say, at maximum 11:30. We don't want to be sitting next to the chart all day because we get fatigued and our decision making doesn't become good. This is it. This is the area where we do take a trade. Let me just waiting for confirmation, align with market structure, entering only when the setup is clear. We're entering only when the setup is clear. There is no setup clear right here in this area where we usually want to trade. Whatever happens after that, we are not even sitting next to the chart. We're not even looking at the chart after 11:30. So how perfect the strategy or the model or the entry might have been, we don't take the trade. Why? Because after these hours, the market is not volatile as we usually trade in. The market doesn't respect our strategy, or our strategy is not respected by the market as well as it does between 9 o'clock and 11 o'clock, 11:30. So we want to use the ideal time to trade between market open and 2 hours after that. I'm thinking about London and New York session also. So I didn't just say 9. So this is what you want to do when you take a trade. You want to wait for confirmation. You want to wait for every confluence to be checked before you take the trade, because that some people, honestly, this is what they do. All right? They see a liquidity sweep. That's it. They see a liquidity sweep like here. Now don't think about the time. I just want to show you an example. They see a liquidity sweep happening right here. The market just swept liquidity right here. And the only thing they're waiting for, because they have the trend and they have the liquidity sweep, the only thing they're waiting for is a break of structure. Did it break structure right here? It broke structure right here. And what do? They enter off of a break of structure. Now you can do that. That is fine. But the probability of it to reverse to the downside and take you out is higher. That's why we want to enter on the fair value gap, because there is higher probability for it to give us a reaction on the fair value gap and then continue to the opposite direction. And this is just confirmation for us that the trend or the trade is aligned with our setups. All right, and then we mark out the take profit right here. Now you get more profit, of course, but it's not, the probability of it going that direction is not higher than if you're waiting for, if you've waited for a fair value gap reaction. So you can tweak and adjust, and that's what defines the best traders, the good traders that I see, because that's what I did. I created my own. I created what works for me and what satisfies me. I have two different models that I'm using. I have the model on the 50-minute, and I have the model on the 5 minute, on the 1 minute. So I'm using both of them. Why? Because sometimes the 1 minute model doesn't appear and the 15 model appears, and sometimes the 15 model appear and not the 1 minute. So I want to take advantage of the win rate of both of them. That's why I applied two systems and I made them my own. I I I, I made it work for me, basically, is what I'm saying. So that's what you can do. You can watch other people and watch other people's strategies and remix it to your own and what works for you. All right, let's do a short recap. I explained to you that waiting for confirmation is so important. You can use a checklist. Just screenshot the checklist that I've been using and use that. Just check off the checklist, and where they're all checked off, you apply risk and you enter the trade. Entry only when the setup is clear and during that time. If you trade from market open and 2.5 hours after that, only find the setup during that time and not after or before. This will give you a higher probability of your setup working out. So as always, do a short check-in of what you've learned. Learn. Do a short check-in of what you've learned during this lesson. And as always, follow me on YouTube, follow me on Instagram, and follow the school community and join the school community if you haven't done it already. Talk to you in the next lesson. Have a good day. In this video, I'm going to be explaining to you when to not take a trade and how to not take a trade. So let's jump directly into the market, into the chart, and I will show you how this works. So we come to the market, right? We mark out the 8 o'clock pre-mark. No, what is this? The 9 o'clock market session open and the 8 o'clock pre-market session open. So what does this indicate for us? This indicates that we are going bullish, right? Because there's a break of structure right here, it indicates that we are going bullish. So what do? We switch our bias and we think, you know what? This is about to go down in reverse. Why? Because the market is going like this. The market is going to do like this. It's going to continue down. It doesn't work that way. You have to see the candles closest to market open and where they are indicating that you're going. Are we going to the bullish side or to the bearish side? This is how not to take a trade 1. So how to not take a trade 2, you're still under the perspective that the market is going down. So what do? You mark out the highs on this area right here, because you just change your bias. The trend is not set. You're not confident with your trend. So what do? You wait for the 15-minute candle to close. Sorry, you wait for the liquidity to be swept, and this is where you're changing your bias. Your bias is going bullish, but you're taking a trade to bearish. You're taking a short. So what do? You wait for it to do a fair value gap. So it did a break of structure right here. We're waiting for it to do a fair value gap. It didn't do a fair value gap. and you say, you know what, because this is bearish, let's take a trade right here. You just jump into the trade right here and put your stop loss right here. You say, okay, that's fine. The fair value gap is about to be created. The breakup structure is about to be created. We don't trade that way. We observe something happening and then we react from it. We don't, what do you call it? We don't speculate what's going to happen. It's like the heart monitor, right? The heart monitor, if you go to the hospital and you connect the heart monitor, you see the chart going up and down of your heartbeat. The same thing goes with the chart. We're reacting of it in the live environment. So what does the market do? This can easily just be a take profit trade, but it doesn't work that way. See? You can get lucky, of course. Anybody can get lucky. And it takes you out. And because it takes you out, you say, you know what, let's go and try it again. Let's try it again because this is what happens. We are trading like the banks and institutions. It took out our liquidity. Let's enter again and put our stop loss on this area right here. And you enter again. What happens? You can get lucky. It takes you out again. And you say, you know what? I know this is what is called a fallen knife, but to the upside, right? Fallen knife meaning a knife falls and you're trying to catch the other direction and you're keep hurting yourself. And then you say, you know what? It just needs to take out this liquidity right here and I can take the trade right now. You take another short, and this is what usually blows accounts. You take the trade again, and this is what the market is doing. You can get lucky. You can really get lucky. See? Let's speed it up. It really doesn't matter. And you're sitting next to a chart at 12 o'clock and nothing had happened. So basically is what I'm saying, make sure that the trend is correct, the liquidity sweep is correct, your breakup structure is correct, your fair value gap entry is valid, you have a proper risk management strategy, you have a proper risk reward to your profits, so you don't take trades that are too high in stop losses and too low in profits. Right? This is when not to take a trade, and this is how not to take a trade. Make sure that's why we have confluences. We have confluences, right? Like these to be checked out. Check, 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 check. School run, check, check. This is when we take the trades and when we not take the trades, and we have to learn to sit in that feeling of boredom. I'm being bored. I'm sitting next to the market all day. Should I just enter out of boredom? No, because the checklist doesn't allow that. And that's what we follow on a daily basis. We have a checklist, a cookie cutter to follow, the model to follow on a daily basis. So this is what gonna bring us the satisfaction basically of entering the market, not winning or losing, the satisfaction of doing the system repeatedly. You know the saying of it's the journey that is the goal, not the destination, right? But it really is true. You have to take the first step to be able to get to the destination, to get to the goal. Sorry. So the destination is following the checklist. All right. Make sure that you check in to this lesson. What did you learn in this lesson? And as always, just write one sentence and share it below because it will make you learn even more and get stuck in your head even more. As always, follow me on YouTube, follow me on Instagram because I share things there that I don't share on this course. And if you haven't done it already, join the school community. The link is in the bio somewhere. Take care and see you on the next lesson. Have a great day. In this video, I'm going to explain to you stop loss placement. So I'm going to talk about three things. Why every trade needs to have a stop loss, placing stop loss at logical levels, and protecting capital when the trade is wrong. So the biggest mistake you can do as a day trader is to enter the trade without having a stop loss. I see people talking about having a mental stop loss, and then exiting the position right there. So when we trade, we use these tools, right? We use a long position and a short position. And when we take these trades like this, when I take this trade right here, right, I want to put my stop loss as the in the most logical level of where the market might return to and take me out. All right, the market can might as well just play during in the stop loss area and then continue to my take profit. And the stop loss that people have as a mental stop loss, for me, it doesn't work. Why? Because I want to take a trade and I want to have a fixed stop loss, fixed on my MetaTrader 5, and I don't want to have to think about it because it's already too heavy thinking about the trade and take profits and how the trade will move and what we need to do with the trade and the emotions. I don't need to think about the stop loss because when the stop loss get hit and you have a mental stop loss, it's so easy. It's so easy to just leave it and not take out your, um, not close your position and have your stop loss going from taking a $400 loss to a $580 loss because you wasn't quick enough. I don't want to be doing that. So where do you put your stop loss? In areas where there are liquidity, liquidity high and low, fair value gap, 5 minute or 15 minute or candle. It all depends um, on what strategy you use. So on the 1 minute time frame, we usually put our stop loss under the liquidity. So let's say if I take this trade right here, just give you an example. If I'm taking this trade right here, right? If I'm taking this trade right here, I'm on the 1 minute, I'm waiting for it to sweep liquidity. Let me just show you a quick way on how you can put your stop loss. You put your stop loss on this area right here. Doesn't matter what the market is doing right now. If I'm taking this trade right here on the fair value gap, right? I don't want to put my stop loss underneath this fair value gap. I want to put them because you can put this stop loss right here. Why? Because there's a fair value gap right here that can be respected. There's a fair value gap right here that can be respected. And if you are proper risk manager, you can basically put your stop loss on this area right here. Why? Because it already respected this fair value gap and it can give you a better risk reward. Now, does it happen? It might happen. This can give you a 1 to 4 risk reward, but usually we put our stop loss during on this liquidity right here, where the liquidity lies. Because where does the market want to do usually? The market wants to go usually down to liquidity and take you out and then continue down. So we put our liquidity, we want to give the price the opportunity to be in the stop loss area, maybe respect this fair value gap and then continue up. My apologies. If you have liquidity right here, this is what the market usually wants to do. It wants to take out the liquidity and then continue up, not down. I wasn't correct there. All right. So this is where we put our stop loss. We don't want our stop loss to be way too big because if your stop loss is way too big, that means that your take profit needs to be even bigger. And it's not probable for it to go all the way there because your stop loss is too big because you're too scared of losing. So your stop loss need to be at the proper area, like liquidity, fair value gaps. And I've learned over the years that I can put my stop loss on these areas right here because see, there's a fair value gap right here, right? If I take the trade right here, I usually put my stop loss on this area right here. Why? Because I'm counting in that the market might go down to this area, take out this fair value, get respected, and then continue up. Now it didn't do that. So this is where the proper stop loss would have been for me, not all the way down here, because all the way down here will give me a huge stop loss. and the market can still go down and take me out. So I'm willing, sometimes, not always, based on how the market is looking, willing to go all the way down to this area right here because this is a low and this is a fair value gap. The market can go down, take out this fair value gap, and continue to the upside. That's basically it regarding the stop loss and the stop loss placement and the stop loss areas. So on the school run, the same thing goes there. If we have a school run, let me see here. You know what? Let me just give you an example of a school run strategy. So let's say this is the overnight rate. This is the fake school run strategy. Let's say this is the overnight range, right? And the first 50-minute candle closed underneath this um, overnight range. And this is where we entered the trade, right? We entered the trade right here. You can see that there is a fair value gap created right here. In the school run strategy, this is what we do. We put our stop loss over the body of the candle where the 50-minute fair value gap is created. We can put it here. That is fine, but we can adjust it. So our stop loss will not get to 121 points. We can get it to 74 stop loss, and our take profits will be on these areas right here. Do you see what I mean? So we don't have a way too huge stop loss, which will give us a way too huge take profit area, which will never get hit. All right, that's about it regarding the stop loss area. Write a short explanation of what you learned. One sentence is enough to check in on this lesson and share it below. And as always, follow me on YouTube, follow me on Instagram, follow me on the school community and join the school community. And on YouTube, I share content there that's outside of the course, but is still trading related. So feel free to follow me and subscribe to the YouTube channel and watch the videos I have over there. All right, see you on the next lesson. Take care. Welcome to this video and this lesson where I'm going to share with you how to take profits and where ideally you want to take your profits. So I'm going to jump directly into the chart and show you an example that would make more sense to you. So what do we do? Based on the strategy we are using, we usually focused on liquidity, right? Trend first and then liquidity to be swept. This means that liquidity is the thing that reverses where the market is going because that's where all the orders are. The banks institutions are chasing liquidity. They are a magnet to liquidity. So where do we want to put our take profits? We want to put our take profits on liquidity, where liquidity lies, and we also want to put our take profits on where fair value gaps lie, because that's the highest probability of where the market wants to go. So in this scenario right here, you can see that the market is sweeping out liquidity. So it doesn't matter where you came from and where you took your trade. So if you took a long right here, right, where is the highest probability of the market to go to? To the liquidity, right? So even if forget about the setup. If the market just open right now, like some people just do this. I know one person just doing this, right? He comes to the market, he sees, you know what? This is bearish. Okay, because this is bearish, I want to go the opposite direction of the market because I'm thinking like the banks and institutions, and I want to go to liquidity. So exactly when the market opens, what does he do? He marks out where the liquidity lies, this area right here, this area right here, okay? And when the market opens, he's not even thinking about it. The market opens, and the first candle that closes, he enters here, and he puts his stop loss on this area, and he marks out the liquidity right here, and marks out the liquidity right here. So what does he do? He's chasing liquidity. So that's where we want to put our take profits. Let me just show you example of this. It's going to be Swept a bit, and this is the first liquidity that's been swept. Now, liquidity is where we want to take our take profits. Why? Because that's the highest probability of where the banks and institutions want to take, because that's the where the banks and institutions make their money by taking out liquidity. They are the whales, we are the small fishes, and the whales want to take out the small fishes that lies over the liquidity. So in this scenario right here, it swept liquidity, right? It swept liquidity. It broke structure. It gave us a reaction to the fair value gap. We entered this trade right here and put our stop loss on this area right here. So we entered this trade, right? And this is where we get nervous. Oh, the market is going down. Where do I take my profits? You jump back to the 15-minute because that's what we do. We take our trades on the 1 hour and the 15-minute liquidity sweep. Okay, so we mark out our take profits on these lows right here because this is liquidity. There is liquidity lying down here, there is liquidity lying down here, and there is liquidity lying down here. Okay, and this is what the market, the banks and institutions usually want to do. They want to take out these liquidities and then continue up if the market is bullish. Or no, sorry, it doesn't want to continue up. There's a high probability of it continuing up. So we want to take the profits on where the highest probability of the market to take us to. So we jump back to the 1 hour, 1 minute, and this is what we do. We wait for it to sweep the first take profit right here. When it sweeps the first take profit right here, we move our stop loss to break even, which means 50% off. On the first take profit right here, we take 50% off of our position and we move our stop loss to break even. Stop loss, stop, stop loss to break even. What does this mean? Because we usually have our stop loss right here. We just move it, stop loss to break, we move it after it takes out our first take profit to break even. Why do we do this? Because it's a higher probability of the market to sweep liquidity and then continue up and takes us out. And that is okay if it takes us out. Why? Because we are zero into the position. We have nothing to lose anymore inside of the position, and we have already taken our first take profit. And we put our second take profit on this area or this area right here. Right? So we wait for it to do its thing, and it takes out 1, 2, 6. There we go. It takes out the other take profit right here. So to have it not mixed up, I have a position size calculator fixed inside of take profit, and I also put this inside of the course where you can use for free. I've had this accustomed to me to 1 to 3. So when you take a trade, look at this. It sets the stop loss based on the take profit, right? It doesn't fix it at the liquidity areas, but when you take a trade, let's give an example. There's a demo account. I take a trade right here. I hide the lines. I close this window and I move because there is liquidity line all the way up here. I move my take. This is my take profit. TP, TP. I have two running positions. So if I close this one trade, it closes 50% on my position. If I close the other trade, it closes 50% on my position. All right. And my stop loss is right here. You can see now I'm going to move my stop loss. You can see that there's two stop losses because every position have one stop loss. See how it works? So taking a trade like this will make it, let me just show you because it's cleaner on the chart. Taking a trade right here, we are marking out the take profits on this area right here, just as the as the MT5, and we jump to the 15-minute and we see what is this? This is the high of this candle. This is the liquidity line over here, and this is what the market is doing. See, it goes goes up, it creates liquidity, it goes down, then it continues up, takes out liquidity, and it goes down, and it goes up, it takes out liquidity, and then it goes down, it goes up, maybe it takes out liquidity again, and then it goes down. And we want to be on this area right here, where we want to take liquidity, take our profits right here. That's a good example, and I really recommend you using the position size calculator, where you can insert it into um, the chart so it can count the risk for you automatically. You're risking 0.5%, 1%. You can just move your lines and it adjusts your take profit and your risk and your TP where it should be set automatically. So I have this set to 1 to 3. You can just change it in the settings. And you can also have different positions where you can change it in the settings also. All right, that's about it on how to take profits. If you learned something from this lesson, feel free to check in what you've learned in one sentence, and that is enough. As always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. Talk to you in the next lesson. Have a great day. Hello, and welcome to this lesson where I'll be talking about backtesting and forward testing. So let's jump directly into the chart. You might see me using the replay mode right here. So let me just remove this session. So what you want to do on the replay mode, which is a good tool, is you want to be able to backtest your strategy and have some data on if it works or not. So the strategies I've been sharing with you, the school run strategy and the 1 minute model, the school run model and the 1 minute model, you can try them out in the backtesting replay mode. So what you want to do, you want to go to the replay mode right here. Let's go to the 1 hour. You go to the replay mode right here and you go back some time. And this is where you can choose the 7x, 5x, 1x. And I usually backtest on 0.2 to make it seem like it's a live environment, to make I practice my patience basically in the backtesting session, right? So you can use this tool to indicate like where is the market going. You can jump forward like this, skip forward with shift and arrow to the right, and you can also just press play and wait for it to happen. You can try it out. You can indicate or you can simulate how the real market is going to be. You can go back for an entire month and use the strategy or the model that I've been using, explaining to you, and try it out. How does the model work on the London session, and how does the model work on the New York session? And try it out. Now, after you've tried it out on the back testing, I put my stop loss right here. This is what Mustafa said. It will work. I tried it out, 1, 2, 3, but it didn't work. So what's going on? We write it out. We see data. How many times is it working a week? How many times do I have A plus perfect setups each week? Do I have 1? Do I have 4? Do I have 5? And how much can I gain from those setup each week? That's what backtesting gives you. It gives you confidence in your ability to execute on the model. Now, after you have that confidence, there is a forward testing period that we need to do also. Backtesting tests our model that it works, right? So we don't need to do it on the live environment. Live environment, it takes longer. You can backtest in the live environment for 6 months, which you can do in 2 days on a backtesting session, right? So the forward testing right here, it tests. So backtesting tests your model. Forward testing tests you, how you behave in the process of executing on that trade. So this is what I want you to do. I want you to download, just use something like this. VT Market, you download the demo account. Let me just close these. Download the demo account and indicate how it would look like in the live environment. Take the trade, see the setup, apply risk, apply the stop loss and the take profits, and wait for, and you see the profits right here. and wait for it to do its thing. And think about it. Have a note, have a journal, and you think about when I take a trade on the 15-minute, how am I feeling? That's the forward testing part. How am I feeling? Am I getting stressed? Am I getting upset? Am I getting hurt because I didn't win that trade? What's going on? That's the thing. How is your patient? How is your greed level? How much are you risking with this strategy? That is the forward testing of this back testing data that you have created. So when people say, have you backtested it? Meaning, have you backtested the strategy? Probably most of the people have backtested their strategy because that's the one that they're using in the live environment. But in the live environment, that is when fear, greed, anger, revenge, those feeling comes up in you, and you have to notice them because those are the feelings and emotions that we were going to be working on to overcome to be able to win over the market basically. So if you've learned something from this lesson, feel free to write it down as one sentence in the comment section below because it will stick with you even more. So when you backtest, there is backtesting and there is forward testing. Forward testing is used in the live environment, backtesting is used in the simulated environment. As always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. See you on the next lesson. Take care. Welcome to this video where I'm gonna talk to you about the trading checklist. Why the checklist is important, I'm gonna talk about three things. What the trade checklist is, why it's important, why the checklist matters, and what you need to check, or what we need to check before entering a trade. And this is basically, we're gonna do it together checklist. We're gonna do a checklist for the 1 minute model, and we're gonna do a checklist for the school run model, right? So I'm using a pilot as a metaphor. When I was younger, I wanted to be a pilot. I did the tests, they show you what do you they show you three boxes and then four boxes and then five boxes and they asked you what is the box that's going to be number eight, cognitive thinking and all these tests, but it cost a lot, so I didn't go forth and become a pilot. Um, but every pilot has a checklist, right? When the pilot enters the trade, there's a lot of things happening in their dashboard, but they have a checklist to check. Are the wings corrected? Are the other tires, I don't know, do they have air in them? How is the fuel? Are the fuel enough to take us to the destination that we're going to? What's happening? What's the weather? So they have a checklist that they're checking every time before they take off to fly. So the checklist that we're going to be using is is to keep ourselves in check basically, and we don't let our emotion take over. So a checklist keeps trading structured. That's what we need. We need to have a trading structured mindset in our trading. So when we have a checklist, this is what we trade. We trade in these preferences, right? We don't go out of these areas because we have a checklist. When we have a checklist, um, we can do those things. I don't know why it's not working too. Give me a second. So we have a checklist. So every condition must be there before entering. If one is missing, you don't trade. That's the same thing with the pilot. He has a checklist, and if the fuel is not there, he can't continue the flight. He needs to check it, he needs to readjust it, he needs to change it, he or she. Every condition must be there before entering. That's the same thing we do when we check the models we are using. If we trade the 1 minute model or the school run model, if one of the things are missing in the model, we don't take it. Or if it's a low probability thing like equilibrium. Equilibrium is a good way to define where the market is in premium or in discount. But if equilibrium is not there, do we still enter the trade or do we not? Is it how strict are we with the checklist that we're doing? So, um, That's my mindset behind the trading checklist. And discipline is connected to the checklist because when discipline comes in, it comes in through repetition. Because if we have a checklist that we know that we are that we are following over and over and over again, the discipline almost gets it becomes second nature to us because we're still following the process on a daily basis. We know eventually what we're looking for on a daily basis, and we know what works for us. And when you follow through on your checklist, the checklist replaces the ego. The ego, I don't want to talk about too much of this, but the checklist, ego, I'm talking about ego as the emotional part. So if we have a checklist, if we have something that we have to follow on a daily basis when we trade, it replaces the ego, the emotions, the feelings that come up when we take a trade. Should we enter? Should we not enter? Is this a good trade? Is it not a good trade? We have a checklist, we check everything off, and then we enter. Apply risk and then enter. Okay, why the checklist matter? As I mentioned, it removes emotions. You don't need to base it on feelings. It filters out bad trades. This is a very good point. It filters out bad trades because if the checklist is not marked out the entire way, there is no setup for us to take. So we didn't miss anything. We missed the trade by almost not following through on the checklist. If everything is checked and we still don't enter the trade, that's when we miss a trade. And it eventually builds confidence and trust in your process because you know what shows up on a daily basis and you know that we eventually will win by probability. So let's create a checklist together. This is one checklist for the 1 minute model, and I want to do this together with you. So, like, I've already done it. I didn't realize that I did it before, but this is how it works. We identify the trend opens, okay? We need to see a 1 hour break of structure before we enter the trade. You know what? Let me jump into the chart so we can do this together. Really do this so I can show you how this works. Let me jump into the chart. So the first thing on our checklist, let me add them here. This is a checklist. You can just screenshot this and use it. The first thing on our checklist is trend. Before market opens, 1 hour breakout structure. So before market opens, what are we seeing right here? Before market opens, is there a 1 hour breakout structure before market opens? So the London session opens up right here, and this is the 1 hour candle. We are on the 1 hour time frame. We're looking at the breakout structure. We're looking at the low right here. The candle of the low is closed over the body of this candle. We're seeing that this is a breakout structure, which indicates where the trend is going. So the trend is right now indicating that we are bearish. So the first thing of the checklist is checked like the pilot. I'm checking this off. The first thing, liquidity sweep 1 hour, 15 minute. Where is the 1 hour and 15 minute liquidity sweep that's being done? As I mentioned before, if the market is going bearish, the market usually goes up, takes out these liquidities right here, and then continues down. Let me explain it here. So the market, if the market is bearish, the market usually goes up, takes out these liquidities that are on these areas right here, and then continues down. So we are looking for the liquidities that's happening on these areas. So we are on a 1 hour. There's a 1 hour liquidity that's been swept before. There's a 1 hour liquidity right here. We've taken that. That's what we mark as a 1 hour liquidity. And then we jump to the 15 minute, and that's what we mark out as a 15 minute liquidity, which is right here at this area, right? This area and probably this area right here. I wouldn't put this right here because this is it's way too close to the 1 hour liquidity. So I'm waiting for these two to happen. Now, did we? That's how it works. Did we find? We found the trend. That's one. We found a liquidity sweep, a liquidity, not sweep. We found a liquidity on a 1 hour and 15 minute. There's a liquidity right here resting. There's liquidity right here resting, and we're waiting for them to basically be swept. If they don't get swept, we don't take the trade because it's not it has it, we didn't check it off. It didn't enter these areas. And then we go to the, you know what? Let's do that. Let's do that so I show you the example. Let's say this candle right here swept this liquidity. Let me change the color for it just to make it seem like it's the same candle, right? All right, let's say this candle went up and swept liquidity on this area, right? So I'm using this as a checklist. So then I drop down after it swept liquidity, I drop down to the 1 minute. Why? Because I'm following the checklist. What does the checklist say? Does did the market do a 1 minute break of structure? Let's see. So I'm defining the trend, that's one. Liquidity swept on the 50 minute, that's two. Is there a 1 minute break of structure? That's three. Did it do a 1 minute break of structure right here? It swept liquidity. Did it do a 1 minute break of structure? It did a 1 minute break of structure. This is not a very clean break of structure, but it's still a break of structure. But I will go with this break of structure right here. See, let me put up the checklist again. This is a hypothetical, so you can see what happens. So number one, trend is defined. Liquidity is swept on this area right here with this candle. 1 minute break of structure. Did that happen? There's a 1 minute break of structure happening right here. That is swept. On 1 minute fair value gap reaction, did that happen? There is a 1 minute fair value gap. Where is the fair value gap? In this area. So there is a fair value gap happening right here. That happened before the break of structure, which is also valid, and there's a fair value gap happening in this area after the break of structure, which is also valid. So I can either take the trade right here on this area or take the trade right here on this area. Both of them work. Why? Because there's a fair value gap reaction that's happening. I sweep that. And then at the end, based on the risk reward that you're looking for, I'm taking this trade right here on this area right here. I'm putting my stop loss over this liquidity right here, and I'm marking out liquidities as take profits on the 15-minute or the fair value gaps. Yeah. So there's a 15-minute liquidity right here resting. This is when I'm taking my profit right here on this area. I'm zooming in way too much. There you go. This is what the trade did. Let me jump into the 1 minute. This is what the trade did. It took out liquidity right here. Probably there's also liquidity on this area right there. So I'm taking 1 to 2, 1 to 2. There you go. This is how we do it because we follow the checklist. So that's on the 1 minute model. Let's jump to the school run checklist. All right. This is the school run checklist. Let's jump to the school run checklist right here. Let's remove all of this. I don't want this lesson to be way too long, but feel free to pause it and jump back and forth to be able to see what's correct and what's not and what works for you. So for the school run model, this is the checklist that we can be using. Trend defined before market open. Is there a 1 minute break of structure before market opens? So because because the school run, I don't want to make this way too confusing because the school run is happening on the 15-minute, the higher time frames as the 4 hour are important. Why is it important? Because we are on the 15-minute. 1 hour has four 50-minute candles in them. So before we can define the trend where it's going on the 1 minute break of structure that's happening before market open, but we can also define it through the 4 hour break of structure that's happening before market opens on the overall trend that's happening. So if we jump to the 1 hour right here, we can see or we cannot see basically where the trend is going, but we can see where the overnight range is. So on um, what is it? Where did I take this? Yeah, we can see um, on the higher time frame, on the 4 hour, we have a break of structure right here going down, right? We have a break of structure right here created after that. We have a break of structure right here on this low. If it's created or not. No, this doesn't count as a break of structure. But mainly, we have a break of structure happening to the downside, right? So if we jump to the 1 hour, we see that this is defined by the checklist. So we have market open right here. We define the low and the high of the overnight range. That's number one, because we have defined the trend. Okay, and then when we jump to the 50-minute candle, we wait for the first 50-minute candle to close either above or below the overnight range. That's number one. We have defined the trend, right? The trend is also, this might get a bit confusing, but the overall way of defining the trend is based on the overnight range. The overnight range, also in the higher time frames. So in this scenario, is not very clear, but it's still a bit clear, more clear than usual because we have a break of structure to the downside based on that. So we are using the 1 minute model, how do we define the trend, and the 50-minute model, how we define the trend. We use both of them. So we wait for the first 15-minute candle to close outside the range. The market open right here. We wait for the first 15-minute candle to close outside the range. That's what we're using. Have we defined the trend? Yes. Is the 50-minute candle closed outside the range? This is the first 50-minute candle. Yes. Direction aligned with trend. Is the direction aligned with the trend? So the trend is bearish. Is the direction aligned with the trend? Because if the first 50-minute candle is closed underneath this area and the overall trend is bearish, we don't take the trade because it can go up, sweep liquidity, and just continue down. So in this scenario, we take the entry basically not really here because this is way too huge of a candle. So we wait for the 50% mark. So we wait for the 50% mark of this candle to be entered on, and we enter on this 50% mark. We put our stop loss underneath this liquidity area or this fair value gap candle, and we take the trade out of either a fair value gap right there, and that's how we do it. We take the trade right here, or we take the trade on this 1 hour fair value gap that's happening right here. See, we checked off everything on the checklist. So that's how you can use the checklist to your benefit. I hope this video was not way too long. So I talked about three things in this lesson. A checklist keeps you disciplined. It keeps you disciplined because you don't need to think and overthink all these things about how should we enter, how should we do it. It's already set in the checklist. You just follow along on this checklist. It's like having a workout regime. You just follow the workout regime, and you know to the summer you will get the beach body, right? Number two, you only trade when everything aligns. When everything aligns to the checklist, that's when we take a trade. Consistency comes from following your process. That's what builds consistency, basically. You have a checklist, you're doing it over and over and over again. That's what's been focused on, how to build consistency. That builds the strength of consistency. And in the beginning, we all need discipline until it becomes second nature to us. Now, I've been doing this for so long, and I'm still using the checklist. Why? Because sometimes, we get a bit complacent and we get a bit, we need to have that reminder of, what am I following really? Like, because just to have, to wake ourselves up into the strategy that we're using. All right, lesson check-in. Take a moment. Take a moment to think about your biggest takeaway from this lesson. One sentence is enough. share it below. Share it below in the comment section below so you will start actively thinking about what you learned in this lesson. As always, if you like this video, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. Take care. See you on the next lesson. Bye. Hello and welcome to this lesson where I'm going to be talking about strategy mistakes that beginners usually make. So I'm going to talk about three things today: entering trades too early, ignoring market structure, overtrading without confirmation. So we have defined two checklists, the 1 minute model checklist and the school run checklist. So when we define these checklists, let me jump into the chart. That's one checklist for a 1 minute model, and the other checklist is for the school run model, right? So we have two models that we're trading. This is on a 1 minute, this is on a 15 minute. So the school run model takes more patience than the 1 minute model, but still we want to enter trades based on the checklist that we're seeing. So enter trades too early is one of the most too early, too late. We don't want to miss out the trade. Um, I want to show you some examples of this, right? Entering trades too early, entering before liquidity sweep, entering before breakout structure, entering without a fair value gap reaction. We're entering too quick, and also on the school run. So on the 1 minute, you know what? Let's jump to the school run directly because I see a setup here directly. So on the 1 minute, this is what it created, right? On the 1 minute, on a 15-minute candle. So I'm seeing a setup right here, right? The trend is defined before the market open. Has it done a 1 minute breakout structure to the downside? Is the trend defined by the market going down? You can see that it's done a breakout structure to the downside and it's continuing to the downside, and it's create a higher high, higher lows, higher high, higher lows, and it's basically going to create a higher low again. So we're marking out the overnight range here. There's an overnight range happening. There's a low right here, and there's a high created right here. This is the overnight range. Now, the first 15-minute candle that happened was that was the wrong, not this one. Let me give you a better example. This is on the New York session, right? This is the low, and this is the high of the London session, as called as the overnight range, because if you trade the London session, the Asia session is the overnight range for you. If you trade the New York session, the London session is the overnight range for you. So in this scenario, you can see that the trend is defined as bearish. We're going down, right? The first 50-minute candle closed outside the range. Now, this is the range that we are marking on a daily basis, on this overnight range. Did the 50-minute candle close within the market open? No. And this is what usually happens. Let me bring that back. Let me go to the 1 minute time frame. This is what usually happens. But where the mistakes happen. So you're waiting for the first 15-minute candle to close. Let me mark out the first 15-minute. This is the 3:45. You're thinking, you know what? Because it's making candles to the downside right here, let me enter to get a better entry. That's what happens. It hasn't closed yet the 15-minute candle because this is where it closes the 15-minute candle on 3:45. At 3:15:45 is the when the 50-minute candle closes, and this is what it says on our checklist. So because it didn't close, you say, you know what? Let me just enter this trade right here and put my stop loss on the underneath this area and my take profit right here on this liquidity area, right? So what did you do? You entered too early. You entered too early, and this is what happens. The market goes up, and it didn't close over the overnight range. It's closed inside of the overnight range, right? You can get lucky and still win this trade, by the way, but that's not following the checklist. That's not how it works because you can get unlucky and have the trade go the opposite direction, which it did right here. So what did it do? It continued. It took out our first take profit, which is a good thing, but that's not how it works. Because you're winning a trade, it doesn't mean that you're winning because this can we are relying more on the checklist than on our profit. We're not trading. When people say you're trading your P&L, we're not trading our P&L. P&L, profit and loss. If we are checking the amounts and we're happy because we made some money, and then it's the market is going to take it back because you don't have the habits in place of following the checklist. That's what's going to happen in the future. Trust me on this, because the P&L would just dilute your attention to other things. So what we need to follow, so this is the mistakes that usually people do. They enter too early. So we don't want to enter on this trade because the close of the 15-minute candle didn't close over the overnight range. So that's one example. Now, let me see another example on the 1 minute time frame. Uh, yeah, this is this is when not to take a trade. You can see that there's a liquidity created right here, and this is on a 1 minute model, right? Liquidity is created right here. We are bearish. Liquidity is created right here. We are bearish. We are going to the downside, and we're seeing that because the checklist says liquidity sweep on the 1 minute, 1 hour, and a 15 minute. We can't see that any liquidity sweep has been done, and we still enter the trade, right? There's no liquidity sweep. The market didn't come up and swept this area, and we're taking a trade from that. That is not how it works, because the market can most likely don't do a liquidity sweep and then continue to the upside, right? And take us out. So in these areas, because they didn't sweep liquidity, then again, you can get lucky. You can get lucky and the market can reverse to the other side. Because in this scenario, it gave us all of our confluences. You can see in this scenario, trend defined. When a 1 minute break of structure defined right here. Fill value gap react. This is a beautiful trade. It took all of our confluences except the liquidity sweep. And then we don't take a trade on that. We sit on our hands, we relax, we're being patient, and we're not taking a trade because of that. Why? Because it didn't sweep liquidity in this area. Let me just, um, I want to show you something else. Where's the mistakes? Entering before liquidity sweep, entering before a breakout structure. Okay, let me give you an example. So we have in this scenario, okay, um, let's say, let me jump to that area. You see, still, in this scenario, the break of structure is happening to the downside. All right, there's a break of structure happening to the downside on the 3 candle. And this is what happens. We have defined the trend going to the upside, right? And this is a natural trade because we don't know if the market is going up or down. But the first break of structure happening to the downside is saying that we are going bearish. So now when the market is saying that we are going bearish, we jump down to the 15-minute, we jump down to the 1 minute, we're marking out liquidity on this area right here. We are waiting for the market to do what? Basically, we're waiting for the market to take out these liquidity areas because we are bearish. We have defined the trend already. We have bearish. So when it swept liquidity right here, you're waiting for every confirmation to be set, as it's doing right here. Maybe I'm going too quickly. Sorry about that. 15-minute. This is not on the. Let me change it. You see, it did a liquidity sweep, right? On 1 hour and 15 minutes, it did on the 15 minute. It did a breakout structure right here. It created a breakout structure right here on this area right there. Now it created a fair value gap right here on this area right here. Right? It gives a reaction on this fair value gap. Do we enter right here? Because it can continue up to the upside. We don't enter on this trade. Why? Because we are not following the checklist and we are taking the trade which is not based on the trend. Which is not based on the trend. Because the trend is bearish and we're not following the checklist if we go the opposite direction. We do the reversal. I'm saying with time, with experience, you can do the reversal. You can base your risk and your the way your strategy flips. But for now, as a starter into trading, I recommend that you just stick to the checklist like nothing else. Just stick to it, nothing else, and just following it on a daily basis. If it doesn't happen, if you don't see the trend and liquidity sweep and the breakup structure and the fair value gap and the risk reward of 1 to 2 minimum, if you don't see those things, we don't trade. That's the thing with trading. That's what trading is boring because you're following the trend, following the checklist over and over and over again. You know what you're looking at, you know what you're seeing, you know what you're expecting to happen before you enter, and then you enter. Let me do so. Entering trades before early, ignoring market structure, trading against higher time frame trends. That's the thing. Trading against higher time frame trends. So the trend here was bearish, and we're trading against that. That's the one of the biggest mistakes. Not identifying higher, missing shifts in structure, big break of structure. Um, yeah, over trading without a comfort, taking trades without full checklist. Exactly. Trading during low quality conditions, forcing trade out of boredom. That's the thing. Forcing trades out of boredom. When you sit in the market, like, let me show you. You know, you can come to the market right here. Let me show you an example. All right. You can come to the market right here. You can sit next to the market this entire time from 9 to, let's say, 11 or 12, 11. Let's say 11 without doing anything because the market is not giving you anything. And because we are so bored, this is what happens. We are so bored. We have it on 1 minute, let's say. We are so bored and we're sitting right here and we're not seeing anything happening in the market. We're thinking, you know what? Let me just try this trade. Let me just do it. Let me just take it. Let me just take it. Okay. Oh no, it was so close to my take profit area. What happened? You know what? Let me just reverse it again. And then you reverse it and you get taken out right here. And then you reverse the trade and you think, you know what? It's so close to my take profit and it reverses again. This is what tilts you and makes you lose control because you're bored. You want some dopamine, some excitement. That's what we want, right? If you want some dopamine, some excitement, listen to music, listen to something, read a book whilst you trade, because this is what happens usually. And you're losing two trades because of bad decisions, and that's when the tilt starts happening. The tilt meaning you make one mistake, and then you make another mistake, and then you make another mistake, and then it spirals out of proportion, and you can't control it anymore. You need to stop yourself at the end. All right, let me make sure I didn't miss something here. All right, so I covered three things in this lesson. Entering too early leads to bad trades. That's the thing. We're entering too early and we're entering with not enough confirmation to enter the trade. And then again, we can get lucky. But and some of us are lucky and some of us are not lucky, but it doesn't work that way in trading, unfortunately. So ignoring structure leads to wrong decisions. If you have a structure that's telling you that it's going bearish and you see a liquidity sweep going to the other direction and you're thinking, you know what, should I just try this trade? I recommend that you don't. And overtrading comes from lack of discipline. When you see these things when you are bored, that you're gonna, you know what, I'm seeing this going to the upside, let me take the trade. That's how retail traders are trading. That's not how the banks and institutions are trading. We are trying to trade as close to how the banks and institutions are doing so we can get the profits that they are getting basically, but in a smaller amount. Right. Lesson check-in. As always, take a moment to think about your biggest takeaway from this lesson. One sentence is enough, and share it in the comment section below. And if you like this video, feel free to follow me on YouTube, on Instagram, all social media platforms that I have. And if you haven't joined the school community, feel free to do that. Talk to you in the next lesson. Have a great day. Welcome to this lesson where I'm going to show you 4 chart walkthrough examples that I've recorded and I put together for you. So different chart walkthrough examples that you can see how I'm thinking based on how I'm reading the market, based on how the market is looking. So I put together 4 videos for you, 4 chart examples for you, so you can basically in the future do the same analysis and take hopefully the same trades. So go through them one by one, and I hope that they give you a lot of value. Let me show you this beautiful trade I took, and I'm going to do a chart walkthrough with you of what I've seen and what I did inside of the market. So if I just remove all these lines, this is a trade I took. I come to the market like this. I'm going to show you different examples so you can see and get a sense of how it feels based on all the liquidities and all the fair value gaps and breakup structures and equilibrium that we've talked about so you can get a better sense of how it looks like in the market. So based on this, the 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 checklist that I've shown is that it has to create a breakup structure before market open. Now, this is not a clear breakup structure, but what do I see based on this? I see a 1 hour. I'm on a 1 hour time frame. I see a breakup structure, a fair value gap reaction reacted on the 1 hour, and the trend looks like it's going up, right? We're not really sure yet. I'm gonna do a no, let me remove that. I'm not going to do that. We're not really sure yet, but the indication that it swept fair value gap on a 1 hour and it created a reaction to the upside, it gives me a more confirmation that it's going bullish. Now, if I jump to the 4 hours, there is not a breakup structure to the 4 hour that that looks valid. The only breakup structure I see is this area right here, which is on the 31 a week ago, right? So it's not really valid. It's not really showing us what's going to happen today. So this is showing us what's going to happen today. Fair value gap reaction to the upside, and it continues up. It's not a clear wick and a breakup structure right here. So what am I seeing right here? I'm waiting for it to sweep liquidity. That's number one. Number one, trend. Identify the trend. Number two, where's the liquidity? So we go after liquidity on the 1 hour and 15 minute. That's what I do. I mark out liquidities on this side. It's on the 1 hour. There is liquidity on the low, on the sell side. These liquidities need to be swept because that's how the market is moving. The market wants to move bullish, right? It has to go down, take out some liquidity because that's where the banks and institutions make their money, and then it continues up. It zigzags, right? And this is the move that we want to take. We want to take the 50% mark of this move. Why? Because it's a higher probability of the market to fake us out from this area and continue down because it can switch direction, right? So we want to take the highest probability trade. So where is the highest probability of it to take out some liquidity from the 1 hour and from the 15 minute? And if you're ambitious with it, mark out all the 15-minute liquidities and see the reaction from which one. So when it swept liquidity here on the 1 hour, swept liquidity here on the 1 hour, I jump down to the 1 minute. And what did I wait? What am I waiting for? This is a checklist, by the way. Let me just trend. Yes, I'll identify the trend being bullish. Liquidity sweep. Did it do a liquidity sweep on the 1 hour and 15 minute? It did on the 1 hour. Yes. Did it do a break of structure on the 1 minute? I'm waiting for it. Where is the break of structure? It did a high right here, and then it did a break of structure right here on the 1 minute. Did it break a structure right here on the 1 minute? Now, did it do a fair value gap reaction? No, it didn't create a fair value gap reaction, but it gave me 2 fair value gaps. One right here. So what did I do in this scenario? There's also a fair value gap on this area. So what did I do? I waited for it to react or reach this um, fair value fair value gap position, and because the way this looks, because I've seen it so many times, like I can say that the way it looks, I would have taken a trade just from this one, but I didn't want to because I knew that the market is going up, and I'm coming from losses, so I'm not willing to risk just yet with with this setup. So I'm waiting for more confirmation. So what did I do in this area? I put a limit order. So I, I wasn't even sitting next to the computer when this happened. I put a limit order on this area here on 25% because I wanted to be 100% sure, and but I've seen it for so many times, to be honest. So I put a limit order right here. It creates a yellow line, and I put my stop loss right here. And I left. I closed down the chart, and I put my risk, and then I left, and I put my stop loss on take profit on this area and on this area right here, or not this area, in the middle. There you go. On this area, this liquidity right here. So this is the trade I took. So it by itself, because I put a limit order, it took the trade right here, and then it continued up. Now, why did it take a trade? Because it gave me a fair value gap reaction. This is a fair value gap, and this is the reaction of it. That's the example of a chart walkthrough on this day, how it looks like. Liquidity sweep, a breakout structure, it needs to create a high on this area to be able to close over the body of this area to be able to be identified as a breakout structure. And there needs to be a gap, just like this one right here, which is called the fair value gap. This fair value gap can be tapped into 50% of the fair value gap, or it can be tapped into 75% or 25%, depending on your preferences. But the 50% is the rule of thumb where to put it. So in this scenario, I put it even lower. Why? Because I didn't want my stop loss to be way too big. All right, that's one of the entries. Hope you learned something from this, and see you on the next chart walkthrough. So chart breakdown example number 2. So I'm going to give you an example of how I break down the chart. So I took this trade today. Unfortunately, it was a loss, but I want to show you the chart breakdown of it. So I came to the market, right? When I came to the market, this is what I did. Let me remove all of these to start from zero. This is what I did. I came to the market. I came to DAX. This is a chart breakdown. So yesterday or the other day, the other chart breakdown is different, has a different Asia session opening, right? So this day, this is the opening of the Asia session, and this is on the 1 hour. So what do? I break, I found I'm looking for the break of structure on the 1 minute, right? There is a low right here. Always these two candles, which is the lowest? Always two candles, which is the lowest one of them. It doesn't matter if it's a red wick candle or a green or blue candle. So I'm taking this breakout structure right here. This indicates to me that it's going bearish, right? Number 2. This indicates that we are going bearish, right? Now, what do I do before that? After that, I mark out, okay, we are going bearish. I mark out there's a high somewhere for me to for the market to sweep before it continues to the bearish side, right? There's a high also right here for the market to sweep before going to the bearish side. And there's also highs right here. So the market can take out these highs and continue lower, and it can take out these highs and continue lower. So what did the market do? If I jump down to the 15-minute, I need even more confirmation of where the market is going. So I box out the overnight range like this, and I see that the first 15-minute candle that closes, if it's a positive candle, that means that the market is going bearish. If it's a negative candle, meaning bearish candle, 15-minute candle, it means that the market is going bullish. The opposite is true. So bullish candle means bullish candle means that the market is going bearish. Bearish candle means that the market is going bullish. Why? Because there are sellers coming in, and the banks and institutions wants to take them out, so they go the opposite direction. And when there is buyers coming in, meaning on the first 15 minutes, the banks and institutions want to sell to take those out. So what did I do? I mark out the first 1 hour liquidity. A 1 hour liquidity is a strong liquidity, and I'm gonna add the checklist right here again to you. And this is what the market did. The market opened, it swept this 1 hour liquidity, and it gave me a beautiful, beautiful trade. It swept liquidity, it broke structure, right? There's a low right here, and it closed underneath the body of the candle on the break of structure. It also created a fair value gap right here, and this is what I entered. This is what I entered. This is the same example as the one before, I believe, but it's on the opposite direction. So this is what I entered right here. I don't want to get into the story of why it lagged, but this is where you enter. You mark out the 50% mark of it, or the 25%, or the 75% based on where you're counting it from, and you take the trade right here. You put your stop loss on these areas right here, and then you mark out your take profits on the liquidity levels on the 15-minute right there. That's basically it. That's how we did it. Now, it didn't go all the way down, unfortunately, but still, some people take their take profit, which I should have done on this 5 minute fair value gap right here. So that's the chart example, and it reversed. It took me out, and now probably what it's gonna do is that it's gonna sweep liquidity that it did like right here, maybe create a reaction to the downside, and then continue down. If it doesn't do that, there is also a liquidity resting right here. So it might continue to fake people out, telling them that we're continuing bearish, but we're not. We're taking people out, and then we are taking another liquidity and then continuing to the downside. All right, that's the chart example breakdown that I wanted to share with you. See you on the next video. Chart breakdown example number 3. Welcome. So I hope this helps. First of all, I'm breaking this down, and I'm getting I think this might work for you because you're seeing what I'm seeing when I do my analysis of the market. So this trade today, let me just remove it. This is what happened today. So what am I seeing in the market right now? I'm coming to the market. I'm marking out 8 o'clock and 9 o'clock. This is on NASDAQ, right? I see a liquidity down here. So I mark out the liquidity. Why am I marking out the liquidity? Because the market wants to usually, if it's a uptrend, go down, take out some liquidity, and then continue up. And this in this area, I'm pointing on the arrow. This area is where we want to take the trade, where I want to take the trade. So you can see that it's a clear, on the 1 hour time frame, there's a clear break of structure to the upside. There's not that clear of a break of structure, to be honest with you. This is not a clear break of structure, but it's a break of structure. It broke structure to the upside because it created a high, and then a low, and then a high, and it closed over the body of the candle, right? So there are two candles right here, and there are two candles right here, and it's continuing to the upside. And if you go to this right here, this is the other day. You see that there's a break of structure happening right here. So if I jump down, and I'm on a 1 hour, I jump down to the 15-minute, and this is where I mark out the 15-minute liquidities, right? So there's a 15-minute liquidity lying down here. Every drop, every spike is a liquidity. So I change this to 15-minute. I hope I'm not being too quick. I'm changing this to the 15-minute liquidity area right here, and there's a 15-minute liquidity area right here. So why am I marking these lows? These lows are 15-minute liquidities to the downside. So the market wants to take out liquidities to the downside before going up. And what does the market do before market open or at market open? That's when we take a trade. We take a trade after the market open. Um, why after the market open? if you think about when the New York Stock Exchange, the market opens at 9 o'clock or 9:30 in New York, let's say 9 o'clock, you can see people stressing and buying orders and selling orders and everybody screaming. We want to be in that area, basically. We want to trade after that. Before that, there is calm before the storm is happening. So this is what the market did today. It took out liquidity. It took out it swept liquidity when we call it sweep. It swept liquidity. It took out the orders. And then if you go to the lower time frames, I jump to the 1 minute time frame right now. I can see that this is what I'm doing. Let's jump it back. Start anew. Okay. Market opened. I'm going to take this slow on the 1x. Market opened. It took out liquidity. That's number one. Let me put up the checklist. So the trend is bullish. That trend is correct. Liquidity sweep, did it do a liquidity sweep on the 1 hour or on the 15 minute? It did one on the 15 minute. So it swept liquidity. Let me just, this is my grandma's cup. Enjoy the moment. Let me just, grandma, besta murmur. Murmur is grandma. I went to my mother-in-law. I told her, give me a cup. Give me a cup that I can drink coffee with. And then she gave me this one, the pink one. All right. I digress. I'm sorry. All right, so I'm waiting for a break of structure that's happening. Now, this isn't a good break of structure because there is no wick closed over the body. So I'm waiting. I'm creating this is the new high. So I'm waiting for the new high to break structure to the upside. Now, did it close the body of the candle over the candle? Yes. So this counts as a break of structure. However, there is no fair value gap right here. So I'm still waiting. There's a break of structure. Break of structure is checked. Now it created another break of structure to the upside. And what did it do? Now it created a fair value gap. This is on the 1 minute. So I'm waiting for it to do a reaction to the fair value gap right here. Now, see? It tapped into the fair value gap, and because the body of this candle didn't pass through the fair value gap, this counts as a valid fair value gap, and this is where I want to enter because it creates also another candle going to the upside because that's our trend. So I put my stop loss underneath this area right here, and I put my first take profit at the 15-minute liquidity. So where's the 50-minute liquidity? There's a 50-minute liquidity right here. There's a 50-minute liquidity resting right here. And this is what I want to take my profit. Now I missed this trade, unfortunately, but I'm just gonna show you how it works. And then we wait for it to do its thing. This is a beautiful trade. Take your take profit at the liquidity level, and then you have about a 1 to 2. 1 to 2. Let's round it up. So that's a chart breakdown of the trade for today, for this chart example. All right, see you on the next video. Chart walkthrough number 4. So in this chart walkthrough, I'm going to show you an example of a chart that's today. It's on the 9th of April, of how it looks like. You can see that the methods that I'm using are all basically static. I'm looking for a break of structure to define the trend. Where's the trend going? I'm marking out on a daily basis the overnight range based on where the trend is going, right? This is not the overnight range. This is the overnight range. And this is what I'm doing. So when I come to the market, I mark out 8 o'clock and 9 o'clock London session open and London session pre-market open. Then I go to the 1 hour, and what's happening on the 1 hour? Directly when I see this kind of setup, it's not telling me anything. It's not telling me much, right? So I'm going back what's happening on the maybe on the higher time frames to see a little bit more confirmation of what's happening. Now, is this a break of structure? It's not a break of structure. This is a break of structure, kind of. Or it is a break of structure because it's 4 candles, right? So this is what is happening. There's a low right here. It closed underneath the body. So if you go to the 1 hour, do I see a 1 hour breakup structure happening? There is a 1 hour breakup structure happening right there. There's a 1 hour breakup structure happening right there. So and it's also, this is what I'm looking at. It's a high, there's a low. There's a high and there's a low. And there's a high and there's a low. And there's a high. And what does the market want to do next? Probably create a low. High, not higher highs. Uh, Higher lows and lower lows. Lower highs and lower lows. Lower highs and lower lows. That's what the market wants to create. So before markets want, so my bias for today, it's bearish. So before market wants to continue down, it wants to take out some liquidity right here. So I jump down to the first to the 1 hour. I'll mark out liquidity right here, which is not probable for it to come all the way up here and reach a 100 point trade. So the thing I do, I mark out the overnight range because that's what I'm trading. I'm trading two models, the 1 minute model and the school run model, right? By the way, you can apply the 1 minute model on higher time frames. It works also on the 5 minute. So, so I mark out the overnight range. This is the high of the overnight range. There's a top, and this is the high of the overnight range, and I mark it out on the low right here, and I see. So this is the overnight range. If the market breaks through the overnight range, I on the 15 minute I take a trade right there. If it doesn't, then I switch over to the 1 minute model. So I mark out the high. I see that there is a liquidity right here. Is there liquidity resting over here also? There is liquidity resting probably on the 5 minute right here, but I don't take the trade from the 5 minute, but I'm just keeping this as the top of the Asia session. Then I drop down to the 1 minute and I wait to see what the market is doing. The first thing it did, it swept liquidity right here, both of them, basically. The 5 minute and the 15 minute. Now, what do I wait? What am I waiting to see here? I'm waiting to see if it gives me a break of structure. It did the trend is clear. I'm waiting for a liquidity sweep on the 15 minute, which it did, or the 1 hour. I'm waiting for a, sorry about that. I'm waiting for a 1 minute break of structure or a 1 minute fair value gap. So I'm waiting for it to happen. All right, what did it do here? It created a fair value gap right there, and it reacted of it. This is a beautiful reaction of a fair value gap. Notice that there's a fair value gap up here. There's also a fair value gap down here that's been invalidated. But in this fair value gap, it reacted beautifully. But it didn't give us a breakout structure. Because it didn't give us a breakout structure, I can't enter yet. And the way the fair value gap and the breakout structure happens, it doesn't matter which one comes first. You can have a breakup structure first and then a fair value gap reaction and you take the trade of that. You can have a fair value gap reaction and then a breakup structure and then you take the trade off that. So in this scenario, because the 50-minute candle is probably going to close not over the overnight range, I'm removing the overnight range, right? So I'm waiting for the breakup structure to happen. There's a low right here. I'm waiting for it to happen in this area. So why did I choose this low? Because these are two candles. Because this is the lowest point of the move. And the easiest way to see this is if you go to you press on these and you press on line, right? To get a better perspective of where's the low, where's the high. Now in this scenario, it didn't take this low because it only counts the body of the candle, not the candle itself. But this is the low of it. So this is not the low of it. This is the low of the trade, this one. So I'm waiting for this to, for the other candle to create a body that's over it for it to have a great break of structure. Now, I'm waiting for it to happen. Now it created a new low right here. I'm waiting for this to be broken underneath. I'm gonna move the low. There's a new low created right here. You see, I'm just moving it and waiting for it to Now, this is not a breakup structure. Why? Because of the body of the candle didn't close underneath. So I'm waiting for it to close underneath. This is a breakup structure. Now, comes to do I take this trade or not? Where do I usually put my stop loss? I put my stop loss at the top of the liquidity, right? Because I put in my stop loss at the top of the liquidity and I'm taking this trade right here. The stop loss would be 100 points. Is it worth it? What does that mean? Because now if I'm risking that much, or if my stop loss is that huge, where is my potential take profit points? This is one, right? Or these liquidity areas right here. These liquidity areas right here. So is it worth it to take a trade? Probably not. Not on this scenario. It was a good setup, though, but the stop loss was way too huge. And we can also, if you were riskless, you can also put your stop loss on this area right here and then take the trade. But if you're counting, like where am I taking my take profit area? There's liquidity right here that can be taken out, that hasn't been taken out. There's liquidity right here that hasn't been taken out. There's liquidity right here that hasn't been taken out. There's liquidity right here that hasn't been taken out. It can go through and take out all of these and continue downwards to the bear side. But it can also react to the upside on the first one, on the second one, on the third. We don't know. But the highest probability of it going down to the 1 hour liquidity, which is this one. All right. So let's say we didn't take the trade. Okay. See, it continued. It broke through the 1 hour even. So it continued to the downside. But there's a higher probability of it continuing doing a I'm going to zoom in for you, doing a reversal to the upside and then retesting these fair value gaps and then continuing down, or just changing the bias and continuing bullish. So this is not a trade that I would want to take. This is the day where we don't do anything. We don't take the trade. We just sit and we just watch the market basically. Maybe leave and not sitting staring at the chart all day. All right, that's basically it for this chart example. I know that this was a long video. I hope they gave you a lot of perspective and a lot of value. And as always, lesson check-in. Take a moment to think about your biggest takeaway from these four chart examples that you just went through. And if you like this video, as always, follow me on YouTube, follow me on Instagram. And if you haven't done it already, join the school community. Take care and see you on the next lesson. Bye. This is the final stage of the roadmap. So first of all, congratulations that you've made it this far. You've gone through the first stage, second stage, and the third stage. So you've gone through three stages basically, and now we are on the fourth stage, which is risk management, psychology, and consistency. And the other stages as foundation. We set everything up, and reading the market, we learned about liquidity and overnight range and fair value gaps and breakup structures and equilibrium and all these things we've learned on the second stage. And then the third stage, strategy, how to take trades. We've learned about how to enter the market. We learned about the strategy based on everything that we are reading inside of the market and when to enter, when to put our stop loss, when to take our profits, when to not make the mistakes that we are usually making as beginners. And I also showed you examples in the strategy part of walkthroughs through how we can apply the strategy. And now we are at the fourth stage of the roadmap, which is basically, to be honest, the hardest part of it. Because so many people know a million strategies, but when it comes to risk and psychology and consistency, that's when people break and give up and leave trading forever, basically. So I'm going to talk about three things. What we built in the previous model we just discussed, where we are now in the roadmap, we are now in the roadmap number 4, and what this module will help you master. What would this module help you understand? So in overall, This module will help you understand how you should manage your risk. What are ways, what are systems on how you should manage your risk and how you can control behavior based on the risk that you're applying, and how you can use a strategy to stay consistent over time. So you can build discipline and it can become second nature to you, so you don't need to rely on anything else. You just need to rely on yourself based on how you apply risk, your discipline to the system that you're applying, and the thing I'm teaching in this module is what works for me. We have all different greed levels, we have all different fear levels, and we have all different ways of following through of the system that we have created. What this means for you, you will stop blowing accounts. I've seen so many people inside of this community and on YouTube and the DMs. The main thing that sticks out is I've lost so much money, I've lost so many accounts, and I can't control myself emotionally. So this module will be a lot of talking inside of this module, but it's focused on the inner game of trading. It's focused on the inner game of the psychology and the consistency part and how we should risk with our money so we can leverage that, we can have a buffer to be able to sustain our lives in trading. Trading is not making money a lot and then losing it slowly and slowly. And making money a lot and lose it's slowing up. It's like starting a new job. When you start a new job, you start off with a lower salary, right? And then you level up the more experience you get and the more knowledge you get. All right. And also, I'm going to talk about expectations in this. So you have correct expectations coming into trading based on the risk and the emotions that you're having and how to stay consistent in that by trusting the process. Um, so let's recap, a short recap. Where are we now in the roadmap? I just talked about that. What this module will help you understand. I also mentioned that and what you can expect from this model. So you will learn risk management, you will learn psychology, how to control yourself. I'll give you different stories and modules and systems on psychology and how you can stay consistent. And last but not least, how money works, how my intention is to have you think in another way about money and creation of money and how you can build your money portfolio and investments based on the teachings that I'm teaching right here. All right, just a short lesson check-in. What is your biggest challenge right now? I'm interested to know what's your biggest challenge, risk, psychology, or consistency. So these are all general terms, risk, psychology, and consistency. When somebody says risk, like what does that mean? Or psychology, I have a problem with psychology. What does that mean specifically? I don't know how to control myself after some losses. I don't know how to control myself after some wins. This happens. I have a problem staying consistent after 4 days because I blow my account or I'm losing money. Be very specific so I can know where I should direct this module to. Or not direct this module, still have it pre-planned, but I would love to know where I can provide you the most of value. So feel free to write what's your biggest challenge right now. And as always, if you like this video, feel free to follow along on YouTube and on Instagram. And if you haven't done it already, join the school community. All right, let's get to it and talk to you on the next lesson. Take care. Welcome to this lesson where I'm going to talk to you about the three edges. In trading, the word edge is used a lot, and let me just Google it for you. What is an edge? All right, an edge is when a person has an edge means having a slight advantage, superiority, or competitive, often intense quality of someone or something else. So it implies a unique, sharp, superior factor. So we have an edge in the market. There are three edges. When someone say he has an edge in the market, meaning I know something specific inside of a strategy that I'm using, the strategy that I'm having has an edge, right? That's the edge, something outside of the norm that people are using. So in this video, I'm going to share with you an edge in your strategy, an edge in your psychology, an edge in your risk management. So when we trade, we can't have just one edge. That's the biggest misconception in trading that I see that other people are doing. You or we, when we trade, this is a Venn diagram. The Venn diagram is showing you three things. We should have an edge in strategy, we should have an edge in psychology, and we should have an edge in risk management. So I'm gonna show you an example also in the chart so we can get you some perspective about how this works. So what does that mean for us? Because we are having three edges, what does that mean that we have three edges? An edge is strategy. So we know what we're looking for, right? We know what we're looking for inside of the market. Let me just move this so you can just see it clearly. We know what we're looking for in the market. We know that we are looking for a 1 minute model or we are looking for a 15-minute school run model. We're looking for those two things. Those two things inside of our strategy is our edge. So when people say, "Do you have an A plus setup?" An A plus setup is all of these. An edge is not just one of these factors. There's an edge in risk management. Do you have a system inside of your risk management based on how you stop the bleeding, how you cut the losses, how you um, navigate your equity curve so your equity curve would not drop too much so you eventually blow the account? Do you have an edge there in your risk management? And do you have an edge in your psychology? And do you know that we are humans. Humans are usually based on, we love routines. Some people are effective at night, some people are effective in the morning, some people are productive and strict and sticking to their discipline and plan in the morning, and then their willpower will fade during the night, and that's your edge. It means that you shouldn't be trading in the morning. You should be trading at the afternoon because that's when you're most alert, right? And this here, can I draw on this? This here, right? Uh, this here, this is what we are looking for. This is what we're looking for on a daily basis uh, based on the edge that we have. This is the sweet spot that we need. We need an edge in strategy, edge in psychology, and edge in risk management. All right, let me show you this and give you an example of this in the chart. So you might be an expert in strategy. You know where the market is going, you know where the market is moving, and you know where the market is. Let me copy this. You know how it works. You know how everything works, and I see this with the Einsteins on my comment section on social media that they know all the strategies in the world, but it's still not working somehow. So why is that? Because it's not about what you know in the market, it's how you can apply it. So let's give you an example of the strategy. Let's say I'm an expert in strategy. I know exactly where the market is moving. I'm waiting for a liquidity sweep right here, right? Look at this. Liquidity sweep on a 1 hour, let's say. And then it gives me a breakup structure. It gives me a breakup structure right here, and it entered a fair value gap in this area right here, and this is it. And this is what happens, right? It entered the fair value gap right here. I'm waiting for this moment to happen, and this is what happens because I have a strategy, but I don't have psychology in place. I don't have psychology in place, and I have risk management in place. So it just broke structure. This is usually when a strategy is telling me to enter the trade. But because I'm so uncertain, I have so much self-doubt. My psychology is not that strong. I didn't sleep well the night before. My edge in my psychology is not correct. It's not strong. So this is what happens to me in the market. Should I enter? Should I not enter? Oh, should I do it right? Oh, no, 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 it's returning. So I'm happy I didn't enter. But now it's reversing. So should I enter now? Should I check what should I do? Should I check the checklist? Should I wait? Should I enter? If I enter right now, the stop loss will be way too big. Should I enter right now? I'm not sure if I should enter because if my stop loss is too big, and you've missed the trade. You've missed this entire move because of your psychology was not that strong and we didn't have the edge in our psychology. I'm just being completely transparent. This is what happens. And like you will come back this video. This video is based on you coming back to this video and rewatching it to get your psychology and your understanding of what needs to be done in place. Um, that's what happens when you have bad psychology. The same thing with having a strategy and having a psychology. If you have a strategy and a psychology part in check, and but your risk management is not correct. So in this trade, you know exactly when you enter and you're brave. You want to enter this trade, you enter it right here. You're taking your stop loss right here, and you're taking your profits on these area highs right here. You're entering this trade. It goes, it continues, and you're thinking, why didn't I enter this trade with more risk? Let's say it took out profit right here. It usually, I think, is going to do it. But why did I enter with more risk right here? Because my risk is usually 1%. And why didn't I enter with 1%? I only entered with 0.25% on this move, and it gave me a 0.75 in profit or zero point 0.5 in profit, which it could have given me a 2% in profit. Why didn't I do that? Because I don't have an edge in my risk management. This is what usually happen. I'm showing you the issues that's happening so we can eventually in this module find the solution for all of these. And the same thing goes with the opposite. If you have a bad risk management, you don't know when to enter on a 2% trade and risk trade, or on a 1% risk trade, or on a 0.5% risk trade. You have it all backward. You don't have a system. We don't have a system that we are following on this. So this is what I'm gonna hopefully teach you during this module so you can learn to have all of these three. So we've already set the strategy part. We need to set the psychology and the risk management part to be able to go through with trading and to be able to make money in the long term in our trades. All right? That's basically it regarding the three edges, the importance of three edges. So we can't leave one of them out. These all three needs to be applied and focused and structured on a daily basis. So, and also something I don't want to forget to mention is your your equity curve based on who you are will grow. If you start trading now from zero, right? Zero amount, you will grow. Let's say you will jump up to $100, right? This requires the three edges. Let me just do the three edges in a new way. Three edge. This gives you the three edges in a new way where you need to grow. So you're growing to this area from here, you're going there, you're developing yourself. So the $100 needs a new three edge strategy for it because you're growing, you're risking more, you're doing more. Now, when you go from $100 to $500, then you need a new edge again. It will give you a new edge again because you are doing something different, you're growing as a trader, and you will have a new challenges that you face on the $500. And this continues to happen over and over and over again because our mind, when we are here, we are seeing this $500 as something huge, right? But when we reach it, it becomes a part of us. And that's $500 start feeling like the same thing that it felt when we have a $0 in our account. And then when you grow again, when you grow to $1,000 a month, this same edge continues to follow along, and this $1,000 will start feeling like $100. And eventually, the more you grow, the amount of money will start disappearing. You start counting everything based on the um, how you trade it. I don't want to digress. This is the three edges lesson right here. Just a short recap. I talked about there are three edges in our main three edges. There's a strategy edge, psychology edge, and the risk management edge. So there is a real edge is not one of them, is all three that are met together. One of them can be missing out. You don't have an edge if you have one of them, if you have strategy and risk management and you don't have psychology. You have to have all three of them to be able to to make it basically as a trader. So short lesson check-in, what edge is your weakest right now? Is it strategy, psychology, or is it risk? One sentence is enough. This keeps you thinking about, what am I here to improve? What do I need to know more about so I can improve? Right. As usual, follow me on YouTube. If you like this video, follow me on Instagram. And if you haven't done it already, join the school community. Take care and see you on the next lesson. Hello and welcome to this lesson where I'm going to talk to you about the position size calculator on MT5. This is a free software that you can use so you can navigate and control and adjust your risk uh, simply, easily, so you don't have to put so much mental energy on how you're risking. You just need to have it preset, and I'm going to show you on how it works, basically on the VT market on the MT5. So as long as you have you can have an MT4 or an MT5. MT5 is the one I'm using. So I'm going to show you here how it works. So when we open up the chart, let me just start from the beginning. So if I open up the chart, I'm going to, if you haven't installed the MT5 or the position size calculator, feel free to do it so you can go through this video as simple as possible with the steps that I'm teaching right here. So if you basically open up your MT5 like this, right? You go to Expert Advisor, and then you go to Position Sizer. You press on that. You see the Position Sizer right here. You press on that. You double click. You get this section right here. You press on Inputs, and you press on Load, and the free template that I've been using for you, feel free to upload it right here. So this template, Position Size Calculator, is preset by me to a risk reward of 1 to 3. You can see 1, 2, 3, right? I double click it and I also change the colors. So when it opens up like this is what you get, right? You get a stop loss area, but you don't get any take profit areas, right? So what you want to do is you want to press on lock and you press on plus in TP, or you just wait on it. So this is just 1 second. Now you just pressed on lock. If I remove the lock, nothing happens. Yeah, I remove the Yeah, if I press on lock, this is locked right now to 1 to 3. So when I take the trade on 1 to 3, let's go to Bitcoin instead, because the Bitcoin is, yeah, you know what, it doesn't matter. If I press on lock, lock helps it have the preset of 1 to 3 locked in. So every time I take a trade, I move the stop loss like this. So this, first of all, eliminates the I didn't have a stop loss. It just removes it, because one of the biggest mistakes we can do as day traders, as traders overall, is to not have a stop loss. You're trading without a stop loss, the market can just drop down or continue up, and you're just in a losing position that keeps on like blowing and taking money from your account. That's the biggest thing that people are doing, that they're not moving stop losses. So step one, it forces you to have a stop loss. So when you take a trade with this position sizer, when we trade, we usually want to have more than one position. Some people trade with one position and that works for them. I usually trade with two positions. And two positions gives me the opportunity to have, um, let me show you. So I have two positions. Every position I have is 50% of the entire position, right? I have two positions, 50% of it, of the entire positions, which makes it equal to 100% of my entire position. So every time I take a trade, I have two positions running, and it gives me the option to either close the positions, both of them on the first take profit, or take two take profits, right? So in this scenario, now I want two positions. How do I create another take profit position? I press on the plus sign right here. So the plus sign right here creates a line right here, which is green, which is the second take profit area. So every time I take a trade, I'm trying to find a market that is open. Bitcoin should be open right now. so I can show you how I can take the trade. ETH, Ethereum. Yep, Bitcoin should be open right now. Chart window. Yeah, Bitcoin is open right now. So let me do this on Bitcoin instead so I can show you on the live how it works. So I go to load, I press on the position sizer, and it didn't open on Bitcoin. Yeah, it's already pre-opened right here, so I can use it. So if I go and search for the lines right here, you can see I'm jumping to the 1 minute because 1 minute is faster to use. So I'm choosing the lines that I want. I'm not focused on how much profit I'm taking. I'm focused on where to put my stop loss. That's the first thing I want to focus on. And then after I've done that, I have the lines, I have the take profit areas. This is when I apply the risk. So you can see that this is a demo account with 96,000, and this is where I define my risk. The risk is always calculated in percentages. You can do it based on the amount, but I recommend that you use it on percentages because it's easier to follow. So if I have a 100K account, if I'm risking 1%, that's $1,000, right? If I'm risking 0.5%, it changes the percentages of it. So it's easier to follow along and it changes it for you. It's easier to follow along based on the risk that you're using and you're just focusing on that. Yeah, I'm just risking 0.5%. I'm just risking 0.25% because I've come from a losing streak and I want to risk less. I don't want to be focused on the money. And this is how you trade on CFDs, by the way. CFD trading, not futures. Futures, you have contracts. So the way I take a trade, let's say I take a 1% trade, I just change it to 1%. I move my stop loss right here. I'm thinking, you know what? I'm gonna put my stop loss in this area right here. If it takes me out, it takes me out. I'm pressing on Shift T. You hear the tut sound, and it takes two positions. After I take this trade, I hide the lines. I hide the lines to make it look easier and more structured for me. So I hide the lines and I have two take profits. If I so do you see that? It just took out my stop loss area. And if I go to history, this is what I see. I see that I had two positions right now. That's the date of it. I had two positions right now. That's the date of it on the 12th of April. And every position took out 50% of my entire position. So it lost me minus $482. All right. So if I want to take another trade, I show the lines and I see what's happening inside of the market. Um, um, Let me take another short. This is a short. And if I want to switch it from a short to a long, like this, I just press on tab. So in this scenario, I'm going to take a trade again. Now you know what? Because I lost the trade, I'm going to risk less. I'm going to press here. I'm going to press 0.5%. And I'm taking the trade right here. You can see that it takes two positions right here. Every position is the 50% of the entire position. So usually what we do, we move the furthest TP area to our first take profit, and the other one is preset to 1 to 3. So in this area, when it gets topped out, this is what we, let's say, you know what, this just took profit. It's gonna, if I hover my mouse over it, it takes $144 in profit. Let's say we have a liquidity area right here. This is what we were taking this is what we're doing to take our profit. Let me move myself so you can see the entire thing. So we're just waiting for it to take profit. And when it takes our first take profit, you move the stop loss, we move the stop. You know what, let me just, and if you don't want it to hit your take profit area like this, the thing you can do is you can just close the trade right here and take profit sooner. So let's see. This is the area where it says 71,504, 71,5. Or is it? Is it this the first one? I think it's the first one. No, it wasn't the first one. So I'm taking my first take profit, right? After doing that, what do? I move my stop loss to break even. Break even. I move my stop loss to this entry area. Yeah, the spread and commission is not allowing it to go to the stop loss area. But that's basically what we're doing. When it continues down, you can see that I can move my stop loss to break even. I can make a lesser risk with my stop loss area because I'm moving it down. It takes way too long when I'm dependent on the market and when it's going. But you understand the point of it, of how the position sizer is working. You apply risk, it it creates the volume of how much you should be risking. Because if you're not using the position size calculator, you can basically use you can use the sell and buy button right here, but you need to readjust your position size, your volume of your trade. Should I take 10? Should I take 5 and sell right here? What should I do? How much is it? You don't know, basically. And then after you do that, you have to readjust your stop loss area and your take profit area. And this basically, the thing you're doing right here is basically with the position sizer, it does everything for you so you can just focus on the trade, not on the risk. You have a risk system that you're following and you're just focused on the trade, not the risk. Let's see if it continues down to the downside. Not sure why is it not working to go to the... Yeah, see? Now, I'm moving my stop loss area right here. You can see if I put my take profit right here, stop loss right here, you can see that if it hits this area, I'm minus, if it hits this area, I'm minus 362. But if it hits this area, because I'm moving my stop loss down, it's 246. My loss will be less because I'm moving my stop loss. That's why it takes our first take profit, we can just move our stop loss to break even. Break even meaning where our entry was. All right, that's about it from the how to use the position sizer. I really recommend that you use this tool because it's easier to follow and easier to adapt and adjust it with. In the beginning it's a bit tricky, but you get used to it basically, as long as you stick to it correctly and use the correct risk management. All right. As always, do a short lesson check-in. What did you learn about this lesson using the position sizer? Mm, just a lesson check-in. I don't need to change that. If you like this video, feel free to follow me on YouTube, on Instagram, and inside of the school community. Take care and see you on the next lesson. Hello and welcome to this video. And in this video, this lesson, I'm going to talk to you about the short and long tool. So I'm going to jump directly to TradingView. So we have two tools that we can use. If you don't have these tools right here, you can just go to this area right here. You can press, oh no, where is it? This area right there, forecasting. You can see that you can mark out the short and the long position tool. So when you mark it out with the favorites, it jumps right here. So you have the long position right here, and you have the short position right there. So I'm going to explain to you both of them. Yeah, I didn't know what, it didn't create the same size, but anyway. I'm going to explain to you both of them and how they work and how they can benefit us to basically write or count our risk and count our reward from what we are risking, because this has to do with risk to reward. This has to do with risk to reward. How much am I willing to risk to be able to gain this amount? And this is the tool that helps us define those things. How much am I willing to risk to gain this amount? So in this, let me just choose one of them. In this long position right here, you can see that this area usually they are red. So I'm going to mark it out as red. Usually in this area, which are red, is the one that we are risking, right? So let's say I'm risking $1,000. I'm risking $1,000, and this is the amount that I'm risking right here. So if I hover my mouse over it, I'm gonna zoom in. If I hover my mouse over it, you can see that it tells me that there's a 1 right here, right? And this is where it says the risk reward ratio. This tool helps me calculate my risk reward ratio based on how much I move my take profit area. So this is the stop loss area and this is the take profit area. So based on how much I'm willing to risk to take profit, it adjusts based on the risk reward right here. So if I'm willing to risk $1,000 to gain how much? $2,000. This is what the risk reward tool is telling me. So you're risking, that's 1 to 2. 1 times 2. It times 2. So I'm timing it by 2. Multiplication. Everything that says on the risk reward, it times 2. And this is the same thing that we want to use on our position size calculator. Let's say we are trading this on Bitcoin USD, which is live right now. I'm going to take a short position right here. This is what we do. We look at what the market is telling us, and I'm taking this short position. I'm putting my stop loss on this area right here. It gives me a 27-point stop loss area. So this stop loss area we can talk about later on, but this stop loss area gives me a 27-point area, and I'm willing to take my profit right here, which gives me a 1 2. You can see 1 to risk reward ratio 3.27. So I jump into the position size calculator right here, and where did I put my stop loss? On this high right here. I'm putting it on this high right here. How much am I willing to risk? 1%. I'm taking my trade right here, and I'm hiding the lines, and I'm moving my stop loss area to this area right here. This will give me, let's say, on this low right here. So where is my take profit is going to be taken out, right? Well, just take it on the below right here to make it easy. This is what happens. I'm using this short tool. I'm inside a short position, and you can see I entered this trade right here based on what it says on this MetaTrader 5, and I'm risking $1,000, 1% of my total amount of the account that I'm having, to gain 2000, let me just see it, 2240 on one position and 2380 on the second position. This gives me a proper risk reward. Why? Because I'm risking 1,000 about right here to gain times 3.5. Because there are two positions, it's times 2. I don't know if I made that confusing, because every position I take, this every position right here is 50% of the entire position. So one position is basically, it's 2,240 times 2, because every position is 50%. You can see that there it's two positions right here. So when it eventually comes down and takes out my profit, this is going to be a 1-2 risk reward, 1 risk reward 3.5. So I'm risking 1,000 to gain 3,500 back. Do you see? That's how it works on the risk reward tool, and that's how the tools can be used. We're using them basically just as reference. We're using them basically just as a reference. And with time, you will almost just need to have the reference point right here, and you will see what's the risk reward that it will be giving you based on the how much you're risking. So if we move the stop loss area to this area right here, just to make it clear, it doesn't move on the MetaTrader. We need to move this manually. So I'm moving it back. When we move our stop loss area right here, our our reward becomes smaller, right? Because the area of the risk becomes higher. So that's why we don't take huge stop loss areas, and we put our stop loss right here, which makes the reward very less. So we know the rule of thumb is I don't want to be risking $1,000 of my money to gain 500 back. That's a bad deal, right? I want to be risking $1,000 to gain more. I don't want to gain less if I win. So that's risk reward backwards. That's what we not want to do. So some people, unfortunately, they put their stop loss right here in this area, right? And they move their take profit area to these areas, and they even move their take profit area and hope that the market is continuing down forever. That's not how we trade. We use this tool to be very specific in when we take our stop losses and when we take our profits. All right, is there something else I need to share about the risk reward ratio tools? Let me see. I think that's it. That's a tool that's used to measure out how much you can risk and how much you can gain and what's your what you can set as your amount on your stop loss area. Because when you move this, when you move your stop loss area, you can see the stop loss number here on this symbol. So you can just jump to MetaTrader 5 and change the amount right here even quicker. The quickest way to do it is basically just to eyeball it and see where the high of the candle is, right? And also, when you move your stop loss area, you can move it to break even. When you move it to break even, not sure why it's not moving. When you move it to break even, you can still move the break even on the tool right here, but it needs to be done manually. There you go. See, it's going down to my take profit area. All right, that's about it on the long and short tool. Hope you learned something from this lesson today. Biggest takeaway, just one thing from this lesson, one sentence is enough, and share it below because it will activate the way we learn. We learn by actively engaging in these lessons. And as always, if you like this video, feel free to follow me on YouTube, on the gram, Instagram, and if you haven't done it already, join the school community. Take care. So in this lesson, I'm going to explain risk to reward to you. You've also seen when people are writing RR, what's the RR of this trade? What's the risk reward? What's the reward to risk when people say that? Because we want to know in this every time we trade, how much am I willing to risk to be able to gain an amount? How much am I willing to risk to gain in that amount? I don't want to be risking $1,000 to gain $500. That's a big no-no. So I'm just gonna jump directly into the chart and explain it to you in a simple manner. And if you have any questions, feel free to ask them in the lesson check-in. So I've drawn two boxes right here. How do we identify, first of all, the risk reward? All right, we have two tools that we are using. We're using the long tool and we're using the short tool. So we usually, when we use the long tool and the short tool, at the risk reward in the long tool and the short tool, you see that it says 1. And as soon as you change the where we take profit, it changes. And as soon as you change where we take profit, it changes. So the rule of thumb that I would like to use is not to focus too much on the risk reward and focus on what the price is telling us. Because if we have liquidity right here, right, and it always only gives us a 1 to 7, Am I willing to wait to have it to give me a 1 to 3, but the highest probability of the trade that can be reversed from this area? Am I supposed to take this trade, or am I not supposed to take this trade? I just don't want to make it confusing for you. We take profits at liquidity levels, or let me say that in another way. We want to take profits where there's the highest probability of the market to move into the other direction and take us out, because we there's always a probability, always a chance of the market to take out the highest probability liquidity or fair value gap and give us a reaction to the upside and take us out. So I'm willing to take some profits on these liquidity areas where it's the highest probability of the market to return, and then take a less amount of profit, less amount of risk reward, based on the tools right here. So we're using basically these tools to count our risk reward ratio, but we are using the where the highest probability of the market returning is where we want to take the trade, is we want to take the profits, not just focusing on where the risk reward amount says. So in this risk reward amount, let's say every trade we take is a 1 to 3, right? You can see that I say 1 to 3 because it says risk slash reward ratio, meaning if I risk $1,000, for every trade I'm taking, the gain is times 3. Why is it times 3? Because the RR 1 to 3, which means that everything I risk is times 3, which equals to 3,000, as you can see below, right? So we have two boxes right here. I have two boxes that I've drawn for you. You can see that this one box is the losses in dollars. Dollars, pounds, euros, it doesn't matter. It's the losses. And in this box, it's the wins. All right? So every time I trade, every loss I've taken and every win I've taken, I'm going to count this inside of this box, just to give you some perspective of how this works. All right. So every win, every loss I've taken, I'm trading, and every trade I've taken, I get a loss. I lose one trade. All right. I've lost $1,000. I lost another trade. I lost another $1,000. That's $2,000. And I lost another trade. That's another $1,000. That gives me $3,000. Right. And now, and the fourth trade, what happens? I'm still risking $1,000 and I'm gaining $3,000 in one win. So one win equals to three losses. One win eats up three losses. And this is how we win, by probability and by having a proper high risk reward at the end of the month. Because if you're looking at it in a different horizon, if you're looking at the trades you're taking, let's say, you know what, let me continue this. Let's say then I lost. I won this trade, then I lost the other trade right here. This gave me four losses. When people look at my P&L and they see that, oh, you have a lot of red days. Yes, but I'm taking another win after that. I'm taking another win after that, and what happens? This other win gives me a 1 to 3, meaning I'm risking 1,000 to gain 3,000. So this another win right here eats up this loss and gives me two more wins, right? So now, because I've lost four trades and won two, I'm still profitable at the end of the month because the risk reward is higher. That's why I said in the beginning, I can't be risking 1,000. I can't be risking 1,000 to gain 500. It doesn't work that way. That's the opposite of the risk reward. We want to gain more by risking um, less, basically. I want to risk a little bit to gain more from that risk. So that's the wins. That's how the wins happen. And I want you to see this in a different horizon. I want you to see this from, let me draw on this tool because I want you to see this in a 10 trades horizon perspective. Yeah, horizon perspective. So if you take 10 trades, right? If we take 10 trades, and of these 10 trades, this is what happens. I take 10 trades. That's one, two, three, four, five, six, seven, eight, nine. That's 10, right? This is 10 trades that I'm taking. Oh, so every trade I take, every loss is $1,000. $1,000. Every win is 3,000. All right? I want you to think of that. Every win is $1,000. Every loss, every win is 3,000. Every loss is $1,000. So if I go here, I'm starting out the month badly. I'm taking one loss, that's $1,000. 2,000, 3,000. I'm taking three losses. And then I take a win. What does that do? That win eats up all the losses that I've taken. All right? Let me, let me just continue doing that. And then what do I do again? I take I take another win. So what happens now? I'm up. You know what? Let me change it because I'm not thinking in dollars. Every loss is 1%. Let me do that. Every win is 3%. That's how I think. I think in percentages, not in amounts. Every loss, I lost 1% right here, 2% right here, 3% right here, and I won this trade. This trade gave me 3% in win. So basically, in this area, I'm at break even. I'm at 0%. I haven't done anything yet, right? I've taken 4 trades, lost 3, won 1, so I'm back at break even. I'm back at 0%. Then I won another one. What happens when I won the other one? I'm up 3%. I'm up 3% on the 10 trade horizon perspective, right? And then the trade after that, I lost 1, then I lost 2. And this is what usually happens. People are starting to question their strategy, they're changing strategies, they're jumping back and forth. Is my risk reward correct? Should I change it or not? And this, let me show you here. So I'm losing 3%. Now I'm down. How much am I down? I'm down to 2% right now, and then I'm down to 1% right now, right? And then the second thing happens, I'm losing another trade, and now I'm back at break even. I'm back at break even because I've won this trade, I've lost this trade, I'm back on break even, and then I take a winning trade right here, and then I take a losing trade right here, right? So what happens? Um, I'm at 3% right here, and then I'm at 2% right here, and then I'm down at 2%. So that's what happens because at the end of the month, I'm at a 2% win. I'm on on end of the month, end of the week, end of these 10 trade horizons. I'm still by probability winning. Why? Because I have a proper risk reward system and I'm thinking about it this way. I'm not blowing accounts based on the losses and then I go out of tilt and risk more and over leverage and not using stop losses and all these things because I've lost 3 trades in a row. If you think about it in a long-term horizon, you will eventually become a winner. Because you see, 1, 2, 3, 4, 5, 6, 7. Out of 10 trades, you've lost 7 trades, right? You've lost 7 trades out of these 10 trades. And you've won 3 of those 10 trades. So this gives you a 9% return because you're risking 1% and gaining 3%, and 7 of these trades gives you a 7% minus in return. 9 minus 7 equals how much? 2. Now, 2 doesn't sound much, but if you're doing this on the week, right? If you're doing this every week, 2 times, let's say 4, because we have 4 weeks, that's 8%. 8% on the month, that's a great return. That's a great return. Doing this consistently, that's a great return. So that's my perspective on risk reward and how it works and how we are supposed to think in a long-term horizon. All right. Feel free to share, as always, the lesson check-in, what you learned from this lesson. One sentence is enough. Feel free to share it below. And as always, if you like this video, feel free to follow me on YouTube, on Instagram, and if you haven't done it already, join the school community. Take care. Hello and welcome to this lesson where I'm gonna talk to you about how to write a trading plan. I'm gonna share with you 3 things: why every trader needs a trading plan, what to include inside of your trading plan, and why consistency comes from following your rules. Really, that's all consistency is about. Following your rules and sticking to them on a daily basis every time you trade. So I have my old trading plan right here. What do I trade? When do I trade? When do I study? How many trades am I taking? How much am I risking? What's my checklist for my strategy? Like have all this written down right here. Old notes that I have, and it's so fun to check um, because it's guided me here. So why do every trader needs a trading plan? Because we So I put this metaphor as a GPS. We need to know where we are heading. Where are we heading with our trading? What 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 walls do we need to stick inside to be almost reckless in our trading, but we need to be reckless in these areas. All right? I'm saying reckless by using it in a responsible manner because we can we can't go off the rails with trading because going off the rails will bring so much consequences to to um, to our portfolio, to our dollar amount inside of the portfolio. So I'm gonna we're gonna write a trading plan together. I'm gonna sit here through it with you, and I'm gonna show you how you can write a trading plan based on the questions that we will be asking right here. All right. So let me open up a free document right here, just a simple one. Google Docs. All right. We're going to use a Google Docs. I'm going to use it on the left side right here. And I'm going to remove this one right here. And we're going to write it together. Is it small enough? Is it small? All right, let's do it like that. Okay. What symbols do you trade? You know what? Let's jump to this. Let's not change it so much. Changing it back and forth. Okay, let's write it together. Trading plan questions. What I'm going to answer it like that. What symbols do I trade? That's the first question you need to ask yourselves. What symbols do I trade? Because some people are using DAX, gold, Nasdaq, S&P, OMX 30. There are 50 symbols that they trade. Just break it down into what symbols you trade, that the ones that you know best and the ones that you know works best with that strategy. So I'm going to use it from my perspective. What symbols do you trade? DAX and NQ. That's it. I don't trade none of the other symbols. I'm even removing them. You know, there are so many symbols. Remove all of them. Remove all of these if you're not checking them. If you need to check them, just write the symbol you're using. So you're trading the DAX, and I'm trading the DAX and NQ. That's one. That's one symbol or 2 symbols that I'm using. That's a part of our trading plan. That's the only symbols that we are checking. What session do you trade? So I trade the London session, and I trade the NY session time. It all depends on the time. It all depends on what's going on inside of the home, inside of the family, if I want to trade the New York session. I usually check the New York session from time to time, but I never trade the Asia session. Why? Because the Asia session is not a part of the what session do I trade. That's two. Okay, what days do I trade? Am I trading every day? Do I have the mental energy to stick into the market, to go to the market every day and have almost that stress and that pressure on me on a daily basis? I can tell you, when I traded, this is what I wrote. When I traded in the beginning, I wrote, I'm just reading my notes. I traded Monday, Tuesday, Wednesday, recap, reading, improvement, mindset. This is what I did on Wednesday. I traded Monday, Tuesday, and the things what I traded on Monday, Tuesday, I did a recap on those on Wednesday. So I didn't trade on Wednesdays. Wednesdays was the time to study, the time to backtest, the time to what do I need to improve to Thursday, Friday, and that's what I did in the beginning. Thursday, Friday. So no trades Wednesday. That's what I did in the beginning. Now it's changed. Now it's changed. It's I don't trade on Fridays. So that's what I do. That's a way you can do it also based on how you work and what time you have off to be trading the New York or the London session. So what times do you trade? So the London session opens up at 9 o'clock. I trade between 9 and 11:30 max. Like I try to, even if I find a trade at 11, I don't even take it or I close it down at 11:30. That's the max. And when I trade the New York session, is it's 3:30 to 5 o'clock max. I don't go over that or 30. Let's say 30. I go 30 max based on my mental energy, my mental bandwidth. That's why I put a line at 5:30. So if I watch a trade or I see a trade before that, I don't take it. This should be included in your trading plan. We have more questions. How many trades do I take per session? That's a great thing. That's a great question. How many trades are you taking per session? Some people are taking 10 trades. You or we or how we get it structured is we take zero. We don't write one or two. 0 to 2 trades per session. If there's no setup, there's no trade for me to take. I don't need to force 2 trades just to say, just just to have it. How many trades do I take per session? It should say max 0 to 2 trades per session. If I take 2 trades, that's it. It's not even worth for me looking at the chart and seeing what's going to happen because I'm not allowing myself to take more trades than that. All right. How many trades do I take per day? Right? That's also a good thing because you can take 2 trades on London session and you can take 2 trades on New York session and you can risk 1% and for the entire day you've lost 4% because you've lost all 4 trades. It's not about doing more, it's about doing less and gaining more. So how many trades do you take per day? How many trades do you take per day? 4 maybe or 0 to 4 trades per day if you trade both sessions. It's very specific. You can see that per session, per day. All right, that's the one thing. Going on to the next questions that we need to ask ourselves. Although that's so we've already figured out what to trade, how much to trade, how many trades we are taking. So what is my setup? What am I looking for in the market? I'm looking for the 1 minute model, 1 minute model, and I'm looking for the school run model. All right. If these models don't happen, I'm not taking a trade because that is my setup. That is a part of my trading plan. Am I following my checklist? Yes. No. Am I doing it? It's a good way to ask yourself these questions. Do I have full confirmation? Yes. No. That's a good way to have a checklist. You can see that. I have a checklist right here. Am I following through? Have I a trend defined? Do I have a liquidity sweep on the 1 hour and the 15 minute? Do I have a 1 minute breakout structure? Am I risk reward fair enough? Doesn't specifically need to be 1 to 2 or 1 to 3. It can be a 1 to 5. I don't know. Is it fair enough for you to take the trade? Is it worth the risk that you're risking? All right, going to the next stage. What is my max loss per day? This is where we count the percentages. My max loss per day is 0 to 2% a day. If I risk on one trade 2%, or if I risk 1.5%, let's make it easier. If I risk 1.5% on one trade, and as I wrote before, I have the ability to take more than one trade per session, how much am I willing to risk after that? I have to risk 0.5% because it amounts to 2% per trade, right? All of this protects us from ourselves, really, because trading is you versus you. When you have a plan that you need to follow, when we have a plan that we need to follow, it protects us from over leveraging, over risking, doing too much, doing too little. It's like we create walls for ourselves through this. People talk, I want to, just short. I don't want to talk too much. People talk about having freedom gives them, trading gives them freedom. Freedom is in the trading plan. Why? Because you know what you need to follow. And when you follow that, freedom is created through responsibility of following your plan, your trading plan that you're doing. That's how freedom is created. So you create your own freedom. It's not something that's given to you. How much do I risk per trade? That's a great question. Do you risk 2% per trade? I risk 0 to 2% per trade. Per trade. Mm. 0 to 2% per trade. So if you risk 2% on that day, you can't take another trade because you're risking too much. You've set your max limit for your risk. You've reached the max limit for your risk. Is the risk reward at least 1 to 2? Yes, no. All right, going through it, continuing. Am I calm before entering? These are questions that you need to be asking yourself before you enter the market or before you enter a trade. Am I calm before I'm entering? Yes, no. Am I even keeled? All right. Did you have a little, just one cup of coffee? You didn't have two. Am I forcing this trade? Yes, no. You will notice that when you're inside of the trade or inside that you're almost about to take the trade, you will see, am I forcing this trade? Am I really doing it? Do I need to take this trade because um, it's not about, I'm wanting something, I'm wanting the result that my expectations is that it's gonna give me a win. So am I forcing it? Yes or no? Am I in the right mindset? This is so important. Am I even keeled? Am I even keeled? Am I in the right balance? Did I just have a fight with my wife and I came to the market and I'm upset and irritated and I want to take it out on the market and make money and, you know, take my frustrations out on the trades? This also, am I in the right mindset? Some people, they self-sabotage for themselves because they need that feeling of I need to fight for it, right? Am I in the right mindset? I reached that amount of profit in my account. It feels like I'm relaxing way too much. So am I in the right mindset? That's also a good thing to remind yourself with. Am I am I in the right mindset to enter the market right now? All right. Last but not least, when should I not or when should I stop trading? So these are rules based on your preferences of what works for you. So you should know when you should stop trading. You should write this down for yourself and you should keep it as a reminder for yourself. And this is a good way to even write it as affirmations on a daily basis or use this list as affirmations. I only trade the DAX. I only risk 1 to 2%. I only risk 0 to 2%. I only trade this time frame. And I stop trading when I hit my max daily loss, when I take two losses in a row, when my trading session ends. High impact news is about to hit or just released. I'm trading outside my session. I'm sitting at midnight, it's late night, the session is not even open, and I'm sitting late at night drinking some cola and eating some chips. I'm sitting next to the market and I'm seeing a setup that works, but it's outside of my session. I stop it. I don't trade it. I feel emotions, tired, and unfocused. I'm forcing trades instead of waiting, right? This is a good list to follow. This is the most common things, but I want to emphasize that a trading plan helps you. Like it feels like there's a lot of questions that you need to ask yourself, but this becomes a part of your behavior in trading eventually. In the beginning, we need to direct our mind to where we are going based on what we wrote in our GPS in the beginning, right? So we need to have it structured. It's a bit confusing right now, so we need to structure it so we have a structure that we are using, and eventually like I don't have a trading plan. I've been doing it for so long because I know what works for me and I know what works. Eventually, all these things with trading plans and checklists and stuff like that, we don't need them eventually. We need them in the beginning, and then it doesn't become, it seems like it's a lot of effort. I get it, but it becomes easier, and the trading plan is supposed to work itself out from your trading. So you don't need to focus on it. But in the beginning, we need to redirect our focus back to it on a daily basis. So, lesson check-in. Let's take a moment. I hope you wrote this trading plan and you maybe print it out or have it written on a piece of paper, put it next to you before you take a trade so you read it before you enter the market. Take a moment. What made having a trading plan clearer for you in this lesson? Just one sentence is enough, and feel free to share it below and comment below. And if you like this video, as always, feel free to follow me on YouTube because I put content over there um, that's not fitted inside of this course. Also on Instagram, the same thing there. And if you haven't done it already, join the school community. All right, talk to you in the next lesson. Bye. In this video, I'm going to share with you how to journal your trades. So journaling is an important part of trading. I'm going to talk to you about three things. Why journaling improves performance, tracking wins and losses. That's a good way to have a way to track your wins and losses, and also learning from your past trades. Because if you don't learn from your past trades, you will not improve to the future. It's not about taking trades and just hoping that we're gonna improve somehow, some way without changing our behavior. This is just like doing a self-analysis and being self-aware of your trades outside of the market, because we make bad decisions where when our stress level is up or our cortisol is up, our dopamine is up, and we can't really have a self-objective look at ourselves and do a self-analysis. That is why it's a good thing to have a journal to see our behavior and what we're doing. It's also a good thing that I didn't write inside of the this lesson right here is to record yourself. Maybe you can record yourself taking the trades and you can talk through the process with yourself so you can watch the videos of yourself doing the jump, right? Doing the sprint. So, what let me just jump in. What do you want to have inside of the journal? You want to have entry, stop loss, and take profit. You want to have a way where you screenshot your trades that you're taking and assess yourself. Ask yourself a questions. Did I follow the checklist? How was my emotions? Why did I take this trade? Now, when in hindsight, if I saw this trade, would I take the same trade again? If it's yes, then continue doing the same thing. If it's no, then don't. Then find ways where you can improve. So there are free softwares that you can use, and there are paid softwares that you can use to journal your trades. So the one I'm using, because I come from the IT world, Trello is something that we used in the company a lot before before doing the sprints and the agile and the boards that we're using. So the thing you want to do, go to Trello, just open up a free account and create a new board. You press on create a new board right here and you write journal. All right, you create a journal right here and it opens up a journal for you. Let me change the background so you can just see it clearly. Let me do it like this. All right, we're gonna create a journal together. This journal is gonna be, you know what, journal 2026. All right, or journal course. It's easier to talk to name it. This journal is a way for you to go back and look at what you're doing, look at your behaviors, and we're gonna create this together. I'm gonna do this live for you, and you can just follow along the steps so you can create your own journal in this free software. So first of all, we need to define the month, April 2026. So this is the journal that we want to use. We want to add a chart card. So in this card, I don't want to do it too quickly. So I just wrote 0 and I want to just create labels. So in this labels, I press on these. In this labels, I press labels, and this is where you see a green day, all right, and a red day, a label. So every time I take a trade, right, you can mark out green day or you can mark out red day. Did I win the trade or did I lose the trade? And I'm going to define what the green day and a red day means later on. But for now, you can just mark out green day and red day. So when you do that, let's say we take this trade right here. I say I'm usually counting it on the weeks, so it's easier for me to write. So on the week, it's the week 15, right? What day did I trade? On Monday. What is the symbol that I traded? I traded on the DAX. That's what I'm doing. And if you can see, if you're inside of the school community, you can see that I'm doing my journal inside of the school community for you to see live. Like I'm doing this. Week 15, Monday, DAX, and I can write something that makes me like intrigued to go and read it. 1 pip from stop loss. All right? Or no, not from TP. MO, yeah, that's it. 1 pip DAX, 1 pip from stop loss. So what I did here is I wrote the date, I wrote the week, I wrote the day, I wrote the symbol that I traded, and I wrote what happened. 1 pip from from TP. And that's the heading that I'm using on this journal. And if I jump to trading view, that's the screenshot that I need for me to recess and analyze later on. So this is a perfect example. 1 pip from take profit. All right. 1 pip. Okay, let's say I took this trade, 1 pip from take profit, and this is what I do. I remove these, I close these, so I have it clean. This is what I do. I screenshot, I press Control, Alt, and S, and it creates a screenshot for me. This is on a Windows or PC. Or else I can take a screenshot using this take a snapshot. I create a copy image or download image, which is what I did right now in the shortcut. I downloaded the image, I can press here. And I usually do that. I take a 1 hour also to identify, like, why did I take this trade? Because the liquidity or the trend was not correct. So I jump to the 1 hour. This is what I do. I jump to the 1 hour. I also take a screenshot right here. And I jump to the 15 minute to take a screenshot right here. Now, I have 3 screenshots right now in my download file. So what do? I take all these 3 screenshots, I insert them in, and usually when I trade, I write notes. This and this and this happened. This and this and this happened. Blah, 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 blah. All right? And then I screenshot it so I can remind myself what I wrote inside of the journal. So I'm putting this inside of my journal right here, and this is what I write. I have 3 points, right? I press, let me do this because I feel like I'm doing this. I press list, all right, and I press bullet list or numbers list. I usually use bullet list. Improve or what I did good, improvement points, would I take this trade again? If not, why? This is what I did good. Would I take this trade again? If not, why? So I'm answering these questions to myself, all right? what I did good. I entered with all confluences, and will I take this trade again? Yes, because I followed my rules, I followed proper risk, and I did what I was supposed to do. All right, improvement points. So what is the improvement points that I need to improve to next time? Be close to the market when you're entering. It's a 1 minute candle that needs to be closed on the correct time frame. Be willing to not risk the entire move or take partial profits. That's it. That is it. That's how I write my journal. That's what works for me. So let's create a copy of this copy card, and let's write DAX loss bad decision making. All right, I create a card right here, loss bad decision making, and this is the label that I'm using. So what do I want to do? I want to change or edit the label to a red day. This was a red day. This was a bad trade. So eventually you will have April, May, August, September. You have a lot of them. And the thing you want to do is you want to narrow it down so you can do a filter right here. You filter it out based on the labels that you've been doing. I just want you to see this based on the labels. All right, search label, red one. So you can see if you block out just the label, I clear it. If you block out all the red days, you can see that these are the red days that's happening, and you can dissect and analyze them once every 2 weeks, so once every month, and you can just you dissect your own behavior in your trading this way. This has improved my trading so much because I'm figuring out my behaviors. I'm also talking to myself inside of the journal. Do as you want inside of the journal as long as you have your trades documented inside with labels. So it's easier for you to see. And it's also easier for you to see, you know what? You know what? You're seeing them right here. And you can see I have red day, and red day. And after 3 red days, that's when I tilt. That's when I break or blow my account and I want to see what's happening. So when you see that you're coming through from 3 red days, you can see the way that you can maybe stop yourself or be more stingy or be more precise with your entry and your risk, because this is the time that you know based on your journal that you usually blow accounts. So you stop yourself. All right, that's about it from trading journal. Just let me look at the things so I don't miss anything. How do you feel before and after? It's also a good way to, here you can write the emotions. Also, be close to market open. The emotions is what you want to trade basically. You want to write, not trade. When you want to write basically so you can see what's happening. I usually write the emotions inside of what's happening at the moment in live environment, and it's a good way to also reflect on it inside of your journal. I just had a I came late to the market. I was stressed. I felt like overwhelmed because I just came from a loss and I took another loss after that. I didn't know what to do, so I traded even more to revenge trade and get back the money that I just lost, and it eventually blew my account. That's a good way to explain it inside of your journal. All right, that's let me just say that the key concept. You don't improve by trading more. That's the thing I said in the beginning. You don't improve by taking more trades and and precise and adjusting your trades. You improve by reviewing yourself. This as a game, trading is a game on personal development, basically. If you are a person that likes to develop yourself and likes to improve yourself as a person, you will become eventually a profitable trader. You will eventually be making money from the market and master this skill because you're always dissecting yourself and looking at yourself objectively of what you need to improve. Let's recap a bit. I talked about three things. Journal builds awareness. That's what it does. Tracking shows your patterns. The patterns that, as Tony Robbins say, successful people have successful patterns. What are they doing? We just need to follow them. And we can see our patterns by seeing or reading our own journal. And reviewing those patterns is what makes us know what to change and what to improve and how we can become better. So, lesson check-in. What made journaling clearer for you in this lesson? What make what made it clearer for you? Just one sentence and share it below to the others and for yourself to be engaged inside of your own learning. As always, follow me on YouTube. If you like this video, follow me on Instagram because I'm sharing things over there that's not a part of this course, but it's in the same subject as we are talking about right now, which is trading. And if you haven't done it already, join us inside of the school community. All right, talk to you in the next lesson. Have a great day. In this lesson, I want to redefine what a green day is. So when we trade, we have red days and green days. You hear that a lot probably. I had a losing week, a green week, or a losing week, a red week, or a winning week, a green week. But I want to redefine what defines a green day. All right? And it's not profit and loss. It's not what your P&L, profit and loss, says at the end of the week or end of the month. So I want to redefine what a green day is, and I want to shift your direction regarding how to define a green day. So I wrote this into a journal, and I'm going to read it for you. What defines a green day? Before we enter and discuss how to review our journal and how we review our trades. So definition of a green day. I'm going to read this for you. How to make every day a green day. I want to redefine what a green and red day is for me, for you. If I can come to the market, if we come to the market, having no intentions and no expectations, we show patience, we only take trades that fit our setup and trust the setup to play out and apply good risk management and accept a small loss, that's an absolute green day. Why? Because when we think that way, we think about it in the process. I become disconnected. We become disconnected from the money, and we will start to see our trading improve 10x faster. Why? Because we're forcing our brain to focus on the process and not the profits. So if you come to the market, you see a setup, you check off everything from the checklist, you apply good risk management, you are patient, you're waiting for the trade to play out, to take out either your stop loss or your take profit, and you've applied good risk, that is an absolute green day. Why? Because winning does not matter and losing does not matter. And if you keep removing yourself from needing to win or needing to lose, you're eventually, based on the risk reward you use, based on probabilities, based on how you risk, at the end of the month, you will be profitable. You will have a plus in your account. Why? Because you're redirecting your brain to focus on what a green day actually means. It's not about the win, it's not about the loss. All right? So this is so important to trading. This is so important because we have learned that we need to always win, and if we don't win, we get in harder and we try even more, and then that is the thing. If you have a bad decision making in your trading, that breaks what a green day is. So this is what I suggest that you do. Every time you win or lose in the market, you don't check on the win or the loss. You check on your decision making. You should be asking yourself like this. This is just a imaginary trade. This, right? Let me see. I took this trade, let's say, and I marked it out as a red because it's a red day because I lost. Loss, bad decisions. So I should be making my decision based on, let's say, loss 0.1%. Okay? Not by decisions. I should mark out the green day by the decision making that I'm doing, if it's a good or a bad decision making. Um, then I check the trade. Let's see. Let's see, if I have a checklist that I'm following, my checklist is saying I'm waiting for the trend to happen, right? My trend, let's say my trend is bullish. I'm waiting for a liquidity sweep. It swept liquidity. I'm waiting for a break of structure. It broke structure right here. I'm waiting for a fair value gap reaction. It gave me a fair value gap reaction right here and right here. And then I applied risk and then I entered the trade. Does this mean, let's say this took me out. Let's say, if I can do that, let me show an example of how I mean. All right, let's say this trade took me out. It went like this, it continued like this, and it continued like this, and it took me out. This doesn't mean that we screenshot this and we add it to our journal right here as a red marker. We add it as a green day, and we can even redefine it. Green day. We add it as a green day. Why? Because our decision making was based on the process. It was not based on the result of the trade. I'm really pushing on this because this is so important in trading. Because this is where people break. We use this metaphor. The process is the goal. The work is the goal. The mindset behind it is the because trading is decision making at the end of the day. We are making decisions in the short time span that is probably stressful for a lot of people, but we are taking the entire day's decision making focused on taking that trade. If our decision making is wrong, then that is a red day. And that's what we should be marking out on our journal. We should not mark out this as a red day because we lost. We should mark it out as a red day. If this is if this what happens, let's see here. Let me give you another example what a red day is. So this is the trade. All right, this is the trade. Let me show you an example. I'm tired. I'm fed up. I've been inside of the market for 2 hours. I want to leave the market, and I've been waiting for it to sweep liquidity for 2.5 hours. And now, as soon as it swept liquidity, I'm just, you know what? Let me just take the trade. I took the trade. I put my stop loss. I put my stop loss right here because I'm thinking that this candle will go up, and it took me out. Now, did I wait for a break of structure? No. Did I wait for a fair value gap reaction? No. Did I apply good risk? Maybe, but it still didn't follow the checklist that I have to be able to take those trades. I just took it on a liquidity sweep. What does that mean? This is the time where I screenshot this trade. I go to my journal. I press here. I write the week. I write the DAX or NQ. Loss, red day, bad decision making, tired, right? And I insert the screenshot right here, and this is what it gives me. And this is what I write. I label it as a red day. And these are the trades that we need to review and get back on and write. What did I did good? What did I did wrong? And how was my decision making? And also, would I have been taking this trade if I'm seeing it right now in hindsight, this trade, would I take the same trade again? That's a good question to ask. If no, then you should check what you're doing wrong. So this is what usually should be marked out. Red days based on the definition that we just redefined what a red green day means, and red days is based on the decision making that we are doing. Because if we're doing the correct decision making on a daily basis, not based on the red or green days or wins on losses based on our P&L, I guarantee you that it will be profitable at the end of the month. All right, that's about it for this lesson of redefining what a green day is. I just want to have you do a short check-in about this, what you learned from this green day definition of the green day. One sentence is enough. Share it below. Feel free to do that. And as always, if you like this video, feel free to follow me on YouTube, on Instagram, where I share content about trading, but not inside that fits inside of this course. So feel free to subscribe there. And if you haven't done it already, join the school community. Talk to you in the next lesson. Have a good day. Welcome to this lesson where I'm going to share with you how to review your trades. So I'm going to talk about three things: reviewing trades weekly, why that is important, identifying what worked and what didn't work in your trades, and improving your decision making, because that is what we define as a green day. Good decisions. All right? So first things first, why do you want to review your trades? Why do people want to review their trades? What is it in your journal that you want to see? You want to review your trades because of the wins and losses and executions. Basically, the executions that you're doing. The wins and losses does not matter, but it's a um, good way to see what wins and what losses that works for you. Some people win more when taking longs. Some people win more when taking shorts, and you want to see where it correlates with your wins and losses and execution. You want to see what worked. You want to see what worked and what you did. What worked for you during this week. And you also want to improve your decision making for the next week, next upcoming weeks, and the next trades that you're taking. This, you need to basically dissect yourself and your behaviors based on what you're seeing inside of your journal. Okay, what do you review? The things that you want to review is, did I follow my checklist? That's one of the things. Do you follow your checklist in your journal? Did I enter too early or correctly? Did I enter correctly or did I enter too early or did I wait a while before entering? How did I manage my risk? Did I manage my risk properly? How was my decision making? This is probably the pinnacle of the results you're going to get in your trading. Because if your decision making is correct, then you will get good results eventually. Correct does not mean that you're not losing trades. Correct meaning that you're following the decision making that you said as what defines a green day. This is what defines a green day. If you have no intentions and no expectations, you show patience, you only take trades that fit your setup and trust system. Let it play out. You take the trade and let it play out. Apply good risk management and accepting a small loss and leaving. If you do this on a daily basis, your trading will improve 10x. So, what would I do differently? This is a good question to ask also in your journal where you say, or you ask yourself, looking at this trade right now, when you see a trade that you've taken, all right, you've taken this trade, let's say, in hindsight, you're looking at this, will I take the same trade again? Is it yes? Then great, continue doing the same thing. If it's a no, describe why you're not taking the same trade again. So I took this trade just only with a liquidity sweep and I followed the trend. So I just followed these two. Now, why didn't I follow the 1 minute breakup structure and fair value gap? Great question to ask. So next time I should put something inside. So I should mark out with a pen or piece of paper, trend, liquidity sweep, 1 minute breakup structure, fair value gap. When I do that with my hands, I leave my pen and my pad and I enter the trade. Or I want to do it with my keyboard. It all depends on what works for you and what makes you, or almost forces you to act, to swipe off the checklist so you don't make the bad decisions that you did inside of your journal. And will I take yeah, that's the thing. What would I do differently and what would I take this trade again? That's basically what I mentioned. And write it down and repeat it every day during the upcoming week. Because if you there's something called spaced repetition. If you learn something now that you know that you need to change your behavior by checking the checkbox, put it on a piece of paper and put it in front of you, and you have to read it until it becomes a part of you on a daily basis. So you keep doing the same. You change your behavior. You force a change in your behavior, and that's how you review your trades. And by reviewing your trades, you also go back to the trades that you've taken on a daily basis for the entire week. The thing I'm doing, I'm not trading on Fridays. On Fridays, I watch the trades that I've taken the entire week, and I'm reviewing the trades. I'm reviewing my decision making inside of my journal so I can know what I need to change, when I need to improve, what I need to adjust to the following week. This never stops, by the way. You never stop journaling your trades. So the days that you don't take a trade because you don't feel that there is any setups that appears, you don't need a journal on that. You can just write there's no setup present because there's not something that you can improve based on that there was nothing in the market. And you watch your trades. You read the description that you've written about yourself. You recheck your trades and see did you do good, what did you do wrong, what did you need to improve, and will you take this trade again? So at the end of the week, you want to see how many green days you have. So at the end of the week, if you followed this process to the T, if you mastered the process that will bring you, let me give you an example. So a person who has a healthy body, he does some things, right? He sleeps maybe good. He sleeps maybe 7 hours a day. He drinks a lot of water. He doesn't eat sugar, and he works out 4 to 5 times a week in the gym, and he eats a lot of protein, and he drinks a protein shake a day. So that's the habits of a person that's fit, have a fit body for the summer, right? These are the habits that you are doing the same in trading. What are the habits that the professional day traders that they are doing on a daily basis that gives them the results that you need? So do those habits. And if you do those habits at over and over and over again, it will become a part of your behavior. And the thing that I need to mention, I learned this from Eben Pagan, and I learned this from Wyatt Woodsmall and Tony Robbins, and the guys talking about NLP. And the definition is this: learning equals behavior change. Learning equals behavior change. If you if you do everything correctly, if you do everything correctly based on what you've learned, your behavior will change. If you learn something, if you listen to it, if you watch the video about it, if you keep taking the same bad trades and you're reviewing your trade and you're learning about yourself, but your behavior does not change, then you have not learned anything. Learning equals behavior change. If you learn something and you change your behavior from what the thing that you've learned, then you will get the success. Then your behavior will change inside of the market. And unfortunately, when we grow up, we need to have a massive trauma, some of us, or massive spike to our ego, and to be able to change our behavior because we can't stand it anymore, right? So I'm going to say this again. Learning equals behavior change. If you learn something and does it and don't find a way for you to improve it in the market, like putting a post-it, put it in front of you, reading it every day before you enter the market, and doing something that forces your behavior to change, then you then your behavior will change. Your actions will change eventually. That means that you learned it. All right, that's how you review your trades, and feel free to check in. What made reviewing your trades clearer for you in this lesson? Let me know. Just write one sentence. This is for you, so you can learn more actively, and you can force your brain to pick out something from your brain that forces you to change your behavior at the end, right? And if you like this video, feel free to follow me on YouTube, on Instagram, where I post content over there where it's not a part of this course, but it's a part of trading. And if you haven't done it already, join the school community. All right. Have a great day. Take care. Welcome to this lesson where I'm gonna talk to you about the word tilt. All right. I'm gonna talk to you about three things in this lesson. Tilt. equals loss of control. Tilt comes from emotional spikes, and tilt leads to account damage. So the word tilt is being thrown around a lot in the trading space, and I want to just Google it for you and define the word tilt. Tilt is a poker term for a state of mental or emotional confusion or frustration in which a player adapts a suboptimal strategy, usually resulting in the player becoming overly aggressive. What is the meaning of word tilt? To cause to lean, incline, slope, or slant. Right? You tilt. You'll tilt over. Like the Tower of Pisa is tilting. Right? So the definition has two meanings. Tilting is that it almost feels like, if you haven't been through a tilt before, it almost feels like somebody else is driving the car and you're in loss of control. And the more you want to take control and bring the control back, is the more tilt the more you start losing control. It's like quicksand. If you're standing in quicksand and you want to move and swim out of the quicksand, the more you sink. That's the thing. When you take one loss with trading, you want to take another trade to gain back that loss, and you lose even more, and then you want to gain back that loss, and then you lose even more, and you you go down into the quicksand until you blow up. That's what tilt is doing with you. And that's why I'm saying to people, don't go in or don't start with your own money. Start with a demo account, use that, try that. Even some people even lose or tilt on a demo account because they can't stand losing. So it's a good way to like learn your behavior through tilting. And most people don't know this until they've been through it. It's like I don't know even what happened. It was like I was watching myself taking trades and I couldn't stop myself. That's a dangerous place to be in, especially with your own money, because we all have responsibilities and we all have things to do with the money, and we don't want to lose it. So, tilt, loss of control. You stop following your rules. This is what happens. You have rules, you have a trading plan, you have a checklist. You stop following, all those go out of the window, unfortunately. You stop following your rules. You enter trades without confirmation. You just jump into trades. You don't know what's happening. You're removing your stop loss. You're breaking the entire system that you've created because you're tilting. You're losing control because of the fire. There's a fire emoji because of the emotions are taking over. You're losing control. And the thing is, that's the scary part. You know that you're doing a mistake. You know that it's something wrong that's happening, but you still can't stop it. All right, tilt comes from emotional spikes. Tilt usually often happens after a loss. You want it back. You want a revenge trade. You lost a trade. You lost $100. You want to go back into the market. You put in another $100. You lose that, and then you go in with $200 and you lose that, and it just spirals out of control. After a win, most people don't talk about this, but after you make a big win, those are usually being overconfident. Usually the biggest losses happen after a big win because you feel invincible. You feel like you're on top of the world. You feel unstoppable. You feel like nobody can touch you because you just made $500 from the market. But it's a part of the game. It's not about winning the money. It's about keeping it and staying steady. This usually happens to beginners. Why? Because they have been in a losing streak or losses and they haven't figured trading out for so long. And after they make one or two or three wins, they feel unstoppable because they know that this is a balance between the two. There's a balance, not they know, there's a balance between the two. Losses, that's the thing I want to instill in you. Losses does not matter and wins does not matter. It's the process, it's the green days that matters. The good decision making that you're doing on a daily basis that matters. Both can push you out of your system. That's the real truth. Tilt leads to account damage. That's what it does. One bad trade becomes three, three bad trades becomes five, five bad trades becomes a blown account. Risk increases without thinking. The counterintuitive here is when you risk $100 and you lose that, you should drop down to the half of the risk until you get the initial risk that you started with, which is $100 back. Because if you risk 50% of your money, you need to gain 100% of your money back to to come back to break even. Not the opposite. Not if you risk $100, you lose $100, you double it to 200, and then you double that. If you lose that, it doesn't work. That you just it breaks down your equity curve even more. You give back days or weeks and minutes. That's if you've been through this. It really excuse me. You trade, right, for a week or two or three. You feel like you're on top of the world. You made $5,000 on these three, and you feel like you're figure it out. I've figured out trading. I know what's good for me. I'm a millionaire. You know, look, mom, I've made it. Right? I'm joking about this because this had happened to me, right? And then one day comes and you blow all of it in one trade because you over tilt. You couldn't stop yourself. I couldn't stop myself. It feels like somebody else is watching and I'm seeing myself driving the car and I can't stop myself. So I give back all of my progress that I've done for 3 weeks in one day, in 1 minute, in one trade, right? That's a dangerous place to be. So, how do we fix those things? How do we deal with tilt? We deal with tilt by having a hard stop rule. After two losses, I stop trading. Basically, is what I'm saying is following your trading plan. When I reduce risk immediately, I reduce risk immediately after a loss. I take a loss, I go back to minimum risk. I step away from the chart 5 to 10 minutes minimum after I'm taking a loss. So if the market just stopped me out, I'm taking a 5 minute break. I'm going to the bathroom, I'm drinking some water, I'm doing some stretches and breathing exercises to get myself back even keeled. How to also deal with tilt is to put a timer. I have a timer right here. You can put a timer for 45 minutes, and after the timer rings, it just pops up on your screen and it stops you by just redirecting your brain. Okay, you know what? I'm inside of here. I'm inside of the trade. I need to be focused. I'm focused here on what I'm doing because I don't want to lose control. And also, last but not least, follow your checklist strictly. If you don't have a checklist, there is no trade to take. You don't sit next to the market because it's a dangerous place to be. It's a dangerous place to be. To trade just randomly. You come to the market and you know what, let me just jump into this and see what happens. If you don't have a checklist or something to follow, you leave. That is the reason why I don't trade on Fridays. Because I don't trade on Fridays, not just because it's Friday, just because it's on Fridays I'm more relaxed. I'm more casual. And when I'm more relaxed and casual, I don't deal with tilt that good because I'm almost opening the door for tilt to come into the market or come into my decision making and makes me be more free with the risk, which is dangerous to be. Because when we're being more free with the risk, we start risking $100, $200, $500, we keep losing and we lost all the progress that we made the entire week because of one day or one trade. And if you can't do those things, we need to have something that blocks us out. And this is something that I've been telling so many people about is the cold turkey blocker. If you haven't tried the cold turkey blocker, use it. This is what the cold turkey blocker does. It blocks you out. You write the name of the application as TradingView or your VT Market or your broker from that's downloaded inside of the computer of yours. And as soon as you feel that you're about to tilt, or as soon as you've taken two trades and you're following your plan, you block yourself out. You press on off and you block yourself out for an hour or two. So it forces you to leave the market. You can't open up the application because you've already blocked yourself. You can't open up the block. You can't open up the block until the time frame continues. And this eliminates the need to make mistakes. This eliminates the need to re-enter the trade, over leverage, go inside and revenge trade and lose more money. And the first thing that you need to do before you tilt is it's a good way to find where it happens. The moment before you're tilting. What happened before? It's a good way to identify. That's the first thing. Get good way to identify what happened before you tilted. So I lost one trade and I lost another one and I lost another one. And this is the scenario. When this happens, be extra cautious and write it down and have it memorized that you know in the future so you can change your behavior to not tilt anymore. And all these things are good. Cold turkey blocker, all the how to deal with tilt and stop losses and rules and how to make those things correctly. And the thing that's a bit the most important for me is this one. You know, it has to matter to you. It has to matter to you because tilt blows account, makes you lose all your money, makes you destroy your life with money because you can't control your emotions after a loss. And if it doesn't matter to you, if it matters to you, you find a way to stop it. You find a way to stop yourself. Tilt is a fight between you and you. We all have different sizes of egos, right? But it has to matter to you more than the trade itself. So I have pictures of my family members here. My wife is there. Me and my wife, my kids is there. I have things that remind me of something more important than trading. So something more important for me to think about so I don't tilt. So I've come to the stage. Sometimes I use the cold turkey blocker, which is this software right here, cold turkey block that I bought. So it has to matter to you. When it matters to you that much, you find a way to deal with your tilt. All right, I talked about tilt and I talked about three things inside of this lesson. Tilt starts before the trade. The danger is in that moment. And control comes from removing the action. When you remove the action, like blocking yourself out, you can't fail anymore because you've blocked yourself out already. So lesson check-in. Describe the last time you felt the moment before entering a trade you knew you shouldn't. What did it feel like and what did you do? I'm interested in knowing this. So feel free to comment it in the comment section below. And as always, if you liked this lesson, feel free to follow me along on YouTube, subscribe over there, and on Instagram. And if you haven't done it already, join the school community. I talk to you there, and I see you on the next lesson. Have a great day. Hello and welcome to this lesson where I'm gonna share with you how to use the behavior finder. The behavior finder is so important to find where our behaviors and our trades are shifting or not working, what we're doing wrong, what the mistakes we're doing so we can adjust them, fix them, see them in an objective way so we can change them eventually. So I've wrote in a description of how to use the behavior finder, and I'm just gonna walk you through it. And feel free to respect this behavior finder and don't remove the check marks right here. Right? Rules. Please check a check marks in the corresponding box each time you commit the error. So there are a lot of behaviors that we are doing. These behaviors are the most common ones. The most dangerous one is the tilt, right? Determine which behavior is outpacing the rest and kill the behavior as quickly as possible. So you will find that maybe you enter too late on the trades and you see that these behaviors keep happening on a daily basis or on a weekly basis. So you will get a different perspective of what behavior you're doing the most. And then we need to find a way to stop it. Once you have killed the worst behavior, then move on to the next one. So we don't want to change too much too quickly. So we usually, when we start using the behavior finder, we find out that we maybe take poor risk reward trades and we exit too late on a trade and we have the wrong position size. And this is what you usually want to do. We want to fix all three of them at the same time. What I want you to do is to focus on one, change your behavior around it after it becomes a part of your trading nature, and then you change it. And when it becomes a part of you, you jump on to the next behavior and focus on that. Think about it. This is about, let's say how many is it? Let's say it's 12 behaviors, right? Let's say if every month you focus on improving one behavior. Let's say you have all of them, which is a lot. If you have a focus on each behavior. Number one, in January, you focus on having better RR trades, not poor risk reward trades. That becomes a part of your nature. And then on February, you focus on entering too soon. And then not entering too soon, just focusing on that. So, the thing you want to do when you take a trade, let's say you took this trade, all right? This is the trade that you've taken. The checklist is saying trend, yes, no. The trend is following. Liquidity sweep, yes, it swept liquidity. 1 minute breakup structure, no, it didn't do 1 minute breakup structure and it didn't do a fair value gap, but I still entered. So what did I do? I entered too soon. I screenshot this and you add it to your journal and then you jump to your behavior finder and this is where you say I entered too soon. So on the 12th of 12th of April, I entered too soon on that trade. And then I did the same thing on the the 18th of April. What's going on? And then I did the same on the 1st of May. Okay, what's going on? So you can see that your behavior is happening, that you're entering too soon. Then readjust, check your behavior, check what you're doing, go back to the journal and check, you know what, why am I not entering this trade correctly? Is it because I'm overconfident? I just came from 3 or 4 wins and I'm doing the same behavior. And then you're dissecting your behavior in a way. I really think this is so exciting because we all have different ways to improve. We all have different greed levels, patient levels, fear levels, and we all have different ways that we can improve our behavior in. All right? So, this is the same thing that you're doing with all of them. Hesitate and miss the entry, right? If you hesitate and miss the entry like 8 times, okay, it shouldn't go up to 10 times because you should fix your behavior because you're seeing it happening all over every time, every like 4 times a month or a couple of times a month and a couple of times a week. You've seen that your behavior that you're doing on a decision making. This will help you identify so you can readjust and make the best green day possible for you in the process because green day has been redefined by us. We define green day in this matter. We come into the market, we have no intentions and no expectations. We show patient, we take the trades based on our setup and our checklist. We apply good risk, we accept a small loss if we lose. That is an absolute green day. If we keep thinking that way, we are redirecting our focus from looking at the P&L, the profit and loss, and we start focusing on the process. Because if we do that, our trading will improve 10x faster. And this almost forces you to have good green days. Do you see all the moments that I'm talking about tilt? I'm talking about the behavior changes. I'm talking about learning equals behavior change. I'm talking about green days, the definition of green days. All of these things, we put them all together to get the best result in our trading. All right, that's about it of the behavior finder, explanation of the behavior finder. Feel free to use it. The link to this Excel file is down in the description. The only thing you need to do is click on the file and make a copy before you use it so you can create your own and readjust your colors and make it fit yourself. and your needs in trading. And as always, just drop one lesson of what you learned in this behavior finder and feel free to comment it below because you will learn more actively. And as always, if you like this video, feel free to share it on YouTube, share it with a friend, and follow me on YouTube and on Instagram. And if you haven't done it already, join the school community. Take care and see you on the next lesson. Bye. Welcome to this lesson where I'm going to talk to you about greed in the market. In this lesson, I'm going to share with you three things. That greed makes you hold on too long. Greed distorts your decisions, and greed is never satisfied. Greed is never satisfied. So I'm going to share with you a short story about the monkey trap. So hunters in the jungle, how do they catch monkeys? So they take a coconut, they make a small hole around the coconut, and they put a small fruit inside of the coconut, right? They make the hole just big enough for the monkey to put in his hand, but if the monkey makes a fist, the hand is locked inside of the coconut, right? So what does the hunter do? They make the hole, they tie a rope around the coconut, and they tie it around a tree. And the hunter goes back and sits and waits and looks at the monkey that creeps up and sees the coconut and sees the fruit inside of the coconut. He takes his hand in, the monkey, and he grabs the fruit inside of the coconut and he is stuck. And you can see the monkey just fighting. You can see videos of this on YouTube. You can see the monkey just fighting and wanting to get out of the coconut, but he can't. He can't. So the hunter comes up slowly and looks at the monkey, and the monkey freaks out, and the hunter just hits him in the head or grabs a bag and ties the monkey around inside of the bag, and he grabs it. And the only thing that the monkey needed to do was to let go of the fruit inside of the coconut, and he will be free. So the monkey basically risked his entire life because he's so greedy. He's so greedy that he's risking his entire life because the hunter is coming to take him because of this fruit. And this is what we need to do in our trading. We should not be focused on just the trade, because if we focus on just the trade, we are just like the monkey wanting the fruit. The only thing we need to do is just to let go, because that is our ego, the wanting to lose. That is our ego wanting more. When there's something inside of you telling you, let's take more, let's make more, let's do this more, $950 is not enough, let's wait for it to be 1,000, and then that it becomes 980 and goes back to 200 because we were so greedy. That's the thing. So how do we do it? Greed makes you hold on too long. That's It makes you hold on to a trade too long because we want too much. You don't take profit when you should. We don't take profits when we should. We have a plan on when we should take our profits, and we don't do it because we are greedy. We want more even when the plan is done. So we have a plan that we need to follow. I can take a 1 to 3 risk reward on my trade, but we don't follow it, even if it's done. We turn a good trade into a bad one because we are greedy. This is what greed does with our emotions and our decision making. It turns a good trade into a bad one because we wanted to take profit and we didn't, and it shifted back down, maybe took us out on break even or on stop. That's what greed does. It distorts our decision making. We ignore our take profit. We have a marked take profit, we ignore it because we want more. Because we just came from 3 losses and we want to take more profit to gain those losses back. We move targets without reason. We move our stop loss, right? We move our take not stop loss. We move our stop loss also because we can't stand losing. We stop following our system. We stop following our rules and trading plan because we are so greedy. Or greed is never satisfied. If you take one win, is that not enough based on your plan? What is your base hit? If you think about it, if you work a job, a 9 to 5, maybe your daily income will be between $150 and $200 average right? So if you take a trade and you make $150 or $200, is that not enough, right? Why are we fixating on $1,000 days and those things? Because if this replaces our 9 to 5 and we can do it by ourselves, is 150 and 200 not enough? It's like somebody's telling me, you know what, I give you $200 and you say, no, I don't want it. It's too little. I'd rather have zero because you're waiting for your stop loss to go down and take out your the price to go down and take out your stop loss. We always want more, unfortunately, but we need to control that. And I'm going to explain to you how at the end how to control that. And this is how consistency breaks. Because if we have a plan that we follow on a daily basis based on our base hits, so our greed level, it doesn't matter if it's satisfied or not, we have a base hit based on the data that we have, based on the trades that we have taken. So how do we control greed? First things first, when you use, by the way, let me just show you on the chart. When you use a position size calculator, this is why it's so good. We have a fixed stop loss area where we are just moving it and it adjusts our volume of the trades that we're taking. So if we say, you know what, I'm going to take this trade right here. We have a stop loss area right here. We put it at the liquidity level and we don't touch it. We don't touch it. We let the market come to us. We let the price hit this area, right? We don't move. We don't, because of if the candle comes close to it, we start moving it like this. You know what? I want to take more profit. I want to take more profit. We don't do that. So define take profits before entering. We're defining the take profits before entering, and we're marking it out where we want the price to go. And we also take partials at key levels because that's what I just mentioned. We have two take profits right here. So we have a key level, a liquidity. I don't usually say key levels, a liquidity right here. And we have another, let's say, you know what? Oh, we have another liquidity resting down here on this spike down right here. So we're taking profits on these areas and these areas right here. And you don't need to look at the chart anymore because you've already marked out your take profit and your stop loss area. And also move stop loss to break even. When we know, now the market didn't drop down as I wanted to, but when we know that our first take profit got hit, when the market goes to our take profit, we move our stop loss to break even. So I can't do that because of the spread and commission. We move our stop loss to break even, so we're inside the trade risk free. That's a good thing to know. So that's what we do. We should have a trading plan. We should have a checklist because a trading plan replaces our greed. Greed is not about the money. It's about letting go. Really, we win by relaxing and letting go. Letting go on the losses. Letting go on the I want to make more. You put your stop loss area you put your take profit area where it's most likely for the market to reverse from, and you leave it there. You don't move it. Okay, let's recap. In this lesson, I shared with you greed makes you hold on too long. It breaks your system because we're too greedy, and control comes from sticking to your plan. If you want control, you really take charge. The way to do it is to stick to your plan and leave the trade even when you know that you can get more profit because you're following your base hits. All right, lesson check-in. Think about the trade you were in profit, but you didn't take it. You were in a trade, you were in profit, but you didn't take it. What were you telling yourself in that moment? Let me take more profit. I can make more from this. What did you tell yourself in that moment? I would love to know that. All right, feel free to comment it in the comment section below. And as always, if you like this video, if you like this lesson, feel free to follow me on YouTube, on Instagram, and if you haven't done it already, join the school community. All right, take care and see you on the next lesson. Bye. Hello and welcome to this video, this lesson where I'm going to talk to you and go deep into risk management, the slow track strategy. So I'm going to talk about three things. I'm going to talk about start small and staying there, we earn the right to increase our risk. We can't risk more if we don't have any buffer. You reset fast when wrong. When you are wrong, because every blown account starts with one loss, right? And this is what we want to think about it regarding risk, is to think about it like a game. We want to level up like a game, slowly and surely. We don't want to level up too quick and then lose too quick. We don't want to gain 50 levels and lose every level that we got with one trade, with one loss. All right? We don't want to tilt, basically. So I've drawn out this slow track. This have taken me so many years to figure out, but feel free to screenshot this. Let me just make it bigger for you. So let me go through it slowly, and so you can see what I mean, and you can just follow the steps along. The thing with risk management is that you want to follow it like an edge. This is this should be a part of your edge. You should have a system in your risk management where you should know how much you are risking today. When you enter the market, you should know, you should have a sense of, you know what, I'm risking 0.5% today maximum. I can't risk more than that because I'm following my risk management strategy. Okay, so let's go through it. Basically, you know what, I like to draw. So let's jump into the whiteboard right here. Let me paste this inside of the whiteboard so I can draw and explain at the same time. All right. Here we go. So this is called the slow track risk management system. Why is it called the slow track? Because this protects your psychology. This protects the mental damage that the losses create in us when we trade. So this is the slow track that takes a bit longer, but it's more comfortable on the psychology because you're not losing that much and you're not seeing huge losses from your um, trading portfolio get removed. I'm also going to show you this inside of equity curve so you can get a sense of how it can look like. But let's jump into it. First things first, we have to focus on our starting balance. We have a starting balance when we enter um, our first trade. Let's say 100K is our starting balance, and I'm using this number just to bring it back to the equity curve later on. So 100 balance, we maybe buy a funded account, or we insert some money into our live account and we're excited. Usually what happens when we're excited, we take a loss. We take a loss or we take a win, right? So I'm going to start with it being a win. Let's see here. I'm going to jump to it. The first trade you take, this is a slow track. This is, by the way, a risk reward on 1 to 3%. And there we go. Every trade you take, it's a 3% gain. So when you risk 0.5% on that first trade on your starting balance, which is 100K, let's say you win that trade. What do? After you win that trade, you risk more because you have some buffer to be able to risk more. The rule of thumb here, we use our wins as a buffer before increasing risk. We need to earn our way to risk more. We can't risk capital that we don't have yet. So basically, you're not losing anything because you're risking the capital you just gained. Not all of it, some of it, to be able to use that capital as a leverage to gain more profits, basically. So the first win you do, you've risked 0.5%, so you have a 1.5% gain. Sorry about that. Gain. So from this 1.5% gain, you risk 1%. After risking 1%, let's keep it that you're winning, continue winning. You're winning this trade. Also, now you up your risk. Either you up your risk to between 1 to 2% so you can get more leverage on the wins. You have more buffer to lose. So if you're losing, you're just losing the wins, and that is fine. And if you win that trade, if you win 3 trades in a row, to remove the overconfidence and to remove the I don't need to lose. I don't want to lose the profits that I just made. You start the process over. You jump back and start the process over by risking the minimal amount. What does this do? It helps you gain some leverage, or this is the equity curve. It helps you gain some profits, and then it flattens it out. Then you gain some profit, and then it flattens it out, and then you gain. This is how we want our equity curve to be, basically. Now, this is a perfect scenario, right? Let's add in some losses right here. So we we start the trade. We start the risking 0.5% and we lose. We lose 0.5% and then this is our starting balance. 100K, we take our first trade and we lose. We went under the starting balance. As long as you are under the starting balance, that's a dangerous area to be because every blown account starts with one loss. And we want to cut that loss and be over the starting balance as quickly as possible by not risking more, by risking less. So how do we do it? We risk 0.5%. If we go under the starting balance, if we lose, we keep risking 0.5% until we gain capital or we gain buffer, so we are above the starting balance, right? So we risk 0.5%, we lose, we take a loss. What do we do after that? We risk 0.5%. We take another loss, and then we keep risking 0.5% until you pass the starting balance, is what it says right here. Now, let's say we risk 0.5%, we lose, right? And then we risk 0.5% again, and then we win. What do we do? Because it's a 1 to 3, we have now a 1% buffer, right? Because we are 1% over the starting balance. We are 1% over the starting balance right here. Let me make this 1% over the starting balance right here in this area. So what do? We up our risk because we have some buffer, and then we risk 1%, and then we keep risking 1%, and until we win, we start over the process again. And this is the system that I've been using for so long, and like everybody says, like, risk 1%, risk. It doesn't work for me. It doesn't work for my way of trading. So that's why I've created this for myself. And now I'm sharing it to you. All right, let's jump right into the equity curve, which dropped all the way down. And I have two examples I want to show you. And I was thinking I'm going to remove the data here, and we're going to do it together. So I have the one with a loss, like you start your first trade with a loss, and then you start your first trade with a win. So with a win and with a loss. I want to show you how the equity curve will be basically, and I hope I can do my best to crunch the numbers correctly. So let's say, you know what, we start off with this, right? We start off with this by risking 0.5%. So let's make this so we can see both of them if it works. Yeah, I'm gonna make it visible for you. All right, this is a rough estimation, by the way, just to give you some perspective on this. So first things first, I'm gonna start with a loss, right? I'm gonna risk 0.5%. What happens? My starting balance will be 99,500. Let me do this for you so you can see what happens. This is my starting balance. The first trade I took was a loss. Okay, the first trade I took was a loss. I'm risking the same amount again because I'm under the starting balance, which is 100K. So I'm risking the same amount, which is 0.5, and then I lost again. So when I lost again, this is the loss, risk 0.5, I lost again. So it becomes 99. There we go. This is what usually happens. People freak out, and this is how they blow account because this is where it starts, basically. You lose one trade, then you lose another trade. And think about it. If you have taken 10 trades with the strategy that we're using, how you can't not possibly have 10 trades, losing trades in a row. That's why this system works. So when you keep losing, you keep risking 0.5% until you win. Let's say you win this trade, right? This trade is a winner. What do you do? This trade is a winner. So the amount bumps up to um, gives you extra buffer of $500, which is 0.5%, right? So you took this trade again, and then you win. What do? You jump back up and you risk 0.5% again, because that's the only buffer that you have. Really, you can also risk 1% because you have that 500 as buffer and the 0.5% as the usual starting balance. So you can do it like both ways. So, but in this scenario, let us just follow the 0.5%. But in this scenario, I would like to bump the risk up to 1%, right? I bump the risk up to 1%. I take the next trade on 1%. This gives me a 3% return. So now, this is how it works. This is where we use the wins as a buffer before increasing the risk. So we increase the risk because we have $500, 0.5% in risk. So we take the first trade, we win that trade, or this is the first trade, we win that trade, the second trade, we win that trade, and now we have a buffer now to be able to risk, as it says right here, right? I took this trade, I won, I'm able to risk either 1%, no, I won to, and we are right here, we are in this area. I'm able to risk between 1 to 2%. It all depends on me. If you know that you have a perfect setup, feel free to risk 2%. Why? Because it's okay, because you're using your wins as buffer. You have a buffer to be able to lose. You're not losing anything at the end because you have 3.5% in that you can use as a buffer. If you lose, you still have, if you risk 2%, you still have 1%, 1.5% left. So in this scenario, 1.5 to 1, because this is a slow track, usually what we are risking is 1%. But you know what? Let's make it 2%. We're risking 2% and we gain 6% on that. This is 109,500, right? This is where we gain our leverage, and this is how we make profits, basically, and in a good way. Not with pushing too much risk, because even if we lost this trade, we could have um, used more risk as leverage after that. And this is the thing. We won 3 trades, 1 win, 2 wins, 3 wins. And this is when we get overconfident and we don't want it to affect our trading, so we start all over. We start risking 0.5% because we are on a winning streak, and this is where we use trade 1, right? Trade 2, trade 3. And this is min or lowest risk. We go back to the lowest risk because we are almost, what do you call it? Um, we're almost preparing for a loss because loss will come eventually. And we're always preparing for a loss because we don't want the 2% trade to be a part of that loss. It can happen, of course, but we want to have the lowest risk to be able to count for a loss that is coming, because it's guaranteed that it's coming, but we don't know when it's coming, right? So in this scenario, let's say, you know what, we didn't lose. We won the trade. We got lucky and it continued. You know, our overconfidence got us um, more in the market and we won that trade. I hope it's correct. There we go. We won that trade. What do we do after that? We still risk 0.5% until we lose. And you see that we just lost the trade. Let me just count. That's correct, right? No. We just lost this trade. We lost this trade, and this is what happens. You we don't freak out, right? This is usually what happens. We lose this trade and we start because we lost some part of our profits and we bump up the risk because we have leverage. That's not how we do it. We just follow the system. So we lost this trade, right? And we keep risking 0.5% until we win our first trade. So we risk 0.5% and we lose this trade again. What happens? And we risk 0.5%, we lose that trade again. What happens? Uh, how much is it? I think it's right. Yeah. See, we lost three trades in a row, and we lost, let's say we lost the other trade. This is fine. This is not affecting our equity curve that much. And that's a good thing that we are on this level. So we lost that trade. We keep going like this until we win the trade. So let's say, no, you know what? Let's say the fourth trade, we won this trade. So we won this trade. This means that we are at, no, this is the correct amount. We are at 110,500, right? We won this trade. We are at 110. No, that's not correct. We are on this amount. So this is what the slow track is. We because we won this amount, we have the leverage to be able to risk more in the trade. We're able to risk more in the trade. Why? Because we have some buffer. We have some buffer inside our trading, so we can inside our profits. So what do we do after risking 0.5%? We go through the process over and over again. So we start risking 1%, all right? We are in this level right here. We're not on this level yet. We start risking 1%. And when we risk 1%, let's say, all right, we lost this trade. So we are back at this level right here. We lost this trade. Okay, what do we do when we lose that trade? We jump back to our lowest amount risk. Uh, all right, we lost that trade. And this is, I'm doing this manually for you to see how this works and understand how this works. And now we keep losing. We lost this another trade. The thing is to not let it get to us because we see our equity curve. Our mind doesn't like to see a drawdown, right? And this is what we want to do. Basically, when we win our next trade, let's say we lose that, we win this trade, we go back to this is the yo-yo effect, right, of trading. We have how much? We win that trade, we are back to that level, that area, and this is when we risk more. We risk this 1%, and we gain back basically all of our losses and more. That's not correct. This is it. 110, 13. This is it. Then we win this trade, and now we are able to up our risk. But you know what? I don't feel comfortable upping my risk. So what do? I keep risking 1%. I keep risking 1%, and this is where I gain my profits. I gain my profits, and I think, you know what? I'm gonna win this trade, but I'm losing. I lost this trade again, and I go back to my initial starting minimal balance, and I win this trade. I lost this one with 1%. I win this trade. It becomes 113,500, and this is basically how we do it. And I get into a rut, and this is what happens. I win one trade, I lose one trade. I win one trade, I lose one trade. And now I can up my risk. So I'm upping my risk but I lost this trade. So what happens? I'm at 500 here. Then I go down and I risk less. So what happens? I'm back to this area right here. No, I take this trade and I win that trade. Let's say 504. And this is how it works, basically. This is how it works, basically. And then you see a beautiful trade. You take that 1% trade after that, or you start risking more. But you have the ability to risk more, but you don't want to because you just want this. You're on this 1%, and then this is where it happens. There we go. This is where it happens. You take the next trade, and then maybe you win the next trade, and then like look at that equity curve. Because when we hit 3 winning trades, what do? We go back to lowest risk. And what do we do here? We risk 0.5% and we almost gamble the loss because that is okay, right? No, I can't see the equity curve, but you get the point. This is how it works. This is the low, slow track loss start of the strategy. The same thing works with the slow track. I'm not going to go through it to make this video way too long, but you know what I mean. You know the principles of it. If you if you if you win, you up the risk, but you don't up the risk way too much because you're still in that area that you don't have buffer. And these areas right here, you take the first trade, you win the trade, then you lose, then you half your risk, and then you half your risk even more, and you stay in that halved risk if you're below the starting balance. All right, and then you keep upping the risk, which is max 2%. And then this is where you see the most growth in your equity curve, right? These areas. But we don't want these areas right here. Let me see if I can draw on this. Yeah. These areas right here, we don't want these areas right here to be way too long. Even if they are way too long, we have a 0.5% risk in that area that doesn't. Like even if I lose 10 trades in a row, that's only 5%. I can gain that back with taking a 1.5% risk and have a 1 to 3 risk reward, right? This is the slow track risk management system. Trust me, this works. This works, but it requires discipline to not overtrade, to not over risk into positions that we know are not really that good, or even if we know that the positions are really good, we're risking the amount that we don't have. We can't do that. This requires discipline to follow through. Basically, what you're doing on a day-to-day basis, when you enter the market, you look, how was my last trade? Did I win my last 3 trades? Okay, then I'm starting over at 0.5%. And then you keep doing this circle over and over and over again. All right? So this is the slow track. This is the slow track risk management system that protects you, basically protects your psychology, and it's more calm on the psychology because the losses does not affect you that much, right? Hope you got something from this video. This is so important with risk management. Feel free to check in at the comment section below. What made risk management slow track system clearer for you in this lesson? How did you trade before? How did you risk before? And I'd love to know how your risk management changed after this video. And if you like this video, as always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community. All right, see you on the next lesson. Take care. Hello and welcome to this lesson where I'm going to share with you a risk management strategy that's called the fast track strategy. I'm going to talk about 3 things in this video. We increase our risk when we have buffer. We need to have some buffer to be able to risk more, to be able to gain more profits. We protect the system by resetting fast. We don't want to take a loss and then continue taking the loss with the same amount that we risked, and that just it just chips off on our profits. We use momentum and not emotions, or maybe better said, we use a system and not emotions, right? I want you to see this as a video game. We are leveling up on a video game, and this fast track system is how to beat the system with profits in a quicker way. And this is a mind map or a way to go through it that makes it easy for you. This is an aggressive system, an aggressive risk management strategy, and this affects your psychology more. It's because you're risking more and you're more aggressive with the risk. That makes it more difficult on your psychology. And if you've gotten to a place where you can handle your losses, the losses does not affect you that much. The wins does not affect you that much. You just you're not even thinking about the money really. You're thinking about this like a game, and you're here to level up with your profits. And this is a perfect system for you if you can handle it. If you can't handle it, there's another system that you can use that will protect your psychology more. So let me go walk you through this and how it works. um, let me This is basically what you do. This is the fast track system. Okay, how do you use this fast track system? You use it by you start off by risking 1%. Let's say you have a 100K account. We are excited. We want to make 10% a month, and we want to, retire retire ourselves. We quit our 9 to 5 and retire our families, right? This is what happens. We come in, we risk 1%, right? We lose that trade. So this is how we use that system. You lose that 1% risk, right? After you lose that 1% risk, you give it another try. You give it another chance to gain back the profits. By the way, this fast track is fixed at a 1 to 3 risk reward. You can play with the risk reward from this, that's okay. But the main thing is that we want to be above the starting balance to be able to risk more so we can gain more profits. So we risk 1%, we lose, and then we keep risking the trade after that 1%. If we lose that 1%, what do? We halve the risk to 0.5%. So when we halve the risk to 0.5%, after that, we keep risking 0.5% until we reach the starting balance or go above it, right? If we win that trade, if we win that trade, if we win that trade, we go back to risking 1%. Or if we have leverage. Let's say we risked 1%, we lost, and then what does that mean? We have 1%, we lost, minus 1 is 2. We have 2% in buffer, then we up our risk because we have 2% in buffer, we can risk 2%. And then we risk 2%, we win that trade, and if we win 3 trades in a row, we start over the process by risking the minimal amount. Right? We go back to risking 1%. All right. So I'm going to jump into a chart right now, into Excel, and I'm going to show you how this works. And I've used 0.5% as the minimal risk, so it can flatten out our equity curve. If you use this system correctly, this is what your equity curve will look like. It only requires you to have discipline to follow through on this system. So you have 2 ways. I have 2 examples. I have starting with a loss, and I have starting with a win. This is it. You risk 1%, you start with a loss, and then you start with a win. Which one and how does this work? So basically, you start off excited and you take one loss. You take one loss, you can see that you drop down under the equity curve. You take another loss, you are now minus 2%, right? If you have a funded account, I think it's maybe 8% or 5% or something like that. To be able to that's there your overall amount to be able to blow that account. And then you have after that you lost 2 trades, you halve the risk 0.5%. Why? Because you don't want your equity curve to be a steep down curve. And also, you don't want your equity curve to be like a roller coaster going up and down, up and down, up and down, because that affects our psychology enormously. And our brain doesn't like to see drawdowns like these. I even wrote it here, something. Our brain doesn't like to see drawdowns. So what do? We basically risk 0.5% until we reach above starting balance, right? So we risk 0.5. I'm not sure if these numbers are correctly, like I'm just seeing a mistake right here, but it's fine. Let me just jump into the chart. You risk 0.5% right here. When you risk 0.5% right here, we gain 1.5%. After we've gained 1.5%, all right, we've almost hit the starting balance. Then we keep risking. When we are at 99, we have the ability to risk that 1% that we started with, basically. So we're risking 1%, and now we have a 3% gain. After we've gained that 3%, we have a 2% buffer to be able to risk, right? We have a 2% buffer, but unfortunately, what happened? We risked, and then we lost that trade. We were not. Where do we do it? We risked 2%. We're not comfortable risking 2% in this scenario, so we risked 1% only this here. We risked 1% only and we lost that 1%, but we still have 1% in buffer to be able to risk. So we risked 1% in buffer, and now this is where these moves happen. This is where these moves happen, where we make the majority of our profits, right? Because we are up 4%, and this is, by the way, the this is an aggressive approach. Don't let me forget to say that. We are risking, because we have 4% in buffer, we are risking 2% as max. And if you feel like a cowboy risking 4%, I don't recommend you doing that. So we risk 2% and we have a 6% gain. That's when we make these profits right here, right? And what happens after that? We still risk 2% until we have 3 wins. So when we have 3 wins, we have one, two, three, and this is when we drop back to our lowest risk. And this is basically we are preparing ourselves for a loss, because losses is inevitable. Losses will happen sooner or later, and it's better to have small losses than 2% losses, because I can lose 0.5% 4 times. That gives me a 2% risk one time. Do you see? So because we are able to mitigate or to weather the losses in this way, we have the ability to grow our equity curve, right? You can see what happens in this scenario. We risked 2%, we lost, we went back to 8%, and then we risked 1%, and then we lost that trade also, right? We don't continue risking 2%. We drop down to our risk right, and we drop back to the 1%. That's the starting balance of what we risked. And if we lose that, we drop down to risking 0.5%. I hope this doesn't get too confusing for you, but you see my point. When you win, you up your risk. When you lose, you go back to risking 1%. And then if you lose that, you go back to risking 0.5% because you wanna stop the bleeding, as they say, right? We want to create smooth equity curves and not spikes down. We don't want to have spikes up and spikes down with our wins and our losses. And when we lose that 0.5%, we keep risking 0.5% until we win. And when we win, this is when we up our trade. We can up our trade to directly risking 0.5% to 2% or to 1%, and then we risk 1% and then 2%, and then we hit the yo-yo effect of um, you know 3 trades, and then we hit our lowest risk, and then we continue risking 0.5% until we win. We win, then we up our risk, we lose that, and then because we lost that, we half our risk, and we won that, and we up our risk, and we lost that. And even in these scenarios, check this out. Even in these scenarios, our equity curve is still moving upward. Because if we could keep doing this system long enough, we will be profitable. Trust me. Trust me. If you keep using this system like this, you will be profitable. At the end of the month, end of the year, you will be profitable. Why? Because you're using a strategy that is it's not fixed to just risk 1%, just risk 1%. When we gain some profits, we risk more. When we lose some profit, we have to risk. If we it's logical, right? When we have something that we can use to gain more, we can use it. When we are losing, we have it so we don't lose more. That's basically how it works. This is the fast track system, and the same thing works with the fast track when starting. We start off with a win. This is how it works. You risk 1%, right? Because we're following the system. You risk 1%, you win this trade. You can up your risk directly. Why? Because you have 3% in buffer. You risk 1%, you have 1 to 3, you win 3%. Now you can risk. This is how you can pass your funded challenge in a week or so. Really. If you have a 8% funded challenge or a 10% funded challenge, like this is how you can pass it. Because you're using you're almost you're not letting this affect you that much to be losing $500 on a funded challenge because you risk 1%, you gain 3%, and now you have a 3% leverage. You can do this the slow way, but this is how it works. Risk 1%, gain 3%, you have a 2%, you can even risk 3% after that, but it's too much. People are not able to stomach 3% losses, unfortunately. And this, you don't want to get out of tilt and start tilting and blowing that account because you lost 3%. So you risk 1%, you win 3, you start risking 2%, now you gain 6% back because it's a 1 to 3, you have 9% in profit, right? You've gained 9%. After that, you keep risking 2% and you lost that trade. You have 0.5%, and then you have the risk, and you lost that again, and then you have the risk. And this is almost flattening out your equity curve. And you keep doing it. You keep risking 0.5% until you win. You win that trade, double your risk. You double your risk. And then you keep doubling your risk. And after 3 winning trades, this is so important. After 3 winning trades, some people they win 2 trades and they get overconfident. Some people win 1 trade and they get overconfident. I'm putting it at 3 trades to have it. Use what works for you. If you know that you're getting overconfident in 2 trades, bring it down. Or not 2 trade, 3 trades, bring it up. And then you go ahead and you risk the lowest risk amount. So your equity curve will be flattened, right? Um, have I forgot something here that I missed? Let me just double check. Yeah, when risking 3, this is so important. This requires discipline because you've gained 60%, 16% on that account. Good job. Let's say 10%, 10 to 16% on that account. Good job. The thing is, a good trader keeps his or her profits. You don't lose the profits after gaining them. It's not about just because we are so stuck in that struggle mode for so long, and when we gain profits, it almost feels unreal. Be able to humble yourself by lowering your risk and taking a loss. Because when you take a loss, this is a humbling experience, and it makes you feel like I'm not that overconfident. And it's not about the wins and the losses. It's about sticking to a system constantly, consistently over time that will eventually make me profitable, make me to a winning trader at the end of the month, end of the year, end of the each quarter. So this is how we do it. And even if you take these kind of losses, 1% and then you half it, and then 1% and then you half it, and then this should be 0.5% here, and then you keep risking 0.5% here. And then when you have this confidence that you have 0.5%, you won this trade, you have a leverage of risking more because you are up 20%. You have the opportunity and the ability to risk more. Now, this is the fast track system. This is an aggressive way to trade if you are well aware of your psychology, well aware of what makes you tilt and what makes you gain the profits and what makes you strong and weak in the market, then you can go ahead and do that. But I will not recommend it for beginners. It's just to give you a perspective on how to, you know, pass funded accounts quickly or gain your capital more quickly. This is how you can do it. So this is the fast track system um, lesson check-in. Feel free to write what you learned from this lesson inside the comment section below. One sentence is enough, and share it below. And as always, if you like this video, feel free to follow me on YouTube, on Instagram, and if you haven't done it already, join the school community. Take care and talk to you in the next lesson. Have a good day. Hello and welcome to this lesson where I'll be talking about risk management, specifically for how to pass a funded account and how to keep a funded account going. So I'm going to talk about three things into this lesson. I'm going to talk about what a funded account is, why risk is everything inside of the funded account, and how to keep it. And I'm going to share with you a roadmap on how to do it. So the thing with a funded account is if you don't have money, if you don't have a large amount of capital, the ideal thing is that we want to do is we want to trade with our own money. We want to use that money, trade with our broker, and not rely too much on a funded account. Because a funded account, they can ban you, they can close you, they can see the patterns that you are doing inside of their system. They have AI tools right now that's seeing patterns all over the traders that are doing it. So they can, so you're not really in control of that. And having a funded account to rely on your livelihood on giving it your paycheck, giving you it, making you a paycheck uh, um, every month, that's a bit risky because they can just block you 1 month and then you don't have a income for that month. So the thing with before I go over, what is a funded account? First things first. Funded account is a company that gives you capital to trade with. So the company's job is to give you capital so you can go trade with larger amounts. And they take a percentages of the wins that you're getting from the profits. So before you do that, before you get that 100K account or 200K account or a 50K account, it doesn't matter. You need to pass a challenge. They set rules inside of these challenges. I'm going to use FTMO as one of the leading prop firms in the industry, where you have two steps. You have a step where you can FTMO challenge and how it works. You have different amounts of challenges, and it costs 345 to pass a 50K account or 433 to pass a 100K account, right? So you have two steps. You have a one-step process, and today I'm going to just talk about this two-step process. The two-step process means that you should reach your first stage. There are two steps. The first step is to reach 10% of that account. So they give you a demo account, and when you reach 10% on that demo account, you pass the first step. And then their phase, you pass the first phase. And then they give you another. They give you another 100K account. That's still a demo account. And when you pass that second stage, which is 5%, half of the amount of the first stage, then you get a live funded account that you can trade with. So this is the process of a funded account, right? So that's how the funded account works. The thing with a funded account, it's just like health. That's the metaphor that I'm using. So summer's coming up right now, and I know so many people, they kill themselves to get the six pack or get the beach body. They work so hard to get it, and when the summer comes, they let go of all the habits, all the routines, all the exercise regimen, all the diets that they were doing to get to that goal, and they just let go. This is the same thing that works with a funded account. We fight so hard and we are so strict and religious with our risk management, and then when we get it, we let go of the thing that got us there, right? So I'm going to talk about this and how to keep it, how to keep a funded account, because like getting a funded account, that's nothing. Like if you put getting a funded account as the pinnacle of your career in trading, you will lose it because it's not about getting it's about keeping it alive always because what is the goal here? The goal is the work. So the work in passing the funded account, the work in keeping the funded account, that is the goal. So why risk is everything in the funded account? Risk controls how we stay in the game. The goal here is to stay longer in the game so we get the benefits of the profits that we are getting on a monthly basis, on a quarterly basis, and on a yearly basis. But one mistake, one tilt can wipe our own the entire progress. The thing I forgot to mention is you have a daily drawdown somewhere. So if you reach like you if you over risk one day and you risk 5% on one day or something like that, then you've blown your account. They lock your account and you fail the challenge. So that's one mistake can wipe that progress. Survival comes before profit. The thing with a funded account is how we think about the losses is more important than how we think about the profits. When you come to a funded account and you come to a trading day, the thing we should ask ourselves is how much am I willing to lose today? So, first things first is how to pass it. So, I talked about these two strategies, risk management strategies, the slow track strategy and the fast track strategy. You can use either one of them. If you have good risk management and if you have a good mental strength, feel free to use the fast track system because that will get you to pass the funded account quicker. The thing with the funded account, if you put $345 into a 50K account, you should see that $355 as gone already because that is the investment you're putting on yourself to pass a challenge that will give you a 50K account. Because when you pass that, you will get back 10x or more of the money that you invested in. So the investment part that you are putting in to pass that 50K account is so huge because it's leveraged. You put in 345, you get a 50K account, and with the 50K account, you risk 1%, that's $500, right? And when you risk 1%, it's a 1 to 3, that's every win is $1,500. So you get back so much from the, and then it continues, it compounds over and over again because you're still using that account, right? The thing with a funded account is also don't take it too personally when you fail the account. You should have, let's say, $2,000 and you should buy four accounts. Let's say you have $2,000 and you buy four accounts. When you buy those four accounts, let me just draw something here so I don't just speak. So you have 2,000, you have $2,000, right? And you buy a funded account. When you buy a funded account with those $2,000, let me draw it. You can fit, let's say every funded account costs $500, right? Which one is it? Yeah, let's say you buy four $100 accounts. So you pay 500 here, 500 there, 500 there. That amounts up to $2,000. So let's say you fail the first challenge. That's fine. All right. You use the track system and it didn't work. That's fine. Throw the account away and do the next one. You failed that challenge. That's okay. You're investing in yourself. That's the thing. You failed that account too. Then the third account, you passed that account, and then you did the fourth account and you fail that too. You still here have 100K to trade with. When you have 100K to trade with, you can get back these $2,000 so quickly, so quickly. So it doesn't, it's like you're borrowing. This is you, right? You are rich and famous, right? You are borrowing this amount. You are borrowing this amount from your future self. That's that has a 100K account, and then you keep doing it. You keep risking, or you keep investing, so you grow more accounts. Maybe you lose one again, and then you lose the second one, and then you win the third one. Now you have now you have 200,000 dollars to trade with, and you can get back that amount so quickly, so quickly. But be careful with this because if you're losing and you're not journaling, you don't know why you're losing. So that's important to figure out before you go ahead and trade the next funnel challenge, right? This gives you access to a large amount of capital very quickly. So you can use the both system. You can use the fast track system if you feel like it, and you can use the slow track system if you feel like, you know what, I need to take my time. I don't need to pass the funded account in 2 weeks or a week, right? I can take my time and pass it in 6 weeks without having any mental stress over it. Right. Now we come to the second stage. You did the risk management. You did the part of passing the funded account. What is the next step? How do we keep it? So you just passed your 100K account. Congratulations. You passed the challenge. After you pass the challenge, you get a live funded account. When you get a live funded account, that is when your risk management changes from this and this to risking small. You risk and you build your buffer, because having a funded account and having a 10% drawdown, meaning you have to lose 10% of your account. Your account has to be 90,000. Let's say you have a 100K account. I'm using 100K because it's easier to count. You have to get that account to 90,000. Where do you do it? You have to get that account to 90,000 to be able to lose that account, which is minus 10%. How many times have you traded and been minus 10%? Almost never, because that never happens because our strategy is not allowing that to happen. Maybe you lose two trades and then you win one trade. Let's say you lose two trades again and then you win one trade and then you win one trade after that. It's never 10 losses in a row. That never happens. I'm thinking about it like that you're risking 1% each time. So when you pass that account, the risk should be 0.25 to 0.5%, and you just keep risking that amount without losing your head of, because that amount in 100K funded challenge is 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 huge for a lot of people. Like risking $500 on a trade, and then you take a loss like 2 minutes after you get stopped out. That's huge. That affects you, most people's psychology very much because we don't come from that amount, right? These are huge amounts that we are risking. And we're thinking, you know what, this is not real money. And then we go on to spiral into that mindset and then we blow that account. So we need to build that buffer. Let's say your risk 0. You start with low risk, 0.25%, right? You take the win, you take the win, you you start your risk 0.25%. You take the win, now you have 0.75% because we're counting it as a 1 to 3. Now you have 0.75%. What do? You double your risk. Now you can risk 0.5%. And then this is how you grow your account. And the goal should be what I usually say over and over again, 1 and a half to 2% a month, a week. 1.5 to 2%, which makes it in a month, let's use number two to have easy math, that is 8% a month return on a 100K account, right? That's still huge ask. Let's say five or six. One and a half, four times is 6%. 6% on a 100K account, that's $6,000. That's a great amount. That's a great living, right? You can do that. And the more you stack accounts, the more you gain your profits that way by risking small. By risking small. You risk 0.25%, right? You risk 0.5%, you win that trade. You risk 0.5%, you lose that trade. You go back to risking 0.5%, you win that trade. And then you risk 0.5%, you win that trade. And now you've made it to 1.5%, right? That's how it goes. You do it over and over again. You never risk until you have some buffer. Like you start out by risking 1% or using don't use this. Don't use the fast track system when you have a funded account. So you protect your funded account by lowering your risk. You can go even lower. Point 20, no, not the past the challenge. Sorry about that. Protect the funded account. You lower your risk. You risk 0.15%. 0.15% is $150. You get basically, or we get basically between 150 to $250 a day on a 9 to 5. Right? When you see it from that perspective, it sounds reasonable to be risking a day's paycheck to gain 3 days' paychecks. Right? Think about it that way. And when you do that consistently over and over again, you stop watching what other traders do. They risk 2%, 4%, and they just made 18K on one trade. That's just gibberish. That messes with our mind. So focus on consistency and maybe force consistency because this needs to require discipline. Why? Because we are coming from these numbers. We are coming from these numbers that we risk 1%, we risk 0.5%. I'm just telling you this in a realistic manner, right? You can still go ahead and use the fast track and the slow track risk management system. You will gain more profits, but you can lose more and there's a high probability of you tilting more because you can't accept the loss. And then you grow steadily. You grow 1.5 to 2% a week. Don't chase more. Don't do more because there is, as we talked about in some previous lessons, there is a want and there's a need, right? What do we what do we need? Let's say there's a need and there's a want. What do we need? Where's our baseline? We need we need to live, we need to eat, we need to drive a car, we don't need to drive a car. There are some people walking, taking the buses, right? That's that's what we need. We need money to survive. There is the base standard of our living, right? And there is a want. It's like food. There is a need. We need to eat, right? And the want is dessert. We don't have to eat it, but we feel like we want it. It's the dessert. That is the dessert of the of the trading. That we are chasing more. We are we're going outside of the process to have more money, have more capital. Because if you spend 3 weeks getting a 4% account, right? And you say to yourself, no, I don't need a paycheck this month. That is fine. You take that paycheck for yourself, and then everything over it, you you can play around with it if you like. And how you scale is not by risking more. You scale by gaining more accounts. So you scale by gaining more accounts, like I showed you an example here. So you scale by, you know, you do this process again. You pass a 100K account, you have it saved in your repertoire, in your portfolio, and then you do the process again, and then you have another account. You save it another account in your portfolio. And when you're risking with $200,000, and then you do another one. Let's say you do a 50K account, right? You didn't do 100. You pass that and you put it in your repertoire. Now you have 250K to trade with. And this, like having, and then you do another 50, let's say, and then you are risking, you have 300K to trade with. You have a 300K account to trade with. You can copy trade them, by the way. You can have one master account and three other accounts connected to that account. So the same trades you're taking on the first account splits to the others. So if you're using, let me count how much that is. If you're using a 300K account, right, and you're risking 0.15, is that correct? Yeah, there you go. That's 450. That's $450 per risk. If you're risking 0.515%, right? That's a lot. $450 because if your monthly paycheck is $150, that's a lot. And if you do this on a daily basis, like let's say you use a 1 to 2, right? You double this, that's $900 in a day. That's good money. And you can do it. This is just a process. This is just manageable to do over and over and over again. So feel free to try this out. Don't risk too much. Don't go to the 100K account directly. Try the 10K account just to dip your fingers into how the prop firm world works. All right, I don't want to get this video way too long. Just to recap, what is a funded account? We just recap. I talked about what is a funded account. I talked about why risk is everything and how to keep the funded account and not losing it by blowing up the account because we should risk small and change our risk management strategy after we pass the funded account. All right. Lesson check-in. What made passing and keeping a funded account clearer for you in this lesson? One sentence is enough. Just share it below so it will stick with you even more. And as always, follow me on YouTube, follow me on Instagram, and if you haven't done it already, join the school community and feel free to leave a review or comment on YouTube so other people will see this video and other people will enjoy this video also and it will spread out through the internet. All right. Talk to you in the next lesson and take care. Hello and welcome to this lesson where I will be talking about how doing less you gain more in your trading. I'm going to discuss three things: why more trades don't mean more wins, why fewer trades create better results, and why this feels counterintuitive, especially to our culture because we're inside of this hustle culture. It's all about sacrifice and sacrificing ourselves and our time and working harder, working more to gain more. It's the complete opposite in trading. So, do less to achieve more. If we do less in trading, we achieve more because we are specifying the things that we want to see in the market. We don't want to take more trades because the more trades we take, the more exposure we are to the mistakes that's happening in the market, to the mistakes that's happening to our setups. So more trades means also more emotional decisions. We are going through the roller coaster of the emotions by the trades we are taking. So more trades means inevitably more losses because we are exposing ourselves more to the market. Successful and professional day traders usually take between 8 and 12 trades a month. A month. That means let's just have a simple math. 5 days a week, five trading sessions a week. In 4 weeks, that's 20 days, which means that 2 weeks they're basically, if they take 10 trades a month, 2 weeks they're basically just sitting and waiting for less trades for the perfect setups. And this is going on to the point why less trades, fewer trades create better results. Because when we wait for high quality setups, those high quality setups don't happen that often and don't happen every day. So we need to remind ourselves that we are in the market to eventually generate our own income and create a way to create our own paycheck at the end. So we need to wait for those high quality setups for that paycheck to be real, for that money to be generated. And the way to do it is to stay patient instead of forcing trades. Really, the easy way to do this is to screenshot those A plus setups and screenshot the setups that are not good, right? And put them next to you. And as soon as you see a setup, a long, a short, it's gonna happen. You just look at your reference point at what a plus setup is, and you recalibrate or you reflect on your emotions. How am I feeling right now? If I take this A plus setup, am I willing to take a loss? Am I willing to go through the trade? Am I feeling patient today? And then you do it. Then you take the trade based on the reference that you've laid out for yourself. So that is how we protect ourselves when taking bad trades and also eventually protecting our capital. Notice, I wrote a notice down there. Notice I didn't say more wins, right? Fewer trades does not equal fewer wins. It equals better results in the trades that we are taking. So fewer trades and taken, and we don't know what we're looking for in the market, that doesn't fit, that doesn't correlate to each other, because we need to have fewer trades, fewer A plus, better results. Fewer trades makes us focus more on high quality setups to take better probability trades that will take out our take profits and not our stop losses. Why this feels counterintuitive? We think action means progress. That was a big issue in my trading, I remember, because I come from the world of hard work and putting in effort and sacrifice and hustle culture and not sleeping and drinking caffeine and all these things to get motivation up and work hard, because if you don't work hard, you don't feel like that's what I felt. I'm not saying that we all people feel this way. I feel like if I don't work hard and I get something, it feels I'm not worth it because I didn't put in the work. But the action by just sitting and being patient in the market, just that is work, right? Just that is progress. There is an action in the non-action, into the action is to not take action. That is the action that but progresses our trading. We feel like we need to be in the market. We feel like if we are not sitting next to the market, that's why I see people sitting next to the market for 8 hours. What are you doing for 8 hours? That's way too long to be sitting next to the market. You get tired, you get fatigued. So sit those amounts between 9 and 10 and between um, market open and 2 hours close to market open. That is the highest probability of our setup that's going to appear during that time. So we confuse activity with the results. That was a big issue for me because I correlate activity to results. If I don't work hard, the results would not come. And I had a friend. Let me talk to you about my friend. I have my friend. He's a business owner, right? And he sees all this trading stuff on social media, and he wanted to get into trading, right? He has money. He told me I have money. I want to get into trading, but not money has nothing to do with it. The skill is the ability to trade. The skill is the skill to be able to trade. It's not the money amount. So he comes from the world of activity, working hard, doing more, taking more trades, hustle culture, because he's an entrepreneur. He runs his own business, and he lost so much money, and he kept revenge trading, and he couldn't accept the loss, and he keep getting into trades and taking trades. That's not a part of his setup, but he had the money to lose it, and he lost a lot of money because of that, because he didn't understand that the counterintuitive part of trading is what makes you a winner at the end of the month by doing less. The truth is, more trading doesn't make us better. Better decisions makes us better. We don't get paid for how much we trade. That's the thing. We don't get paid by how much we trade because it's not about trading more. We get paid about how well we trade by trading the best quality, high quality setups that there is based on our strategy that we are taking. So the solution here, do less but do it better. Do less but do it better. It's like a bulb, right? When we have the light on, the light goes all across the room. But if we have it focused like a laser beam, the light is so strong it can break through a piece of metal because it's laser focused, and it's better that way as a laser being focused on just finding A quality setups. So in trading, how does this look like? Sitting out when there is no setup. You don't need to be next to the market when there is no setup appearing, and you can almost see it. If we are waiting for a liquidity sweep, if the liquidity did not get swept, we don't enter the trade because of it. And then we don't enter the trade that's going to the liquidity. We're waiting for it to sweep liquidity, and then we can act from there. Taking one or two clean trade instead of five random ones, right? And I don't need to say more. Taking one or two clean trades instead of five random ones. Because you can, by the way, if you take five random ones, you can by luck win. You were lucky, the market went your way, and this is what builds bad habits. Because if you win five trades, not all five, you win half of those trades by just being lucky. This will build a bad habit that you will believe that if I just take random trades, I will be lucky and win one of those. In the long run, this will not work. And even if you've did it and you won $5,000 that month, you know that your decision making was not good. So you know that eventually, because you don't have good habits in place, the market will take that money back from you because you weren't deserving of that money because you didn't do less by doing better. You did more. And that doing more habit will eventually just, the market will eventually just take the money back. So be okay with doing nothing. Be okay with doing nothing. Really. Not doing nothing, you know. Let me rephrase that. Be okay with sitting next to the market, because sitting next to the market and not taking a trade, that is doing something also. Because if you traded and did not trade, that's an action also. So let's recap. More trades leads to more mistakes. Fewer trades leads to better decisions, and less action creates better results. Because that is what we are looking for in the market. We're looking for this high quality setup that's appearing once or twice a week or three times a week, and we're keep doing those over and over and over again. And the way to keep reminding ourselves of this is to have a screenshot of all the A plus setups that you've taken to remind yourself that these setups appear over and over again. So lesson check-in. Take a moment to think about what made doing less to gain more clearer to you in this lesson, and feel free to write one sentence below and share it with the community. And also, as always, if you like this video, feel free to comment a post on YouTube. I will really appreciate it because this spreads the video, and the algorithm will catch that video up to spread it to other people. And if you haven't done it already, join the school community, follow me on Instagram, and I love it if you left a comment on YouTube. Take care and talk to you in the next lesson. Bye. Hello and welcome to this lesson where I'm going to be talking about euphoria and overconfidence. I'm going to talk about how it affects us in our trading, and let's get to it. After a win, it feels like everything is easy, like we figured it out, like we can't lose, right? We feel powerful. That feeling is dangerous because it's not clarity, that is euphoria. And we lose our ability to perceive risk. Because what happens when we trade? We take a win, right? We get that euphoric feeling that we are overconfident and we can't almost lose. So what do we do after that? We take extra trades after a win. We increase our risk or our position size. We break rules because we feel confident, and closing trades early to avoid a loss. This is what happens as an effect in our trading. And the truth is this: euphoria is just as dangerous as fear. There's a feeling of fear. I don't want to lose that trade. I don't want to lose the money. FOMO, and there's euphoria. These emotions, these chemicals that's happening inside of our body. The only difference between those two is that if euphoria, it feels good, right? It feels like we are listening to music and we are happy and we are jumpy. But both of those, the fear and euphoria and the overconfidence, they have the same uh, consequence, which is that they take us away from the process. We don't lose because we don't know. We lose because we feel. We're letting our emotions control our decision making. When we feel euphoria, this is so important. We lose our ability to perceive risk. We lose our ability to perceive risk. Some people get this euphoric feeling when they've stopped drinking coffee for a while and they start drinking coffee and they get the euphoric feeling. When you get that euphoric feeling, don't make any decisions during that time. Get back to base level, be even keeled, and then you can make a decision. Because we can't trust ourselves when we are way too upset, and we can't trust ourselves when we are way too happy, right? So the solution here, what is the solution? I have this picture right here, cow standing in the rain, just being stoic. A win does not change the plan, the process, the system that we're using. And a loss does not change the plan as well. So a win or a loss should not even phase you, should not even change your decision making or anything else because it's like a cow standing in the rain. It just is. All right, because I just followed the process. And eventually, by doing this, the euphoria and the overconfidence will get smaller and smaller and smaller. Why? Because you will get euphoria and overconfidence from the process eventually. You will get dopamine from just following the process because you know that that is the thing that will bring you success at the end. So let's recap short with this video. In this lesson, I covered three things: that wins creates overconfidence, euphoria leads to breaking rules, and we have a hard time perceiving risk, and how it does not really matter. Wins or losses does not matter. The only thing that matters at the end is the process itself. Short lesson check-in. Take a moment to think about how are you acting after winning a trade. Maybe it's not one win, it's not two wins, maybe it's three wins in a row and you get that euphoric feeling. So one sentence is enough. Feel free to share it below if you feel comfortable with that. And as always, follow me on YouTube, Instagram, and in the school community. And I will love it if you left a comment or a review on one of the YouTube videos. It will really help out the algorithm to boost the YouTube videos to the other people also wanting to learn trading, just as yourself. All right. Take care and talk to you on the next lesson. Bye. Hello and welcome to this lesson where I'm going to be talking about every trade is unique. And what does that mean? So when we trade, let's say I have a drawing right here. Let's say we take this first trade, right? We take this first trade, it's a winner. We take the second trade, it's a winner also. And we take the third trade, it's a winner. So what do we think on the fourth trade? That this eventually will also become a winner. But it doesn't work that way because we don't know when the next winner will be and we don't know when the next loser will be. All right? Because every trade is unique. Every trade is for itself. You can take the perfect entry. You can take the perfect entry today and have it be a loss. You can take the exact same entry tomorrow and have it be a win. And this is what trading does with you. It it contradicts each other's ways of trading. And you can take let's do it again. You can take a trade today that is perfect and you can have a win. You can trade this, you can take the same trade tomorrow and you can also have a win, and you can take the same trade on the day after that, and you risk more, and that is when you lose, right? You just flip it over. You can take one trade today that is a loser. You lost that trade. You can take the same setup tomorrow, and that can also be a loser. And on the third day, you can see the exact same trade, and that can be a winner. That's how it works. So the truth is, two situations are exactly the same, but it's like playing the game, but every round is different. Every round is different because every trade is unique. There are new people coming into the market every day. Every new person that comes into the market changes how the market will be, changes how the market will react. You can use the same strategy, what's in our control, but you can't expect the same result. The kicker, the whole nugget of this lesson is that every trade is unique, and just keep doing the same setup and the same process that you've been doing over and over again. The solution here, detach from the results. A winning trade, okay. A losing trade, okay. The same okay on both of them. So follow the process every time. I'm keep saying this, to follow the process, because the process really is the goal. The thing you do on a daily basis, the decision making you do on a daily basis, that is what trading is. And accept the outcomes, that the outcomes will vary. Sometimes you take a perfect quality setup, and sometimes you take another perfect equality setup, and one of those are winners, the other one is a loser. So focus on execution, not winning. I'm going to read you a quote right here by Kobe Bryant. Weakness is you are reliant on a loss or a win. You have to be in the moment. When you lose, you are sad, and when you win, you are happy. That is by definition weakness, because you're reliant on an outside source to dictate your outcome. You run from loss and you chase a win. A real pro, a real pro is in the moment, and the outcomes just take care of themselves. That was, I love this quote. I love this by Kobe Bryant, because it doesn't matter. Like I hope you reach that level. If you reach 10K January, 10K February, 10K March, right? Then what? April is still gonna be there, and you can blow all the 10Ks that you made yeah, January, February, March in April, because you're not following the process. That's how it works. Lesson check-in. Take a moment to think about how do you react after a win and after a loss? What's happening inside of you? I'm interested to know. One sentence is enough. Feel free to share it below with the community. And as always, follow me on YouTube, Instagram, and the school community. And I will love it if you left a comment on the YouTube video to make it have it catch it on the so the YouTube will catch it on the algorithm, and it will spread to other people that needs this information. I know it's a hassle to do it, but feel free to just write a simple comment in the YouTube section. It will really help me out. Thank you so much, and talk to you in the next lesson. Bye. Hello and welcome to this lesson where I'm going to be talking about exposing yourself to the market to be able to improve your trading. So I've been talking with some of the people on the social media and on the community, and some of the people have been doing training for 2 years and they're not finding success. Some of the people are doing it for 3 years and 4 years and 5 years, and they're not finding success. So the question I usually go back to is, how many New York sessions and London sessions have you seen during those 3 years or 4 years that you have not seen success? Because I'm correlating this by going to the gym. If you are consistent by going to the gym, you will see people being at the gym consistently, right? You only see people in the gym and going to the gym consistently by you doing it. If you go to the gym every day, you will eventually see results. There's a story that I can share with you. Is my wife went to a spinning class with her friend, and next to them inside, next to them in the class, they saw a guy who was really overweight sitting next to them, and they kind of felt sorry for him. Then they nodded, "Hey, how are you? How are you?" You know, that they felt that need to say hello to him. But as soon as she told me this, I told her, respect to that guy because he's showing up. He's taking it seriously. Winning or losing does not matter. He's showing up consistently. Now, a year went by and they went to the same class again. So they went to the same class a year after that, and they grabbed their bike, their spinning bike, and they washed to the right, and he said hello. There's a guy on the right. He said hello. Hey, how are you? Long time no see. And my wife said, like, do we know each other? Have we went to school together or something like that? And he said, no, I'm the guy that you met a year ago. And she didn't recognize him because he had lost all his weight, he had gotten into shape, and she was just amazed because how quickly he changed in 1 year. He was that overweight, she didn't even recognize him. Why? Because he showed up. He showed up to the market. He showed up to the spinning class consistently every day for a whole year. And now people don't recognize him. So this is what I'm saying. Expose yourself to the market. Watch London session if you can. Watch New York session if you can, live on a daily basis for 1 or 2 years, and I guarantee you that your trading will improve. I guarantee you because it's like just your back of your hand. Because this is what I did in the beginning. I'm always think. Let me just. This is like a back of your hand. You know exactly how the back of your hand is looking because you've seen it every day. You see it every day, and this is what makes it uh, um, so familiar to you. That is why I'm only trading two symbols. I'm trading the DAX and I'm trading the NASDAQ. I'm trading them on the London session and the New York session. Now, there is gold, there is the S&P 500, there is Forex, GPP, USD, GPP, like all of these symbols. There are so many, but I wanted to narrow it down to make it easy for myself to just follow two symbols, London session, New York session, and I know them so well because I've seen them for so many years. It's like I'm married to those two, right? I'm married to the DAX and I'm married to the Nasdaq because those are the ones that I can trade because I know how they move. I know almost their personality because I've been exposing myself to those symbols over and over and over again for a couple of years, and it makes me know them. That's what it makes. My friend the other day, he told me, "How do you know where the market is going to move?" I told him because I've seen it so many times. I've been in, like I'm not I haven't seen the DAX and gold and Forex and Bitcoin and all these things. I've seen these two for so long, for so many times. And this is how you get market IQ or market knowledge because you've seen it. You almost get a sixth sense of where the market is moving. And now when I look at the market, I can just see, oh, this is going to take a while today. I'm going to be sitting here till 11 o'clock. This is going to take 2 hours. Or I'm going to maybe sit here for 2 hours and there's no setup that's going to appear because I know it so well. Because I just followed these and I exposed myself to the market. And that is why I recommend you do. You need to expose yourself to the market. So if you've been trading for 5 years and not seen any results, and I go back and ask you like how many New York sessions and London sessions have you seen for the past 5 years? And if you put them all together, it's like 6 months because you work Monday to Thursday and you're only in the market maybe Tuesday and then Friday when you're working from home. So you're basically just watching the market 8 times a month, while the other person is watching London session, New York session twice a day, two symbols. It's more focused. It's 100x more than the person just watching the market on Tuesday and Friday, or even more than more x to 100x. Do you know what I mean? So the more you expose yourself to the market, the more exposure you have to the symbols that you are trading, the better market intuition and market IQ you will have. All right, that's about it for this lesson. Um, Feel free to check in what you learned from this. This is not the correct expo yourself. Feel free to comment down below in the comment section below one sentence what you learned from exposing yourself to the market and share it below with the community. And I will love it if you follow me on YouTube, Instagram, and join the school community if you haven't done it already. But comment, leave a short comment on the YouTube videos, and I will love that because it will just boost the algorithm, and like the video also. I would love that because it will really help me out in the YouTube space. All right. Thank you so much for watching this video. Hope you got some value out of this. And don't forget to expose yourself to the market, and talk to you in the next lesson. Bye. Hello and welcome to this lesson where I'm going to talk about how to stop revenge trading with fairness and loss, because fairness and loss are the emotions that trigger us to revenge trade. So I'm going to talk about three things: why we hate losing more than we like winning, why unfair outcomes trigger emotions, and why this leads to revenge trading. So I'm going to start off by sharing an experiment with you, which is the fairness experiment, which is a psychological experiment about how we human think and how we react on fairness. So this experiment includes two people, person A and person B. Person A gets $1,000 and he has the choice to decide how to split it. He gets $1,000 and he has the choice, and he decides how much he should have for himself and how much he should give to person B. So person B has a choice. Person A has a choice on how much money he should split between the both, and person B has a choice to either accept the offer or reject it. If he accepts the offer, both of them get the money. If he rejects the offer, none of them get money. So if you accept, both of them get money. Rejects, none of them get the money. If person A says you get 300 and I keep 700, person A has $1,000 and he says I will give person B $300 and I will keep $700 to myself. Person B almost always says no. No meaning both get nothing. No meaning no to $300. No meaning I would rather have $0 than see you have 70% of that $1,000. See you have $700. No, I can't stand seeing you win because it's unfair. So person B, they even tried this experiment in third world countries where $1,000 were like, I don't know, 4 months paycheck. And the same thing happened there. Why? Because person B can't stand that the other person is getting the unfair advantage. That's what happens with us. We want fairness, and we don't want to lose, because around that's what happens around the 30-70% mark. Almost always person B says, like, think about it. Person B says, no, I don't want any free money because I can't stand the bastard across the room having more than me. This is what makes us frustrated, and we want to see fairness, we want to see justice, we want to have 50-50%. We rather say no to free money than to have the fairness. So in trading, this looks like this. You enter again after a loss. You lose the trade and you feel like, this is not fair. I want to re-enter. You increase the risk. You risk the $100 and you double the risk because you want to get back what you lost, because you can't stand that the market is taking your money. You want fairness in the market. You're chasing trades that you missed. You're forcing entries because it should work, right? This should work. The market owes me money. This is what triggers the emotion of fairness because we just lost the money. Somebody owes us the money back. That's the feeling that we get. The truth is, the market is not fair. It doesn't owe you nothing, and our job is not to be right. Our job is to follow the process over and over and over again. That is why so many people say that trading is boring. Trading is boring because that's trading, a process. That is the trading, a process. You do it over and over again until it becomes second nature to you without even thinking about it. And when you see other people, oh, trading looks so easy because they have done it, the process over and over again. So you should put in uh, some rules for yourself, and this is different for all people. We all have different levels of what is fair levels in us. So I have a post-it notes right here, and every time I feel this emotion, I need to remind myself that this is coming up, and I have to put it next to my table to see, this is happening. That it's a reminder because when we get into our emotions, our objective thinking doesn't get logical almost. So use this checklist for yourself. I stop when I feel the need to get it back. I stop trading when I'm reacting to a loss. I stop trading when I'm chasing a missed move. I stop trading when I feel frustrated or emotion. Like these things. And I've even suggested here, if you need to use the cold turkey blocker, use it. Because when these emotions get out of hand, we blow accounts, we lose money, we do things in the market that's not really suiting our standards or our values of how we trade. So feel free to block yourself out with a cold turkey blocker. This is probably the best $30 you will spend for the rest of your life because this stops you from you. And I wish I created this application for myself to just give it to people. So let's recap. We talked about three important things. How we react to what feels unfair, what feeling shows up after a loss, and acting on it breaks your system. And also talks about the psychology of money and the experiment that people are using. That we can't stand, we say no to free money because we can't stand that the other person is getting the unfair advantage. We want fairness in everything that we do, but the market doesn't care about us. So lesson check-in. What did you last feel something was unfair in your trading? When did you last time you felt that this is unfair in my trading, I need to get back in and revenge trade. One sentence is enough. Feel free to share it below. And as always, if you like this lesson, follow me on YouTube and feel free to comment on the YouTube video down there and leave a review or write something that will boost the algorithm to get more people to see it. I would love that. And follow me on Instagram. And if you haven't done it already, join the school community. All right. Talk to you in the next lesson. Take care. Welcome to this lesson where I'll be talking about realistic goal setting, how we set goals in our trading. So, there's a difference between what we need and what we want. We need food, right? We need food to survive. We need water to be able to drink the water so we can live. We need food. What we want is dessert. There is a difference between the need and the want, right? I'm gonna go through it either way. The food we eat, we need it to survive. The desserts we eat it just because we want it. And the thing is, winners or losers. If you take somebody running the track on the track and they're supposed to run 100 meters or so, the winners and the losers, there are like 8 people. Winners or losers have the same goal. Everybody in that track, there are 8 people. They want to win, right? So why don't they all win? Why is just that there is just one winner at the end of that run? So the goal itself cannot be what makes them win because they all have the same goal. It must be something else. So the goal affects does not affect their results. It must be something else. And the real truth here is that big goals don't create success, the daily habits, which is the work that we do on a daily basis, that is the goal. We don't reach big goals directly. We the big goal will not feel like this is the thing. When we have a big goal, it will not feel like when you achieve it, it will not feel like just special ones among us gets to reach to that area and you will feel exceptional all the time. It doesn't feel that way. Think about it. You've had goals in your life, right? You've achieved some of your goals. When you achieved that goal, did you feel extraordinary or something special, or did you feel like this is a euphoric special place that just me, I'm just the one here? Did you feel that way? No, right? Because it's not, it's the process. You can be successful today, in this second, by just changing the way you see it and changing the system. Because the systems that you're doing on a daily basis, they're waking up a half hour before the trade. Maybe you're structuring you're watching news, you're structuring your entries, you're structuring your checklist, you have your know how much you're risking. Doing those things on a consistent basis, that is success. That is how, and when you reach that goal that you have, that big goal, it will not feel that different because that you will continue doing the same system over and over and over again. It will never change because that is the habits of the successful people, as they say, that will get you there. So explanation here, in trading, we need structure. We need to know where we are going. For example, my goal is I need to make X amount percent per week. That is the goal, right? You should have a baseline minimum of how much you need to reach to be able to survive and live and eat each week. So in the end, why week? Why not month? Because in a weekly basis, it's easier to see. You know that at the end of the week, okay, you know what? I was break even this week, or I lost this week. I need to readjust to the week ahead. A month seems too far away, 30 days. And that is the goal basically. Everything about, let's say you have a goal of reaching 2% a week. 2% a week is a good goal to have. It's a baseline goal. It gives you 8% on the month. 8% is what the S&P 500 is doing on a yearly basis. If you're doing that every month, that's great results. That's A-level results. Everything above that, I'm just using 2% as an example. Everything above that is the dessert, as I spoke on the beginning of the video. That's the want. That's not the need. The need is 2%. Everything above that 2% is a want. It's counterintuitive because the hard it's harder to do the small, consistent, tiny goals over and over and over again than it is to do the big goal. But you have heard the saying, uh, uh, the destination is the goal, not no, the process is the goal, not the destination. And that really is true. Okay? To reach that big goal, you need to take one step at a time to reach that big goal. This is so cliche, but that is really how you get there, by taking one step at a time. And those one steps is hard to do. The tiny goals that it's harder to do because they seem insignificant. It's harder to do than the big goal, which means that the daily work, the daily things that we are doing on a daily basis, that is the goal, right? So watching the market, New York session, London session, every day for 2 years, and you will reach that goal because you're seeing it every day. You're in that momentum of how it feels to be a professional day trader because you're creating every day as a green day. Let me define the green day again. What is the definition of the green day? A green day is if I come to the market, I have no intention and no expectations. I show patience. I only take trades that fit my setup. Sorry. I apply good risk management. I accept a small loss, then it's an absolute green day. Why? Because when I think about the process like this, my trading improves 10x faster because I'm forcing my brain to focus on the process, the goal on the daily basis, and not the profits. That is the definition of a green day. So we make every day a green day. So let's recap a bit. In this lesson, I covered three important ideas. Realistic goal setting creates consistency, small daily action lead to bigger results, and daily green days is the goal because that is the work that we need to be doing. And we can start being successful today at this moment. It's just a choice. Lesson check in. Take a moment to think about it. Are you focusing on what you need or are you chasing what you want? Are you chasing the needs or are you chasing your wants? The wants is the desserts, the need is the food. Once that this is enough, feel free to share it below with the community. And I love you to follow me on YouTube, Instagram, and join the school community if you haven't done it already. And if you just make me this favor, feel free to jump on YouTube and just write a short comment so it will boost the algorithm and it will get more people to see this video. It will really help me out. All right. Talk to you in the next lesson and have a great day. Bye. Welcome to this lesson where I will be talking about self-doubt and I'm going to be breaking down it in steps. So I'm going to talk about three things. Why self-doubt is just a feeling, why self-respect removes self-doubt, and why confidence comes from execution. I don't know if you've tried it before, but if you've done an ice bath, the first time you do an ice bath, you feel tremendous amount of self-doubt because that's not something we usually do, right? But when you keep on doing the ice bath, the same feeling you got day one isn't the same feeling that you get day seven if you keep doing it every day. The same feeling that you got day seven isn't the same feeling that you get on day 21 because you've been doing it every day, and so forth and so on, because you know what you're expecting. You know what's going to happen, and really, the temperature of the water did not change. What changed? You changed. You became stronger. You became harder. You become more. You know what? This is what I do. I do ice baths, so it doesn't affect me. I get the feelings that's happening before I enter or before I take the ice bath, and it doesn't affect me anymore because I've been here before. I've done this before. My action speaks louder than my words. So the real problem is about self-doubt is we don't trust ourselves because we don't follow through. This is the biggest thing about what creates self-doubt. If our plan says enter here, exit here, take profit here, and we don't follow it, we break trust with ourselves. Every time we do that, self-doubt grows every time we break trust with ourselves because we create uncertainty in ourselves to follow through. We don't trust ourselves enough to follow through. I'm scared of the market. Why are you scared of the market? Because the market has no control over you. You should have control over the things that you do, and that builds what? That builds self-respect. And self-doubt is just a feeling. It comes from past experiences. It doesn't come from now. It comes from something that's been created before. Let me tell you a story. I was tremendously afraid of speaking in public. Speaking, recording like I'm doing now, talking, sharing my perspective. Why? Because I come from a that's a typical Middle Eastern family. Like every time a kid speaks, it's like, don't say anything. You're just 8 years old. You have no perspective. You have no no knowledge yet to share with us adults. So they quieted down the persons in my family, and we all have this, by the way. Me, my brothers, my sister. We all have this feeling of self-doubt when we are about to speak in public. You know, the stage fright, because we feel that our perspective was not heard from the past experiences that we've gotten. And we grow When we grow to avoid those actions. I remember when I got older still, when I was sitting in meetings and we are doing a check-in where everybody's talking about their perspective, and when I remember when it came to me to talk, like my heart pounded, I got red in the face, I blushed, I was shaking, all this because of self-doubt that's created from my past experiences. And what did I do? I I went to Toastmasters to be a better speaker. I forced myself. The actions I was about that I did is forcing myself. So I found every place. I even called schools, by the way. I called schools, I called universities to tell them, you know what, my name is this and this, and I've done this before. Let me come speak to your class, just to force myself to speak in front of an audience to remove the self-doubt from my emotions, from my feelings, from my life. Why self-respect removes self-doubt? We trust ourselves, like I mentioned before, because we follow through. Because when you follow through on the words that you're saying without the need to feel ready, you become unstoppable. Why? Because you will become the person that follows through no matter what. And that like self-doubt will become this and then just get out of the way. Self-doubt is just your ego telling you that who are you to do these things. You should take the actions that the person without self-doubt is doing, and then self-doubt will get removed from your life because you're proving to yourself that you can do it. And you can do it. You know why? Because there are people that are not smarter than you that are doing this. And if they can do it, you can do it. Trust me, if I'm not the smartest person alive, but I can do it. If I can do it, you can do it. It's not rocket science. It's just system that we need to follow. And the biggest thing with trading is just follow through on your word. Keep your word to yourself. That builds integrity with yourself because you know what you stand for. You know that you're about to do these things because that is what you do. You set an expectation for your life because you're the person that follows through. You're keeping your word to yourself. And when you're keeping your word to yourself, that builds tremendous confidence. Why? Because we become, as Aristotle said, we are what we repeatedly do. Excellence, then, is not an act, but it's a habit. When you see somebody playing basketball in a pro level, that's not excellence. That is a habit that they are doing on a daily basis. Because actions builds the beliefs. You're proving, you have proof that you are the person that you say you are because you're doing the actions that the person that is professional is doing. And when you do that consistently, you build real trust, not with everybody, with yourself. And that spreads out to all the people seeing you. The truth. We don't remove self-doubt by thinking about it. We remove self-doubt by proving it to ourselves. So we do what we say we're going to do. And the solution here is to build self-respect. And how do we do that? We keep our word to ourselves. We keep our word to ourselves. Let's recap here. Hope you enjoyed this lesson. I talked about three things. We don't trust ourselves because we don't follow through. Self-respect comes from keeping your word, and confidence is built through executions. Lesson check-in. What made self-doubt clear to you in this lesson? One sentence is enough. Feel free to share it below so it will stick in your mind even more. If you haven't done it already, follow me on YouTube, Instagram, and join the school community. And I will love it if you left a comment or a review on the YouTube videos so it could get shared to other people that needs to hear this message. All right. Talk to you in the next lesson and have a great day. Hello and welcome to this lesson where I'm gonna be talking about self-sabotage and ego and how they are correlated. So self-sabotage and ego. I'm gonna talk about three things. Excuse me. Why ego creates self-sabotage, why growth triggers resistance. We feel kind of resistant to go back to our old ways. Why the process removes the ego. So first things first, we are trying to become a better version of ourselves, right? We are trying to become a better trader, a better provider for our family, for ourselves, for our future, and we are trying to learn the skill of trading. So we're trying to better improve ourselves, basically. So we are trying to create a new version of ourselves. While something inside of us, the ego, is trying to keep us the same. There is this voice that we keep hearing over and over again that's trying to keep us back to our old habits and our old ways of being. Because when you trying to better yourself, the ego loses its job. Because the more you better yourself, this is the ego, the more you better yourself, the further away you will become from the ego. And that is what trading does. It really, really challenges your ego. Why ego creates self-sabotage. The ego wants control, not growth. That's the thing. If you want to become a better version of yourself in every endeavor, not just trading, your ego wants to have control of the old, overweight, lazy, not following through on keeping your word person, because that's the person that the ego has control over. They say the devil leaves the people that are lost alone. The people that are lost in life and don't know what they're doing, they're not improving themselves, they're not taking care of themselves, they're not improving their life in any way. The devil leaves them alone. Why? Because they are doing what the ego is telling them to do. They're not feeling the resistance. And the resistance is a way that Stephen Pressfield talks about this in Turning Pro. When you're ready to turn pro, when you're ready to grow up, I'm using this as a metaphor to take your life seriously. That is when you will face resistance. You're facing resistance when you're ready to take your life to the next level. You face resistance when you're ready to take your life to the next level. It reacts when you're trying to improve. It creates resistance to keep us the same. You know, you're going on a diet, you feel the resistance to, oh, should I eat candy? Should I eat sweets? Should I eat those things? And like something inside of you should say, no, I'm taking my life seriously. I'm doing this now. I'm eating healthy because I want to improve my life. And you will feel resistance more and more the closer you will get to your goal. The same thing with trading. Why growth triggers resistance. The closer we get to progress, the more resistance we feel. As I mentioned, we start doubting and overthinking. Part of us wants to go back to the comfort. The voice in our head that wants to go back to the comfort, I don't trust the voices in my head anymore because I know that there are voices coming from the videos I'm seeing, the audio that I'm listening to, the news that I'm hearing, the negativity or the positivity around the world. That is what's building my decision making. All right. So I don't trust the voice in my head. I trust a system that I've created. I do this, by the way, in anything. So I'm here just to inspire you with that. When I'm trying to teach my son how to ride a bike, I write an Excel file, I make videos, I make pictures, and I do a process that needs to be followed so he can ride his bike eventually. The same thing goes with diet. The same thing goes with trading. We keep saying this over and over again with the process, right? The process removes the ego. Because if we have a process, riding a bike, going on a diet, trading a system, if we follow it to the T, it removes the ego. Because the process gives us structure on where we are going. If we are keep doing the process, eventually it makes it inevitable for us to reach the goal. Because we will eventually reach that goal, whatever our goal is. So following it removes the need to control. The process replaces the ego. Because if you have as your baseline, base take profit hits in your trading, that you need to take a $250 a day profit, right? You see the market going to $250 and you're not taking your profit. And something inside of you says, you know what, it's just $50 until the 300 dollar point. So let's just wait $50 more. This is the ego. And you inside of yourself should say no. What does the process say? The process say that I need to take a $250 daily. You close the trade and you remove it. Why? Because that upsets the ego that you did it. Why? Because you are removing yourself from the need of something external. You're becoming a better version of yourself by doing this, by following through on the process. The truth is, the ego doesn't want us to grow. It wants us to stay where we are. It will say things like, "Who do you think you are trying to make this work? You can't do this. We've always failed in everything we've done. Let me distract you by tempting you with gambling, new strategies, the shiny object syndrome, chasing dopamine rushes, chasing women, chasing men, chasing alcohol and food, and forgetting our real process, why we are doing this. Not because it's right, it just hurts me to say these things. Not because it's right, but because it wants control. The ego wants control. When you believe those things about yourself, the ego gets happy. And we don't want the ego to get happy. We want the process to be followed through. So the solution here, we don't fight the ego. We don't need to fight the ego. We just replace it. That's how we do it. Because if you fight the ego, it feels like you're swimming upstream. We replace it. We we replace it with what? With the process. If we just like really, if we just trust the process and we just submit to it, you will get there. I promise you. Just follow your plan, stick to your rules. If we just, I'm gonna speak in we form because this is for me also. If we just followed our plan, we stuck to our rules without breaking them and executed without any emotions, even though, you know what, feel the emotions, but don't react to them because you have a process that we need to follow and we followed it through to the T, and especially when we feel resistance. This is what took my trading to a whole nother level because as soon as I felt the resistance, I was like, you know what? I'm feeling resistance right now. Just because I'm feeling resistance, I'm gonna enter the trade even more, even harder. Why? Because that tells me that I'm on the right track. So let's recap a bit. The ego creates resistance when we try to grow. This is one of the 3 points that we took up or I talked about here in this lesson. The ego creates resistance when we want to grow. The ego doesn't want us to grow. I talked about the resistance shows up as self-sabotage, right? We almost we reach a level and somehow we find a way to break that something inside of us breaks the rules and we get back to level number 1 because we self-sabotaged by listening to the ego. Following the process removes the ego. The ego hates it that you're following the process over and over again because it knows if this soul, this person continues to follow the process, I will me as an ego will be out of business. That's why it hates it. So, lesson check-in. Take a moment. What made self-sabotage and ego clearer for you in this lesson? One sentence is enough. Feel free to share it below in the comment section below. And if you like this lesson, follow me on YouTube, follow me on Instagram, and join the school community. And I love it if you left a review or a comment on the YouTube videos. Um, I know it's annoying to leave a comment, but feel free to do it because that will help me, help the community, and it will boost the video to other people that needs to hear this. All right. Thank you for watching, and I see you on the next lesson. Take care. Hello and welcome to this lesson where I'm going to be talking about what is your why. This video will help you when you feel the times that you want to give up because trading is hard, trading is challenging, trading is will almost break your soul. But that's a good thing because you need a why to continue for it, to continue to learning the skill. Because every endeavor, you will have setbacks, you will have challenges, and your why shows you the direction to why you're doing this in the first place. So in this video, I'm going to share with you three things. I'm going to share why important, why most people lose their way, and why purpose creates discipline. So when we don't know where we're going, every path feels right. We find this other strategy. Oh, this is the way. We found another strategy. Oh, this is the way. And this is how they're risking. Oh, this is the way. Oh, a new prop firm opened up. Let's go to the new prop firm. Every path feels right, and then we get back to the place and we see what did we do? We didn't make any progress. We are just spinning around in circles because as soon as we choose another way, we go 3 steps, and then we go back and we choose another way. We get 2 steps, and then we go back and we take 5 steps. This is the way. And then we go back and then we go another way. We don't follow one path through enough. So why is why important? It gives us direction when things get hard, because it will get hard. That's a guarantee. I'll guarantee you that it will get hard. It will get hard. It keeps us focused when we want to quit. It keeps our focused when we want to quit. It reminds us why we started in the first place. Most people lose their way because they focus only on the money. I I get it that we want to learn the skill of trading because we want the benefits of the money and the freedom that it provides. But it needs to be more than only the money because that is where people quit. They forget their deeper reason. It has to be. It has to be a deeper reason than just I want to make money. It has to be because money is not that motivating for us because as soon as we get it, then what? They quit when results don't come fast. That's why most people quit. They want the results quick. They're not willing to put in the time to get the results, and they quit because the results didn't come quick enough. Let's say you reach the 10K, uh, 10K a month, right? You reach 10K a month. I'm using 10K. Just it's a simple number to use. Let's say you reach 10K. You will lose it. You know why? Because you're not that kind of person that is can keep the 10K. Because you were just focused on getting the money. You were not focused on shifting your identity. You were not focused on doing it for a deeper reason than just 10K. And trust me, when you reach that 10K, when you reach that 15K, when you reach that 20K sometimes, right? It will not feel like anything because you know that it's not about the money. It wouldn't feel like you just climbed Mount Everest and you're standing and watching all the people down there. It will not feel that way. That's why we think it will feel, but it doesn't. It doesn't. It's not true. Why purpose creates discipline. When we act from mission instead of obsession, we have an intention where we're going. We're acting from our mission. This creates discipline because we know what we're going. We are taking control out of taking control of our life. We stay consistent after a loss and we build something long term. Because when you have the ability to trade, nobody can take it away from you. Nobody can take it away from you. You don't have to share it in a divorce, right? You don't have to give it to someone, right? Nobody can take it away from you. You go to prison. That's a weird example, but you go to prison, you still have that ability to trade. Nobody can take it away from you. The truth is, if your only reason is money, you will quit. We will quit because trading will test you and losses will come and doubt will come. And without a stronger why, we quit, right? So, the solution, what is the solution here? What is your why? And it can't be, I want to make money. For example, I'm just giving you some examples. I want the ability to I want the ability to generate my own income. I want to rely on myself to support for my family. I want to stand on my own 2 feet. I want to build a skill that nobody can ever take away from me. I want to become someone who can create value on demand. I want the freedom to choose how I live my life. I want to stop depending on a job or somebody else. I want to prove to myself that I can do this. And the real here is it has to matter to you. It has to matter to you. You know, my why, whatever my why is, I'm just thinking about it. Like I get emotional directly. Just thinking about what my why is because it's so important to me. It's so important to me. And my why grows the more I get it. The more I'm closer to it, it grows more. It's like concentric circles. I'm reaching the big ones and the big ones and the big ones and the big ones until the end of my life, at least. So it has to matter to you. It has to matter to you. And it can't be just money. And the stronger this becomes, the harder it is to quit, right? This is because it's identity based. It's who you become. Setting goals based on who you will become, there is value that lies in that. Why? Because it's not just outcome based. It's not just I'm doing this so I can get money. I'm doing this so I can get a car. I'm doing this so I can get a house. It's not outcome based. It's something you can't touch. That is it. That is the goal that you should aspire to be like. I want to become this kind of person who supports for their family. I want to become this kind of person so I can stand on my own 2 feet. And it creates long-term drive and it shifts your identity. So let's recap a bit. I talked about 3 things in this lesson about what is your why. I hope you think this through and just write a short sentence of what's your why. Like why are you doing this? We need a clear why to stay focused. We need a clear why to stay focused. I've talked about money alone is not enough as a why, and a strong purpose builds discipline because every step you're taking has a purpose because it's mission based. It's not obsession based that I want to make 10K a month or I want to win 50K a month. So lesson check in. Why did we start trading in the first place? Why did we start trading in the first place? Ask yourself. Like you're talking to yourself and you're dragging yourself out and looking at yourself. Ask yourself, why did you start trading in the first place? One sentence is enough. Feel free to share it below if you feel comfortable with that. As always, if you like this lesson, feel free to follow me on YouTube, Instagram, and in the school community. And I would love it if you commented on the YouTube videos down below so it will boost the algorithm even more. Comment, like, subscribe. I would love that. Have a great day.